You have market going in an uptrend. Okay. And market found an area of resistance. Okay. So an area of resistance is going to be an area where people decide to sell at. Okay, so you're going to have sellers here. If price decides to come back up, price has a good chance to short at that same area, okay, of resistance. Since people sold there the first time, has a good chance to sell there the second time, okay? And then you're going to have areas of support. And these are going to indicate buying zones, okay? And even if it doesn't congruently happen like this, a setup can commonly look like this. I call it the support mirror, resistance mirror, or the stack mode mirrors, okay? So you might see a setup that looks similar to price might come up, it might rally past the resistance, you know, come back down, and then mirror the resistance, you know? Very common. You have setups like this for a downtrend type of setup. And then for an uptrend type of setup, could definitely look like this. Price might bounce here. And then price might come back up and then validate it again. So even though it invalidated at this area here, it decided to come back up over here and then go in an upwards direction. Okay. So we have to understand the market is a vertical chart. You're looking at a vertical chart. That's why I do not want you guys to fall into the indicators traps. Okay. Now, there are going to be some pretty good indicators. Okay. Volume. Okay. A lot of people don't even know what volume is. What is volume? Volume is going to be the amount of orders placed at a specific area or time. So volume is the amount of orders placed at a specific area or time. That's going to be volume. So that's the term you always hear. So you want to be buying at key areas of support, okay, because it's going to have most of the volume there. You want to be selling at key areas of resistance because most of the volume is going to be there. Now, let me go ahead and give you guys some secret sauce here. Way more powerful than indicators. Okay, understand that sometimes in the market, resistance can be broken and turned into support. Okay, resistance can be broken and turned into support, and then price can bounce in an upwards direction. Just the same way, support can be broken and turned into resistance. Okay, so resistance can be broken and turned into support, and support can be broken and turned into resistance. Even if it doesn't happen this cleanly, it can happen something like this. And price might run through there, come back up, turn this resistance here into the support later on. Okay, go to the support area, support, say price decides to run under here, come above it, and then come up again, boom. This area of support made this area of resistance created here, okay? So I make it simple for you guys, man. I do not want you guys to be struggling, okay? There's going to be times, life is going to be hard. The charts are going to be hard. People are going to be doubting you. People are going to be hating you. And there's going to be times you might not even believe in yourself. And all that doubt has to be killed, okay? And indicators equal doubt. If you have to rely on indicators to trade, then you can't be a profitable trader. Okay, if you can't just look at the chart and be like, okay, I see why price bounced here, 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 and here. then you cannot be a profitable or successful trader. You will continue to struggle. You will continue to go through hard times. Okay. And it's going to be very, very hard for you to elevate. And the indicators are what's holding you back. So I want you guys to do this. Okay. For a year, no indicators. Okay. No indicators. Just read the candlestick chart clearly. Read it raw. Read it raw. Okay. That's what I need you guys to do. So for a year, no indicators. And I want you guys to just go hard, man. Go hard. Put in 16, 20-hour study sessions. Live on these charts. Understand every single micro reaction. Understand why price bounced at every single area that it did. Understand why price sold off at every area that it did. We have to get the full congruent picture. We want to get to the next level, and we're pushing harder than ever. We're not stopping for nothing. Okay, this is real therapy for me, guys. Just sitting here teaching you guys these charts. I'm so passionate about this. You know, I live for God, and I live to just get people out of financial poverty. I don't want to see anyone struggling. I don't want to see you guys blowing up your accounts or committing suicide over the markets or just going through any financial hardships. I want you guys to be successful. I want you to get to the next level. And I want you to win. Okay? And I want you to win. And best way to win on the charts, okay, is you have to have your setup. Okay? Follow your heart. Okay? If God put it in you to trade, trade. Don't let anyone stop you. Don't let anyone stop you. You have to trade. Okay? Whatever's inside of your heart, you got to go with that. You got to do that. It's going to be times you're going to be feeling doubt. It's going to be times you're going to feel like, oh, it's not for me. I don't know. But God put it inside of you for a reason. So go hard. Okay? Follow your heart and follow your setup. Okay? You tell yourself, I'm only going to play break and retest. Okay? If you're a break and retest trader, why are you trading anything else other than break and retest? Why? If you're a mirror trader, okay, someone who trades resistance or support mirrors, okay, why are you playing anything else other than mirrors? You need to, if you're a trend line trader, okay, why are you playing anything else other than the trend lines? Okay, that's the things. You have to follow your heart and follow your setup, and most importantly, follow God. Okay, you can get successful. Investing, it's important in this world. Okay, the more shares that we buy, the more companies that we can help, the more that we can help each other on this earth. Okay, faster healthcare products, more communication so we can communicate with our parents, grandparents around the world, etc. Okay, investing in the stock market is crucial. It's important, and don't let anyone else stop you guys from doing it. Very, very passionate about teaching this, and if you want to learn more about it, and if you want to get a free stock watch list, should see you at stackmode.net. Stay prayed up to God, keep grinding. Catch you in the next one. Peace. The strong reasons why market's going to be going in upwards directions is due to the fact that these stocks help the United States economy. That's going to be the strongest reasons, and there's a reason why the billionaires within the trading community are people who play United States stocks companies, whether owning shares and options such as Warren Buffett, etc. Because it's going to be honestly the easiest market to play. Forex market is very sideways. Futures you can't hold overnight unless you have a certain amount of margin. So the United States stock market and even cryptocurrency is going to be great realms to just buy and hold your money. Okay, so let's go ahead and continue the lesson here. So these stocks aren't just random stocks listed on TradingView or these brokers so people to just make invisible money. These stocks are real companies that people actually work at, okay, that we might have worked at in real life, okay, and they generate real income. So since they generate real income, they can also employ people. So they can employ people. And when they employ people, these people pay taxes to who? The government. Okay, so as long as these companies are making money, okay, and people are working at these companies, then the government will continue to make more money. So these companies being profitable, these companies doing well, these companies making money, they help out the government. And anything that helps out the United States government will be pushed. Okay, that's just what we know about trading and just fundamentals of things. Okay, if it helps the government, it's going to be pushed. Okay, there's a reason why cryptocurrency didn't get a big push until SEC laws and stuff like that were regulated. Okay, so until the government regulates it, and unless the government has something to do with it, it's not going to have too much value until then. But every single one of these stocks boost the economy since they put jobs out for people. Jobs include people who pay taxes. Taxes go to the government, making the United States more wealthy. Wealthier we are, more power we have over other countries. Okay. So it all starts from just simple things like wealth. So options and the fact that these shares and stocks go up in an upwards direction is really important. Okay. It's way more important than people even think. Okay. So market's not just, oh, I'm going to come on here and just make some money. Okay. It's real life stuff happening on these charts, and really understanding everything is going to help us understand what we're going to be trading for. So market's going in an upwards direction. So this is why we're going to be focusing on call options. Okay. So as we know, call options, they pay you whenever you think price is going to go in an upwards direction. Okay. If you speculate and you're buying a call option and you think price is going to go in an upwards direction and you're correct, then you get paid. Okay. So that's going to be a call option. And the reason why we're going to be focusing on call options is exactly what I just broke down. These stocks have incentives to go up. There's also going to be laws such as the short sale restriction that are going to be in place too, to make sure that these stocks don't just fall flat down to zero. Okay, there's a reason why decades of these stocks of going in an upwards direction has been a thing. Okay, so it's about letting go of all the fear, trusting God, not having any weird anxiety of, oh, what if it just falls down to zero and it's time to start just investing and being a boss. Okay, so we're going to be talking about the proper levels to play at. Okay, and we're going to keep talking about why we're playing at these levels and what we're buying. Okay, I always want you guys to understand why. I never want you to just be like, okay, just do X, Y, and Z and just do this. It's going to work. No, I want you to understand the deep reasoning why this works, why people are billionaires buying just shares and call options. Okay, so it's about finding things that are undervalued and catching the sweep up. Okay, every company wants its share price to go down. It doesn't make sense to really play puts due to the fact that market is not built to go down. Exactly. And even when market does go down, exactly. Even when market does go down, people are quick to buy the dip. People are quick to buy the dip, and market will recover right back to wherever it dipped from heavily. It'll fill it right back up. All it is just a discount. All it is just like clothes and cologne and whatever. It's just going on sale. That's all it is. Market just goes on sale whenever it falls down. So puts don't really make sense to purchase, especially when you get on your higher time frames, especially when you're playing companies that have good revenue and actually make money and the share price increases year after year. Playing puts, not only are you going to have significantly shorter trades, your take profits aren't going to be as easy to put down because one, you can't predict where the market's going to bounce at. Okay. So you can't predict where the market wants to stop at all the time. Now, shorting and stuff like that comes really from Forex traders and is something that's seeped over to the stock market. But the Forex chart and the stock market chart is completely two different worlds. Okay, stock market just goes up in an upwards direction. Okay, and that's just the truth of it. Okay, if I pull up the Forex chart here, Forex is extremely sideways. Okay, you have price action all the way up here. We got price action all the way from here from 1977. We got all types of stuff going on. Okay, but if I click on the fluffy stock market, it's literally going up in a straight line. Okay, it's almost impossible to not make money in the stock market. This is why I'm so passionate about teaching in these videos. I'm starting to realize that They've literally made it to where we can just get money for free. It's welfare. It's genuine welfare. Instead of making stupid decisions, trying to flex for people who don't care about us, trying to make decisions that are just way too fancy right now instead of staying down and investing. Okay, those are the things that keep people back from being financially free significantly early. The opportunity is here for us to just invest money and infinitely turn your money into more money. This just goes up in a straight line. It's impossible for anyone to not make money on the United States stock market. It's impossible. Okay. And it's about just making really good decisions. So, price has an incentive to go up. So, forget put options. We're focusing on calls. Okay. We don't want to be shorting the stock market. There's a reason why you can't even short the stock market on a lot of brokers, too. You also have to think about that from a logical perspective. Most people on most brokers cannot short with shares. Okay. They can't short with shares. They can only purchase shares. So everyone's trying to just buy the stock. Also, CEOs are trying to be richer than the next CEO. So they want their company's share value to be going in an upwards direction. They want to be classified as a billionaire. So also more incentivization to go in an upwards direction. And there's also something called dividends. Dividends are going to be what the stock pays out. So the more you invest into a stock, if a stock is making good income, it'll pay out what's called a dividend. And that's going to be money that it pays out back to the shareholders. Okay, so it's like, you know what? Thank you guys for investing in us. Here's some money back. Okay, here's your reward. And that's what it's going to go ahead and say. Okay. So if a company has enough money to do that, that means that it's profitable. If it's profitable, it's most likely going up on the stock market. Okay. So there's incentive for it. The more profitable something is, the more it's going up on the stock market. Hence why when a company makes a big deal, it just shoots up. Okay. Because it's now more valuable. Okay. The more money and the more valuable something is, the more of a high share price it'll have on the stock market. Okay. So, cool. That's keeping those things in mind. So now let's talk about when a setup is going to be good to play and when not. Go. So let's say, for instance, here, I have this area up here. Okay. One area that we're not going to play at is going to be called all-time highs. Okay. We're just not going to be playing at all-time highs because, one, we're trying to catch a sweep up. Okay. So all of your setups will look like a V. Every single setup will look like a V. Okay. And what your profit is going to consist of is the right side of the V. Okay. So the left side of the V is going to be the resistance. Okay. This is where price is falling in a downwards direction. So you can see here, you could see price creating resistance here. Okay. This is the left side of the V. Price is falling down. Okay. The left side of the V. What we're looking for is playing the right side of the V. Okay. We're playing the right side of the V. All of your trades are going to be the right side of the V. Okay. You're going to be buying call options, expecting price to sweep up. Okay. That's what you're going to be looking for. So how can you play the right side of the V if price is falling the left side at all-time highs? You can't. Okay. So let me show you a good example of an actual good setup. So this is how we find a setup. What I'm going to be looking for is a couple of things. One, I'm going to be looking for higher time frame areas. So I'm going to make sure that I'm on my higher time frames. I'm going to make sure I'm on my weekly time frame first. My weekly time frame is going to help me see everything. It's going to be my eyes. I'll go from my weekly time frame to my daily time frame to my 4-hour time frame. Okay, so you're going to start off on the weekly time frame first, due to the fact that the weekly time frame is going to help you once again see everything. It's going to be like an eagle eye. Okay, because tunnel visioning when it comes to trading can be extremely bad. Okay, you want to be able to see the full picture and not just what you're seeing on a smaller time frame. You're then going to go to the daily just to see the picture painted a little bit in more detail. And then you're going to go to the 4-hour to see any hidden candles. So what we're going to make sure is that whenever you're on your 4-hour time frame, and this is why we can't just use the daily and the weekly, we have to make sure our extended trading hours is on. So as you can see, the daily and the weekly don't have that. That's due to the fact that they don't show pre-market hours because the weekly and the daily go off of 24-hour blocks. So that's why we still need our 4-hour time frame. And then we're going to be able to turn on extended trading hours to see all the true candlesticks that we're missing. Okay. So so yeah, extended trading hours always needs to be on. So we're going to go from the weekly to our daily to the 4-hour. So let's go ahead and let's mark out a setup, for example. Okay, I'm going to talk about what I'm going to be looking for, and then I'm going to jump onto the charts. So my setup is only going to consist of 2 things. I'm only going to play setup 1, which is going to be a support mirror. Okay, if you see price bouncing at an area of support, you're going to be good to go ahead and purchase there. Okay, if you see price bouncing at an area of support, reacting from another area of support, okay, that's going to be a good area to purchase. Support is going to signify an area of demand where people want to buy the price. So it's going to indicate where buyers step in. Okay, so buyers step in an area of support. And we're buying call options, meaning we get paid when price goes in an upwards direction. Okay, so we want to be buying at areas of support. Okay, so if you see an area of support mirror itself one after another, that's going to be a good setup. Or it'll look like this. Sometimes you'll have an area of support. Price might run down through it. Okay, it might not bounce at the other area of support. It might break below it. But then it might come back up and bounce at the support again. Okay, even this would be considered a support mirror. Okay, so even if price runs down underneath the first area of support, if price decides to bounce at the area of support again, that's a clean support mirror, I like to call it. Okay, so you'll either see one area of support bounce right after another, or you'll see an area of support mirroring an area of support from the past that maybe didn't get reacted off of immediately. Okay, so your setup will either look like this, or it'll look like this for criteria number 1. And criteria number 2, very simple. It's when an area of resistance gets broken, and an area of resistance is going to indicate where sellers are. So resistance indicates where sellers are due to the fact that people have too much supply. So that's why resistance gets created in the first place. There's too much supply. When people have too much of something, when they've made too much money, they're like, all right, you know what? It's time to close. I'm out. Okay. And then they're going to go ahead and close their trade simultaneously. And a wave of enough people doing that is going to create what's called resistance. Okay. That's going to create resistance. So let's continue on here. So if an area of resistance decides to get broken past, okay, if an area of resistance or support gets broken past, we know that's called a breakout. So resistance getting broken past and turned into support is going to be called break and retest. Okay, break and retest. Okay, waiting for resistance to turn into support after it's been broken. So it's when you're waiting for the resistance to turn into support after it's been broken. Okay, if you see this, you can take the trade pretty much safely. Okay, we're going to talk about some certain criteria, how to read daily closes, etc., what a close is. But let's talk about some more fundamentals we are going to be looking at. It's important to have a logical mechanical process before we put down any type of size or money. Okay, did price do this? Did price do that? Having a large checklist is going to save us a lot of money when it comes to making any type of mistakes on the market. Okay, so one thing we're going to pay attention here to is the earnings. Okay, whatever broker you're on will most likely tell you. But before you put down a trade on whatever stock you're looking at, make sure that you look at the earnings. The earnings are going to go ahead and let you know when the report is going to come out, and the stock can significantly make upwards or downward sweep when these earnings reports come out. So we want to be making sure that earnings aren't anywhere near. Okay, if earnings are 7 days or less away, and you're trying to don't open a new trade. If you're already in something, it's fine. But if you're trying to open a trade and earnings are 7 days or less away, don't do it. Okay, because the price action is already going to be weird, and people are going to be wary of the same thing. They're going to wait for earnings to happen first and then make the trade. Okay, so if you see earnings a week away, 7 days or less, don't take the trade. Okay, just don't take it. Now, if earnings is far, you're fine. So those are going to be the criterias we're going to be taking. Let's talk about it on the chart. So once again, we're always going to start off on the weekly time frame, doing what's called top-down analysis, TDA. T stands for top, D stands for down, A stands for analysis. Okay, top-down analysis, TDP, TDA. Okay, so what we're going to do is I like to always mark out, okay, where would I want to close this trade if I got in? Okay, I can see price made all-time highs up here. So let me just go ahead and draw a zone up here. Okay, and I like to just eyeball. Okay, we don't use any indicators. We're not going to need any indicators. What we're going to do is pay attention to straight candlestick price action. Just like I told you, price should be doing the right side of the V fill. Okay, so we can see price decided to fall in a downwards direction here. Okay, this is going to be the left side of the V. Okay, and what we're doing is catching the right side of the V. Okay, we're going to be catching the right side of the V. So let price form the left side of the V, and then we're going to get in and catch the right side of the V. Okay, so you can see price maybe potentially trying to make a low right here. Okay, potentially trying to make a low right here. Let me go to my daily. Okay, I can still see price making a low right here. Okay, I can see, okay, I'm on my daily time frame. So I'm gonna get on my weekly, put an area of resistance, put a zone around it, okay? Because I know, one, price has an invitation to go in an upwards direction, okay? It helps the government, helps the economy. It's trying to go and be the most profitable and helpful company, okay? It's a lot of recognition, and as human beings, we care about things like that, okay? So recognition will be coming with being the most profitable and best company. So in order for that to be credible, share price has to be decent. People have to be investing into it. So let's increase the share price. Okay, that's what people are hoping for. So let's drop better products so people buy from us. That is what people are really hoping for who are behind these companies. So let's think like them. Okay, so you can see price deciding to make a bottom here. Okay, so then I'm going to start on my weekly. Okay, I can see just this large gap of space here between here and up here. So here I have the left side of the V. Okay, I have the left side of the V. Price already created it for me. And then price already drew out the bottom point. Okay, so now I'm going to go to my daily here. I can see price drew out the bottom point for me here. Okay, now we can see price potentially wanting to fill up the V. Okay, so what we're going to be doing is catching the whole right side of the V. Okay, so we can see price made the left side of the V already for us. Okay, we can see it. It made it left side of the V. Now, price made a low already. I can see on my daily candlestick, and this is what I'm going to be looking for. Okay, no indicators, no nothing. If I'm on my daily and I see price bouncing from a low, okay, with a large gap of area from an area of resistance, and I see price making multiple daily candlesticks go up in a multiple color stick direction. So I can see here green candlestick, green candlestick, green candlestick. I see multiple green candlesticks in a row. Okay, multiple green candlesticks in a row. Just like we have multiple red candlesticks in a row going down, if I have multiple green candlesticks in a row going in an upwards direction, and I see a large area looking to be filled in to fill in the right side of the V, okay? Even if price falls down at the resistance and goes down to all the way down there, we don't care, okay? Because we can clearly see that price wants to try this area of resistance again. It's like, hold on, how am I going to fall down right here? I'm not with that. Let me try it again, okay? And it's going to try it again. And when it goes to try it again, that's going to be our profit window. That's our opportunity. We're not here to get the best entries in the world. We're not here to predict the most high point of the market, the most bottom point of the market. We're here to react. We're here to come onto the market, scroll down, see, oh, market made a low right here, and it make it high. It looks like it wants to try this high again. Okay, it might want to break this area. And that's what you do is you react within the market. Okay, and this is going to be the trick on options. So option sellers, right? Before we jump into the trick and why we're going to do what we do, let's talk about it. So option sellers, what they're preying on is that people make some ridiculous gambling dice decision, okay? They want people to make some just fried, horrific decision. So options aren't just spawning out of thin air. There's a reason why certain stocks don't have any options attached to them. Because one, nobody is selling the options in the first place. Okay, so options are not just spawning out of thin air. It's called trading for a reason. Once again, it's called trading for a reason. Okay, contracts have to come from somewhere, and they come from people turning their 100 shares into a contract and then selling it. Okay, and what they're trying to make money from is that we don't win. Okay, they're trying to make money hoping that we're wrong. Okay. But we're trying to make money hoping that we're right as options buyers. Okay. So here is how, as an option buyer, how we can make some good profit, right? Let's talk about it. So as an options profit buyer, okay, of course we want to make some profit and some money by being in the right direction of the trade. Okay. So obviously we're buying calls. So we want market to go in a upwards direction. Okay. So in order to outplay the option sellers, we're just going to play not ridiculous bets. So you can see we just did all that criteria to determine if price was ready or not. We looked at another trade and saw it was at all-time highs. We would not buy because that's the left side of the V. We're looking to only purchase the right side of the V, which looks like it wants to be filled up here. Okay, let's catch the rest of the candlesticks and farm the rest. So what I'm going to do is come up here to the team. Okay, and I'm going to be able to see the options list. Okay, so the furthest to the left here would be the closest, and the more right I go would be the furthest. So what I'm going to be focusing on is called an options leap. The reason why people say options are so risky and etc. is because they're just not playing it right. Everything in the world is risky. Okay, driving on the road every day is risky. So we're not going to be scared. We're going to be smart. So options leaps. Okay, this is what we're going to be focusing on. Leaps is a contract that I say you hold between 3 months to 2 years. Okay. Any contract that you hold between 3 months to 2 years is a leap contract. Okay. So let's say this contract here, right? Let's say I bought this. Let's say I analyze this area of support, right? Let's say I'm like, yeah, price make the bottom of the V here. Okay, just like a V. You know, a V has a point. Okay, let's say I like the bottom V here. Let's say I want to go ahead and catch the right side of the V, right? Let's say I believe in this. Okay, I'm like, you know what? I'm on my daily time frame here. I can clearly see market's been trending in an upwards direction for quite some time. Okay, you can clearly see we're just sweeping up year after year after year. You know what? This is a profitable stock. Oh, okay, cool. We're beating earnings, beating earnings, beating earnings, beating earnings. I like that. We're paying out dividends to people. Okay, I like that. This is going to be a comfortable play. So I would go ahead and purchase a contract that makes sense. Okay, so this is going to be some sauce right here. So I'm going to buy at least a year out if I wanted to. Okay, so I would buy for a year out. Okay, or I could buy 2 years out to be even safer. Okay, so let's say I want to buy 2 years out. This is how you know what's going to be the best contract to buy. Okay, so what a lot of options people get destroyed on is the theta. Okay, and what theta is a Greek. Okay, so options has Greeks. We have delta, theta, and gamma. Okay, theta is going to be the Greek that equivalates to time. Okay, so whenever you think of time, think of theta. Okay, so once again, whenever you think of time, think of theta. So in order to outplay the theta, we need to make sure that we have plenty of time on our contract. So the theta and the Greeks don't destroy our mental patience, okay, and make us want to crash out. Okay. So instead of worrying about, oh man, I gotta close my trade in 2 seconds, like I gotta close my trade in a week. No, you have years on it to hold. Okay. And you can see price is already bouncing in an upwards direction. So what you're gonna do is whatever the current number is of your options contract, okay, whatever the current number is, and your options broker, wherever you're on, will always tell you. Okay, it'll always tell you, it'll be in the middle of whatever options chart that you're looking at. Okay, the best contract to purchase at all times, okay, is going to be the contract one number above, okay, we're going to purchase the contract one number above the current price. Okay, so if current price is at 26.20, right? What we're going to go ahead and do is purchase the 27 contract. Okay, that's all we're going to focus on since we're buying a call contract. Okay, because we only want to buy in an upwards direction. Okay, just like we broke down, there's reasons why stocks wants to go in an upwards direction and why they go up year after year after year. Okay, and why people get rich by just turning their money into more money by investing into companies that put the money in the government's pocket. So you can get rich by investing in companies by putting money in the government's pocket, inshallah, if God wills. So we're going to go ahead and focus on the call side, since that's the side that pays us whenever options are going in an upwards direction. Okay. So we're then going to focus on the current price. Okay. So let's say current price of this stock is 26.20. Okay. We just did all of our verification. Is price ready on the right side of the V? Okay. If price is ready on the right side of the V and already made a bottom point, we're ready to go ahead and purchase that. We're going to go to our options. We're going to make sure that we're buying at least 3 months to 2 years out, depending on how far your take profit is. Okay. My take profit here, let's say I did on the weekly, I think this gap is pretty big. So just to be safe though, don't be cheap. Okay. Be safe. Okay. Being safe is what's going to get you wealthy within trading. Okay. Focus on the trades that aren't going to lose you money. Okay. People want to trade zero DTEs, trying to make some money feeding for bread, but they end up blowing up their account over and over and over again, not making anything or making some money and then losing it all. Okay. Because it's not safe. It's not consistent. So play options in a safe way. Buy 2 years out and buy the number one above current price when it's already trending in a positive direction. So this way, you're going to get your bonus points too. So this is why we use our higher time frames for options too, because we want to be catching the whole move. Okay, so we're buying years out and catching the whole move. So the higher time frames is going to show us the whole move here. So I can see I would personally close at the area of resistance. Okay, you always want to fill in the V structure. This is why the V structure is important. Okay, price will make the left side, you catch the right side. Okay, and you fill in the V structure. Wherever the V started at, slanting to the downside, is where you close at. Okay, so it's going to be where you close at. So price started resistance here, fell down, made a bottom point. I'm going to keep my profit window is going to be the remainder of the V. Okay, the remainder of the right side of the V. Even if price was up here, okay, I would still be able to catch the remainder of the V up here. Okay, the earlier entry that you see is just the more money you're gonna get. But even if you enter later, that means that you have a higher probability of being right. Okay, and we're here to play safe. Okay, you want to focus on the trades where you're not gonna lose. Okay, you don't know if price wants to bounce down here. But once price has showed you that it wanted to bounce down there, it's a lot easier to get in and make your decisions based off of that. Okay, so let the market react for you. You don't have to predict, just react to the market. Okay, react. Okay, market decided to make a heavy area of resistance here. close at the heavier resistance here so we don't get reversed on here again. Okay, we don't know if price wants to reverse right here. Okay, it might not or it might want to. All we know is that price wants to go and give it another whirl, it looks like. Okay, and we're just going to take advantage of that and be happy with that profit. Don't ever try and 50-50 the breakout. Okay, your take profit will always consist of an area of resistance above current price, or it'll be an area of support above current price sometimes. Okay. Sometimes your setup's going to look like this. You're catching the right side of the V and you're closing at the area of support. And that's because, just like the opposite, resistance can be broken, turn into support. Support can be broken and potentially turn into resistance. Okay. So we want to keep that in mind and trade safely. Yeah, it's really just taking your time and just letting the market react and do its thing. Okay. So these are going to be the two things we're going to be looking at. That close at areas of resistance above current price, which a lot of the time it'll be, or support above current price, since resistance can be formed there and you want to get in before market falls down. Since we're focusing on calls, we want to get paid whenever market goes in an upwards direction. Okay, so we don't want market to fall down. Okay, so keeping all of this in mind, catching the right side of the V, we know what contract we want to purchase. Okay, I'm gonna go 2 years out. Okay, I'm gonna look at current price. And even though my take profit up here is 29, I'm still gonna look at current price and buy the contract one above. I'm still gonna buy the 27 calls contract. The reason I'm not gonna buy the 29 calls contract is because options, once again, you get paid based off of predictions. So even though our chart closing is gonna be at 29, we're going to buy the 27 contract because all the profit we get is going to be bonus points. Okay, 27 is the number before 29. So even if we bought 28, you would get bonus points too. So any number of a contract that you buy before your take profit will be bonus points. So it makes sense to buy the number one above. So even if take profit was 35, I would still buy 27 just because 27 is before 35. And I would get all the bonus points. I would get, and the more points that you go, so if I bought at 27 and I closed at 35, it would get bonus points per number. So it would be bonus points at 28, at 29, at 30, at 31, 32, 33, because I'm so right. Because I'm right way before. Right? So because I'm so right, it just pays you out stupid amounts. And that's how people just do nasty flips. And I've done some nasty flips on option myself. Okay. So let's talk about another setup here, okay? So you're always going to want to be looking for price to be forming at a low, okay? You want price to have made a low already, all right? And you want price to have made a high too, okay? So in this instance here, market's still looking for its low, okay? It hasn't quite made its low. It tried right here. And this is why I like to look at the daily here and wait for multiple candlesticks going in a green upwards direction. Okay, so you can see here, we wouldn't have gotten faked out by that. Okay, so this right here, say this low that people tried to buy, this is why we don't buy what's called falling knives. Okay, you don't know where market wants to bounce at. Okay, you can have a good idea of it, especially when it comes to the upside. Okay, and you don't know if market wants to break out. So if market creates resistance here, I'm gonna close at this resistance. I'm not gonna say, oh, market's not gonna fall down there again. No, I'm just going to close at the resistance. Okay, it's a lot easier to play like this and play to the upside than it is to catch ultimate bottoms. Okay, just wait for the bottom to form and then play to the upside that's already been formed. It's a lot easier. Okay, so instead of trying to catch every single bottom and then price keeps falling and then you're losing money catching a falling knife, wait for the bottom to form. Okay, until I'm on the daily time frame and I start seeing green candlesticks going in upwards direction, I'm good. Okay, I want to see multiple green candlesticks in a row before I take any type of trade. Okay, so take some type of low like this, right? If I see price make a low and I see multiple green daily candlesticks in a row going up, I'm like, oh yeah, price wants to do that. But I can clearly see here, like an area like this, price just faked them out here, okay? Price tried to go up, but it's red, okay? Red candlesticks, and they're very sideways, and then market just dumped, okay? But then we have a low right here, green heavy candlestick. I'm sure this candlestick was green too before the close. And then green candlestick, okay? Super heavy low right here. Green candlestick, green candlestick, green candlestick, okay? Even right here. Green candlestick, green candlestick, green candlestick, right here. Okay, same thing. Green, 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 green in a row. So if you're not seeing at least a couple of green candlesticks going in an upwards direction on the daily, then that low just isn't true. Okay, the low is just it's pointless. Okay, it's what you want to be looking for. Look at this low here. Okay, this low worked out, it formed, and then we started seeing green daily candlestick. See, I would have answered on the second one. I never answer on the first one in the zone because I don't know if price really wants to bounce there. But if I see another green candlestick and then another green candlestick, I'm like, oh yeah, that's cool. But price, it was pretty much close to the area of resistance here, and then we'll see if price wants to continue from here. Okay. So price decided to fill in this area of resistance right here. Okay, we have this area of resistance right here, and then price falling down right here in the zone. Okay. And then one day price will try and break this area potentially, and then we'll try and go up to this area of resistance, I assume, up here. Okay. So could wait for price to find another V and then take the whole side upwards like that. Okay, but right now it's just not ready. Okay, market is dumping on this, and it gotcha. So here, gotcha. So if I bought right here, I will close my first contract here, just because price keeps spamming this resistance. Okay, I would close, close the first contract here, and then if I have more, then I'll go ahead and I'll close the next one up here. And this is why I buy years out though. But even if I, yeah. Class, we're going to be talking about value investing versus growth investing. We're investing for a reason. It's time to stop being broke. Being broke isn't cool. Late bills isn't cool. Debt isn't cool. And suffering isn't cool. If you want to start being broke, all right, start being lazy. Start not believing in your view. Start closing your trades early. Okay, start doing things like that if you want to stay broke. So let's talk about value investing versus growth investing and how we can actually have our money make some money. Let's jump into it. So an investment philosophy is a consistent overarching set of principles and beliefs that guide an investor's decision-making process, and it dictates what to buy, and when to sell. Without a coherent philosophy, decisions become emotional and reactive, and the core tension in equity investing lies between intrinsic value, which is what a company is worth today, and future potential, which is what a company could be worth tomorrow. And by the end of this module, you guys are going to be able to understand how to articulate the foundational theories of value and growth investing, how to identify key financial metrics using each philosophy, and assess which approach aligns best with your personal financial goals and risk tolerance. And value investing is rooted in the principles laid out by Benjamin Graham. And it's often called just someone who's pretty good at investing. Okay, and it's popularized by one of his most famous students, Warren Buffett. And the core of the idea is simple, and it's buying $1 for 50 cents. So intrinsic value, right, IV. This is the estimated actual worth of a company, and it's calculated through fundamental analysis, which is analyzing assets, earnings, and cash flow. And value investors believe that the market price often deviates from this implied volatility and intrinsic value due to irrational investor behavior. Let's talk about margin of safety, MOS. The most critical concept. This is the difference between the stock's current market price and its estimated intrinsic value. And a high MOS provides a cushion against calculation errors, business downturns, and market volatility. And the business owner mentality. Value investors think of themselves as buying a part of a business, not just trading a stock ticket. And this leads to a long-term patient holding period. So, Graham introduced the concept of Mr. Market, and it's a manic depressive
business parser who shows up every day offering to buy or sell its shares at a wildly different price. A smart investor does not let Mr. Market's daily mood swings dictate their decisions. Don't let them come up to you and be like, you know what, I want to go ahead and just get into this because X, Y, and Z decisions. Make sure it's logical, okay? Don't just hop into it because of a FOMO candle, because of emotions. And remember, the compounding effect is what's going to get you guys to the profit that you want to be getting into. You got to stack up the cash, stack up the wins, keep investing in certain shares. Okay, so a smart investor, once again, does not let Mr. Market's daily mood swings dictate their decisions. They trade based off of logical and fundamental parameters, and instead use rationality to their advantage. And when buying, they're pessimistic. So buying when prices are low and selling when euphoria is in and the supply is super duper low. Okay. And that's gonna mean the demand is in, which is gonna make the prices high. So buy low, sell high. And the value of a buy. If a company has an intrinsic value estimated at $100 per share, a value investor will only consider buying if the market price is $60 or less, creating a margin of safety of over 40%. And the investor must be confident in the IV calculation in general. So formula, market price divided by the earnings per share, EPS. So the PE shows how much an investor is willing to pay for every dollar of a company's earnings. And value investors generally see stocks with a low PE ratio compared to historical averages and industry peers or the S&P 500. And a low PE suggests that the stock is currently cheap relative to its profitability. So for example, a PE of 8 means that it's going to take 8 years for the company to earn back your initial investment, assuming constant earnings, meaning that it's constantly making profit. So the price to book ratio, the PB, and the formula is going to be the market price per share divided by the book value per share. And the book value, which represents the shareholder equity, it represents the theoretical value left over if the company sold all its assets and paid all its liabilities. And the PB ratio is less than 1.0, and it indicates that the stock is selling for less than the liquidation value of its net assets, which is considered a classic deep value signal. While less common today, it's essential for financial and industrial sectors. And DE, debt to equity, measures a company's leverage, and value investors prefer a low DE ratio, as high debt is going to be a major source of risk and can erode the margin of safety. So free cash flow, right? FCF. Free cash flow is the cash that a company generates after accounting for cash outflows to support operations and maintain its capital assets. Strong, consistent, and FCF is vital as it fuels dividends, stock buybacks, debt repayment, and the things that ultimately justify intrinsic value and the things that are going to cause a stock to go in an upwards direction. So pay attention to all these things, okay? Look at the ratios, see what's going to be worth investing into, and scan each of the fundamentals and know what each of them things mean before you invest, okay? You can see quality companies that are temporarily mispriced and not companies that are structurally flawed, okay? Because over time, that'll lead into a downward decline of money for the most part, okay? They're not helping anybody. They're not putting any value into society. They're not making people smile. So it's not going to be a worthwhile company. It's not going to be something that is going to put some future value, okay? So there's no point in investing to things like that. We're here to make some cash. We're here to stack some cash. We got people to take care of, houses to buy, land to get, okay? We got to be stacking this cash and getting to it, inshallah. So there's some pros. There's the lower downside risk. The margin of safety acts as a buffer. And by buying below the intrinsic value, the potential for further significant losses is theoretically reduced. And psychological calm. Value investing encourages patience and detachment from daily market noise, reducing emotional trading errors. So in dividend income, value stocks are often mature and profitable companies return capital to shareholders via constant dividend payment. Why? Because the company's making so much money. They're going to be like, you know what? You guys can go ahead and have some money back. Here you go. And that's what a dividend is. And patience is going to be required. All right. It can take years for the market to realize the stock's true value. And that's okay. Okay. Be patient. Keep stacking cash. Keep grinding hard. Keep waking up, praying to God, and putting your full force into whatever, your business, your work. Keep stacking cash. Okay. Keep going hard, trying to protect and provide for yourself and your family. Okay. Keep stacking cash. Stay down. Get into stack mode. Don't buy that whip just yet. Don't buy those clothes just yet. Okay. You don't got to fill up the cologne cabinet full of X, Y, and Z right now. Stay down. Okay. Take your time. Build real wealth. Okay. So you can take care of your family whenever it's time. Okay, you're going to be the one who can handle the hard times. Okay, why? Because you were in stack mode, you didn't give up, and you were staying down. And the value trap, this is the greatest risk. And a stock looks cheap, right? Low P and low PV, but it's cheap for a valid reason, such as a fatally flawed business model, disruptive technology, or poor management. And the value never materializes. And missing out on innovation. By focusing on established, mature businesses, value investors often overlook high growth companies that are changing the world. And the ideal value investor is patient, contrarian, analytical, and possesses strong emotional discipline. They thrive deep on research and are comfortable standing alone against popular market sentiments. So, foundation principles. Growth investing focuses on companies that exhibit above average rates of expansion and revenue and earnings, often driven by new technology, market expansion, or innovative business models. And the philosophy was philosophized by investors like T. Rowe Price and Philip Fisher. Okay, and has a focus on momentum. Growth investors prioritize future earnings and potential over current valuation metrics. They're willing to pay a high price today for the promise of massive earnings tomorrow. And disruptive innovation. Some key characteristics include a high rate of sales growth, a strong competitive advantage, a moat, and a rapidly expanding industry, and a focus on reinvesting all profits back into the business for continued scaling. Okay, and ignore current profitability. It's common for high growth companies to report low or negative earnings, okay, just because they're getting their feet off the ground. Okay, they're letting the sales come in, letting the customers come in. Doesn't mean that the company is not worth nothing. And thus a high PE ratio is going to be involved into that as they invest heavily into R&D, marketing, infrastructure, and trying to make the company bigger. So then their profit margin is going to be a lot bigger. Okay. And while a value investor seeks a stock trading at $60, that should be $100. A growth investor seeks a stock trading at $100 that they believe will be worth $500 in 5 years. Okay. They're concerned with the trajectory of the business, not its current snapshot. Is it going to be putting a smile on people's faces? Okay. That's going to be the number one telltale sign to know if a business is going to be successful or not. How much is it affecting people's lives? Okay. And a growth buy, let's talk about it. So let's say a software company is losing money today, has a negative EPS, but its recurring revenue is growing by 50% annually. A growth investor buys based on the expectation that once the company achieves critical mass and stops aggressively spending, the profits will be enormous and the stock price will multiply several times over. So focus. Investors primarily look at year-over-year revenue, growth, and earnings per share, the EPS growth. And consistent growth above 15 to 20% is often the benchmark for a true growth stock. And quarterly acceleration in these metrics is a major bullish signal. So let's talk about the law of large numbers. Growth investors must always assess how long a company can sustain high growth rates, as it becomes exponential harder as the company scales. And that's the law of large numbers. And we'll talk about the PE ratio. Okay, divided by the annual EPS growth rate. That's a percentage. The PEG ratio attempts to harmonize PE and growth rate. And the PEG ratio of 1.0 or less is often considered a fair value for a growth stock. And it suggests that the price being paid is reasonable and relative to the expected growth. And if a stock has a PE of 30 and is growing earnings at 30%, then it has a PEG of 1.0. So high growth, recurring revenue. High growth software and subscription companies are highly valued for their predictable recurring revenue streams. Okay, for example, software as service or SaaS. And TAM. TAM is going to be the total potential size of the market and that the company is targeting. The bigger the TAM, the longer the company can maintain hyper growth, and investors seek companies with small current market penetration but colossal TAM. Okay, and TAM stands for total addressable market. It's a principle. Growth investors are fundamental betting on future performance and disruptive power in an expanding market, looking to make money constantly. So, advantages: potential for explosive returns. The possibility of 5 or 10x returns in a shorter time frame is the primary draw, and compound growth is exponential. And exposure to innovation. Investors gain exposure to the companies driving technological change and societal evolution. And the simplicity of thesis. The core thesis is often easier to articulate, and this company is winning in a massive growing market. Okay. And the cons: extreme volatility. High expectations lead to steep sell-offs, and if the company misses even minor earnings targets, these stocks are vulnerable to economic downturns and interest rate hikes. And valuation risk. Paying a premium for growth means the investor must be right about both the growth rate and the sustainability. If growth slows, the stock can fall dramatically. and the lack of dividends. Growth companies typically reinvest all the cash flow, meaning that the investor receives no current income at all. So the ideal growth investor is risk tolerant, technological savvy, forward-looking, and comfortable with volatility. They seek to capitalize on the long-term trends and accept the risk that many investments will fail, provided the successful ones generate outsized returns. So, bridging the gap, the GARP philosophy, famously employed by Peter Lynch, it seeks to combine the best aspects of both disciplines. And a GARP investor looks for companies that are exhibiting consistent above average growth, but are not trading at exorbitant, speculative valuations are going to be involved in them. And a GARP criteria, it's really the best of both worlds. Okay. GARP, it stands for growth at reasonable price, by the way. A growth at reasonable price stock often has a PE ratio that is only slightly higher than the overall market, but its EPS growth rate is slightly higher, and it blends the safety of a modest valuation with the upside of strong business expansion. And the PEG ratio is the primary tool used by GARP investors. And the GARP investor profile, right? Consistent growth. It seeks stable, sustainable growth. For example, 10 to 20% per year, rather than volatile exponential growth. And the focus on quality. It prefers companies with strong balance sheets, high returns on equity, right, and strong free cash flow. And it's hallmarks of a fundamentally sound business. And risk mitigation. Okay, you can see things like the PE and PEG metrics, which you can use to evaluate and to avoid grossly overpriced stocks, thereby mitigating the risk inherent in pure growth investing. So you don't be buying things at all-time highs, stuff like that too. So insight. GARP is perhaps the most practical strategy, once again, growth at reasonable price for the average long-term investor, providing a path to the market and beating returns without taking on undue speculative risk for no reason at all. So choosing the right approach is less about what's right and what's wrong, and what about aligns with your personal goals. Are you a family? Are you a guy with someone with kids? Okay. Are you a woman with someone with kids? Are you by yourself? Okay. You just have a partner. Can you go a little bit more heavy with your investments? Are you trying to play it safer with maybe dividends? Okay. So let me know what you guys are doing in the comments below. So your time horizon, right? It's going to be 10 years if you're value investing, but you prioritize capital preservation. Your risk tolerance is going to be low to moderate, and you dislike volatility. And your goal is going to be to generate current income via dividends and stable compounded returns, investing in things like SPY, QQQ, and things like that, slow movers that are very consistent. And you enjoy deep analytical research into financial statements to figure out the best ratios to see what's going to pay you guys the most out. And consider growth investing if your time horizon is long and you're seeking to maximize capital appreciation. And then maybe you might want to go ahead and invest into some value stuff, dividends, after you get some day trading, futures profit, swing trading profit, whatever. And your risk tolerance is going to be higher in this scenario. And if you're comfortable with significant drawdowns, and your goal is to capture exponential returns from market disrupting businesses, and you're technological informed and enjoy following market trends and innovation. So have a diversified portfolio. Okay. I recommend you guys having a long-term portfolio and then you guys having a short-term portfolio. Okay. Also, because the taxes are going to be different too. If you're holding a trade for over 1 year, taxes are going to be subject to some long-term tax benefits versus the short-term tax benefits if you sell before a year. Okay. So decide what's best for you. Okay. Invest in a smart way. Keep this capital. We're building wealth for ourselves, our families, our loved ones, making sure everyone can be taken care of, making sure everyone can be protected and provided for, because we're being disciplined, because we're going hard, and because we're pushing forward. All right. Don't be in your head. Don't let anything stop you guys. Stay prayed up to God. Keep grinding and head over to Stackmode.net if you want to learn how to be disciplined and how to invest. Catch you in the next one.
After you've been grinding for years, really busting your tail, you want your money to work harder than you do. And dividend investing might be the easiest way to build passive income. But most beginners overthink it. But dividend investing is really simple. You just buy shares of strong, established companies, and they pay you cash just for holding them. And that's it. So imagine waking up to deposits monthly, weekly, and certain dividends pay out in different ratios and frequencies, and they hit your account while you sleep. That's the power of dividends. Let's go and let's jump into it. Let's understand what dividend investing is and how you guys can start building some passive income for you and your families. Inshallah. Let's talk about dividend investing. Making our money work for us is going to be the most ample way to, one, get our mental health back. Okay, I understand we're grinding hard, working year after year after year after year, but let's at least make our money make us some money. Okay, we're not just grinding. Okay, no more exchanging time for money. Okay, it's time to start exchanging money for money. Okay, this way you guys are going to be a lot mentally healthier. You guys are going to have time to get closer to God, work on your family relationships, work on yourself, work on your business, and understand that when you have your money flowing within that asset river constantly, you're using your cash and buying more assets with it, and it's flowing in the river, flowing in the river. You could pretty much never work again. Okay, so when people talk about passive income, retiring, it's about putting your money within that income river. Let's go and let's talk about how to make our money work for us. Inshallah. So, what is a dividend in the first place? A dividend is going to pretty much be a thank you payment, okay? And they pretty much just tell you, hey, you've been investing in us for a long time, you've been believing in us, and I'm going to go ahead and give you some money back because we've been crushing it on the company side. So, a dividend is a thank you payment, okay? So, whenever you invest into a company that pays out dividends, or you're invested into an exchange trader fund, okay, which is a compilation of companies just put into one big giant fund, then you could also get dividend payments from there if the fund pays it out. Okay, so let's say imagine you lend money to a friend, right, to start their lemonade stand. Okay, you believe in them, you think it's going to turn up, and every month they start giving you $10 from the profits as a thank you because he started turning up, started making tons of money. Okay, so that friend who started the lemonade stand decided to give you a portion of the income because since you gave him that initial investment to believe in him, okay, and you funded his company, he did the right thing and gave you some profits back because you had his back and you believed in him. And that's what a dividend payment is. When you believe in these companies, when you believe in these ETFs, then we're able to get some profit back, inshallah. And that's a dividend. It's real cash paid to you just for owning a piece of the company, okay? And it's passive. Okay, you don't got to do no work for this money. All you got to do is buy. Okay, all you're doing is turning money into more money. Okay, dividends is going to be one of the most extreme forms of passive income, especially after you guys have grinded out 6 to 7 figures. Okay, being able to plant that 6 to 7 figures into some dividends and get paid $5,000 to $25,000 a month just for having your money parked is going to be a really, really good way to just chill in life. Okay, and it could be regularly. Okay, it's usually paid every 3 months, okay, so quarterly, and it's very, very safe. So usually only strong, profitable companies pay them, okay? It's not a lot of broke companies paying out dividends because they can't afford it, okay? A lot of companies paying out dividends are companies that have it all based out. They know that you investing into the stock market, okay, is going to go ahead and give them more income. They're then going to be able to turn that income into bigger buildings, hire better and more employees, okay, which should lead to them making more income, okay, better products, faster products being made, etc. So that way their income can skyrocket, okay, and when that happens, we benefit from it too. And a lot of the times too, dividend payments, okay, have certain dates set to them. Okay, sometimes you get dividend payments monthly, sometimes you get dividend payments quarterly, a few times a year. Okay, and every single company and ETF is going to have its own different dividend payment cycle. So before you invest into something, make sure you're doing your research. So here's an example, okay, just one more time to make sure we understand it. Let's say you own 1 share of Apple, okay? Per 1 share of Apple, Apple pays you 24 cents, okay? You can check your phone, okay, and that money is sitting in your account, chilling, okay? You didn't have to sell the stock to get it, okay? All you have to do is just have your money chilling in stocks. So you get paid for turning your assets into more assets, okay? So after all the day trading is done, after grinding your business hard for years, after grinding corporate hard for years, take that money and you guys can easily park it into some dividends and start getting yourself some monthly cash flow, okay? Put some mental health back into yourself and take some of your money and let's try and get some passive income from the money we already have and we've been working hard for. Let's go to the next slide. So let's go and let's talk about the dividend yield. So the dividend yield tells you the return on your money right now, okay? And it's kind of like the interest rate number on your savings account, okay? So as you know, for APY accounts, okay, interest though, you know, is a reason why God says not to do it. It's not something that'll leave you profitable in the end anyways, okay? So focus on things outside of interest. But let's say annual percentage yield, let's say there's an account that would give you like 3% per year, okay? With inflation and taxes though, that's not anything. Okay, so when you're focusing on dividends though, something like that, okay, then you're going to be able to get a lot better bang for your buck and for your value. Okay, so average yield, right, around a 2 to 5% average yield is going to be healthy. Okay, and a red flag, if the average yield is over 8%, okay, be careful. Okay, it might be a trap and the company could fall off later, even if they're paying out big dividend payments right now. Okay, you want to try and have your dividend payments be as consistent as possible. Okay, you don't want your dividend payments to go down. Okay, if you're getting 5K a month for the money you have invested, that's how much you want to be getting. Okay, you don't want it to go down to 3K one month and then your bills and calculations are all thrown off. That you don't want it to happen. It can be really, really frustrating. Okay, so let's do the math. So let's say the stock price of something is going to be $100. Okay, and then they pay you $4 per year. Okay, so the yield, okay, is 4, since they're paying you $4 a year, divided by 100. Okay, and that's the stock price, and that's going to equal a 4% return. Okay, and that's how the dividend yield is going to go ahead and be broken down. Let's go over to the next slide. So, is it safe, right? The payout ratio. So let's talk about the pizza analogy. So think of a company's total profits as a whole pizza, okay? And the payout ratio, it's how many slices they decide to give you, okay? And that's going to go ahead and be exemplary for the shareholders versus how many they keep to grow the business, okay? So how many slices of pizza are they going to give to you? And then how many slices of pizza are they going to try and hold on to, okay? And safe, okay? So under 60%, okay? If they give you 6 slices and they keep 4, okay, that's safe, okay? That's safe. Why? Because they were able to pay you a little piece of the pie, okay? Make sure you eat and make sure they eat too, okay? Because they got to be logical. They can't feed you if they're not feeding themselves, okay? So they be logical. So, but it can be dangerous if they're giving away over 90% of their pizza. If they're giving away their whole pizza every single time, then they're going to have no food left over for tomorrow. Okay, so you have to watch and look at the payout ratio percentages. Okay, so let's say company A, right? Let's say earn $10. Okay, and then they give you $2. Okay, they would have $8 left. Okay, and that's going to be pretty safe. Now, let's say company B, right? Let's say they also earn $10. Okay, and let's say company B paid you 9.99. Okay, they paid you $9.99. Okay, they'd be left with 1 penny left. Okay, what type of investments or growth can they do then? Okay, so focusing on the payout ratio of the dividend you're looking at is going to be extremely, extremely imperative to making sure that you're not making any random decisions unnecessarily. Okay, focus on companies with safe payout ratios, because that way you can see that they have their math baked in for consistent scaling year after year after year after year, not just random sporadic payments being sent out and then they have a possibility of going broke and then there's really going to be no more dividend payments. Okay, so in order to avoid all of that, avoid the hardships, try and focus on dividends and companies and ETFs that pay out very safe ratios so that they don't go broke, so then they can continue to pay out dividends so you can continue to feed your family and yourself, inshallah. Let's go to the next slide. So let's go and let's break down the snowball effect, okay? The compounding effect, stacking dollars, okay? Get into stack mode, okay? Stay down. I don't care if you got to wear the same clothes every single day, okay? Keep driving that old car, okay? It's not time to get a new car right now. Stack it up, okay? Set some parameters. Tell yourself, you know what? Until I have 100,000 stacked up, I'm not going to get X, Y, and Z. Until I have 1 million stacked up, I'm not going to get X, Y, and Z. All this just takes a couple months and a couple years, okay? You guys got it. Go hard. Go hard. Go hard, because it's really time to automate your wealth, okay? And it's going to be the secret sauce. Instead of spending your dividend cash on coffee or random other things, okay, you can press a button called drip, okay? So what drip is going to do is take your dividend income, okay? So say you're making $100 a month from dividend income, okay? You could take that $100 a month and buy some more dividend shares with that, okay? So that way that $100 a month will turn into $150 a month. You keep doing that, it'll turn into $200 a month, okay? And then it keeps stacking up over time. As long as you're in stack mode, your account will be in stack mode right with you. Just know that, okay? So drip equals dividend reinvestment plan. A lot of brokers have it to where you can automatically just reinvest your dividend income back into more shares, okay? So the computer or whatever broker you're using uses your dividend cash to buy more shares automatically, okay? And next time you'll have more shares, so you get a bigger bag, bigger check. Then that bigger check buys even more shares and it spirals upwards, okay? So trying to have your life together outside of the market, okay? The more you have your life together outside of the market, the more money you'll be able to generate from the market, okay? Just keep cycling your money back into shares, back into more shares, back into more shares, and keep upping that income. So let's say year one, you own 100 shares. Okay. You invested super duper heavy. Then by year 10, okay, you own 150 shares. Okay. And let's say you didn't even pay for the extra 50 shares. It was just stacking up over time. Okay. So once you start planting that seed of ownership, your tree can do nothing but sprout and grow, inshallah. So plant your seed today so you can start sprouting. You guys can start dropping fruit everywhere. Okay. But you got to plant your seed. You cannot start dropping fruit everywhere until you plant your seed. Okay. So then from year 30, 20, then from there, you're earning a full salary from dividends alone. And then you could chill out. Okay. You still have your money parked away in the dividend, and you're getting paid for having your money parked away. It's crazy. Okay. If you make the right financial decisions, you stay focused on God, and you don't feed your flesh, you guys can get out of poverty. Okay. You guys can be rich forever. You can never go broke again as long as you maneuver your wealth into that constant asset river. You have to continue to flow your money in that asset river. Otherwise, things can get hard. Okay. So throw your money into the river and start flowing so you guys can grow like the big oak tree. Plant all your seeds today. Let's head over to the next slide. So let's jump into royalty stocks, right? Dividend aristocrats. So these are going to be the MVPs of the stock market. Okay. And to be on the list, a company must have been in the S&P 500, okay, which is accumulation of like the most powerful stocks, okay, put into one index, okay, known as the S&P 500. And two, okay, they must increase their dividend every year for 25 plus years straight. So if a company is paying, right, 20 cents per share, okay, in 2010, okay, and then in 2011, let's say they're paying 25 cents per share, okay, that's going to be a 5-cent increase. Okay. So if they're increasing their dividend amount every year for 25 years straight, then that's going to be a big MVP. And that means that these companies have survived recessions, wars, bubbles, and still paid their investors more money, which means that a lot of these companies are going to be constant investments due to the fact that it seems like that these companies have become a staple in human lifestyle. Okay. Companies such as Coca-Cola, okay, or Johnson & Johnson, the Band-Aid company, for example. Okay. So companies that incorporate into lifestyle, okay, really are going to be the ones that will survive year after year after year. So let's go and let's talk about the risk with everything. Okay. Pay attention to that yield trap. Just like we talked about on the previous slides, the yield trap is going to be really important to pay attention to. Sometimes you see a stock paying 15%. Okay. You think you're about to be making bands every single month just by investing into a simple dividend. Okay. And they might pay you out for a couple of months. Okay, you might be getting 5K a month payments, for example, okay, for 3 months. And the next thing you know, they start losing profit. Things start getting shambles. And then boom. And then the high yield decides to stop paying you out what you're used to getting paid out. And if a company runs out of cash, I'm telling you, they're going to cut that dividend to zero. Okay, so just with the pizza analogy, okay, you can't help anybody in the world if you're not helping yourself first. Okay, so if you have a box of pizza, right, there's 10 slices of pizza. Okay, if you give away 6 slices of pizza, okay, you'll still have 4 slices of pizza for yourself. Okay, you can still eat. You're not gonna be starving, and you're gonna be chilling. Okay, but then take person B. Okay, if person B gives away all their pizza, they're gonna have no pizza left over. Okay, and that might seem like a good thing instantly. Okay, because they fed everybody and ignored themselves, but that's not. Okay, that'll turn into later frustration, later hunger on that person, regret on that person. Okay, and they're going to be like, well, you know, people might not have fed me in certain type of ways. Okay, leading into certain type of mindsets. Okay, so even in dividends, it tells us it's really important, okay, to keep our bag right. Before we can help anybody else, our bag has to be right. Okay, and dividends show us this. If a company is giving away all their money, they're not going to have enough money to reinvest into more ads, into more workers, into better factories, etc. And they're not going to be able to scale at the way that they would like to, if at all. Okay. So if a company runs out of cash, they're going to cut the dividend to zero. So be wary of new companies, especially paying out big dividends, because it might not be consistently for long. And that's when the crash comes. Okay. And when they cut the dividend, the stock price drops even more because it's going to go ahead and lose value, which means you lose twice. So not only would you lose money on your base, money that's parked in there, your dividend payments are going to go ahead and get cut as well. So a golden rule, right? So a safe 3% return is better than a 15% risky return that has a chance of going to zero. Okay, don't be greedy. Focus on consistency. The name of the game in trading, investing in general, is consistency. Treat yourself like an oak tree, and you gotta plant yourself in the ground. You gotta give yourself water and sun. Okay, if you're not planting your seeds and you're just trying to hit the big 0 to 100, you're just trying to go buy an oak tree and plant it in the ground, it might not be stable. Okay, it didn't get time to connect to the roots, to the soil, and it might topple over. Okay, but when you're the tree and you grow it day by day, limb by limb, okay, root by root, okay, you're gonna know the field, and your money is gonna be planted within the soil. It's gonna have a lot better baseline to it. Okay, even if stock prices were to start dipping down, since you have so much baseline planted, okay, stuff isn't really gonna affect you. Okay, your dividend payments are still gonna be pretty consistent, and your profit fluctuation isn't gonna be as bad because you planted your seeds. So focus on planting your seeds over a quick win. So how do you start today? Okay, I'm gonna give you guys a 3-step plan. So the account, open up your broker. Okay, you guys can do Webull, Robinhood, Fidelity, Schwab, Vanguard, so many different options. Okay, open a brokerage account. Okay, then from there, okay, you can buy ETFs. ETF stands for Exchange Traded Fund, and they're pretty much going to be a bunch of companies put into one big giant company, for example. Okay, so you could buy really, really consistent ETFs like SCHD that pay out really, really good dividends, or VIWM, for example. Okay, and it's a basket of 100 plus dividend stocks that give instant safety. Okay, or you could pick individual stocks as well too. Okay, and then the button. So find settings for your dividend reinvestment and turn it on. This way, all your dividends are going to go back into shares consistently, instead of you guys just having random cash, and then you're going to have to go buy dividends, instead of you just having it all in that DCA consistent flow mode. Okay, so don't forget, diversify. Okay, and a good way to diversify is to really invest into ETFs as well too. Okay, let's head over to the next slide. So dividend investing is really like going to be the ending to everything. Okay, it's the furthest thing from a get rich quick scheme. But after you run up 5 figures, 6 figures, 7 figures, you've been grinding, you've been putting in the work, you've been praying to God, really staying down. Once you have some money stacked up, dividends is going to be a good place to park your money in, and you guys are still going to get that monthly income and that monthly reward from it. But make sure you guys are choosing to invest into things that pay you out consistently, and be patient, be consistent, and start now. Okay, start now. That's going to be the most important thing. Start generating your business now. Start generating income now. Start doing whatever you need to do now. If you say you want to invest into certain assets, if you have $5 in your account right now, take that $5 and invest. Okay, start planting your seeds today, and that's going to be the most important thing. It's not really about the money. It's about your lifestyle, your consistency, okay, and how disciplined and focused you are when it comes to stacking your assets. All right, if you want help with it, head over to Stackmode.net. Stay prayed to God. Keep grinding. I'm going to catch you guys in the next one. Peace. Keep going hard. Don't ever give up. I'm not the richest person in the world, but I've bought over $10,000 worth of Bitcoin at 22. All credit to God. And here's a couple reasons why. One, Bitcoins come clutch for me. Many times at night, my bank might be going through certain maintenance, and I'm able to go ahead and send over some Bitcoin to my Coinbase card and spend it and make the purchase that I need to. Or say I want to send some money to somebody in another country easily and without worrying about any holds, stoppages, or anything like that. Or if I want to just turn my money into more money by investing into the future, Bitcoin was one of the many options that I chose in order to stack my money. We're going to go ahead and jump into some great reasons and why I personally invested in Bitcoin, and you guys can see if you want to jump into it as well too. All right, let's jump into it. Let's go and let's talk about Bitcoin, why we're purchasing, and let's take a look at this chart. So I want you guys to start focusing on your higher time frames. So for this example here, we're going to be paying attention to the weekly time frame, okay? Some of you guys are too caught up on the 5-minute, 15-minute, etc. Make sure you guys are at least on your daily time frame whenever you're analyzing your chart before you scale down to your lowers, just so you can get the real bigger picture. So let's check everything out. So I'm zoomed all the way out here. We can see Bitcoin had a beginning price here, and price decided to trickle up year after year after year. And you could see price has been going within a vertical direction year after year after year, not sideways like certain Forex markets or other crypto coins as well too. So crypto, especially Bitcoin, is mirroring the stock market a lot of the times as well too. So if you pull up the S&P 500, you're going to be able to see some correlation between that and Bitcoin. So let me go ahead and show you guys something, for example. So pay attention to this April 2025 low here in Bitcoin, correct? And then I'm going to go ahead and pull up the S&P 500, also known as SPX, and you'll be able to see the same low mirrored within the same place, okay? So Bitcoin is also going to be a limited quantity asset, okay? There's not an infinite amount of it. So that generates scarcity, and the scarcity alone makes it a great investment. Very similar to why people invest into gold, buy diamonds, buy certain expensive pieces of jewelry, rollies, APs, etc., due to the fact that there's a limited amount. Okay, limited amount of something, especially with large amounts of amounts on this earth, and more people spawning in every single day, scarcity is going to pretty much equal value 100% of the time, especially in a situation dealing with digital currency where more and more people are starting to spend money online. Since we have the ability, thank God, to save the headache from going to certain stores now, Bitcoin is going to be a really, really good asset that people are going to be looking to park tons of money into, since they can pull it out any single time. Okay, you can transfer it to either a Coinbase card, for example, spend the crypto just like that, or transfer it over to your bank account. Okay, so you have a couple other options. I have a presentation for you guys, and let's jump into the specifics of why I invest in a Bitcoin, why I think you guys should too. Let's go. All right, let's go and let's cover Bitcoin's uses for the future, its technological fundamentals, and its place within society. So the foundation of everything, right? The scarcity and decentralization. Let's talk about it. Scarcity. So when something is limited, one, it equals value, okay? Take certain cars, for example, okay? A Lamborghini is significantly more valuable than a Honda, for example, due to the fact that the materials are more scarce, okay? Since there's a limited amount. Okay, so scarcity, a lot of the times, especially when it's something that's going to help society, okay, or make a human feel a certain type of emotion, value is going to be presented by making things scarce. And let's talk about decentralization. So decentralization is pretty much meaning that there's no human higher power controlling the funds. Okay, so within the bank world, if you try and send a wire transfer to somebody, the higher power within everything that can see all transactions has the ability to decline or approve said transaction. Okay, but now if you're trading within the decentralized world, trading cryptocurrency, if you want to send 10,000 to somebody, you can instantly do it as long as you have their receive address. Okay, so decentralization is putting power back in the people's hands. Okay, and you're going to be able to send money to people all around the country, all around the world within an instant time, whether at 3 a.m., 6 p.m., no waiting for the traditional Monday through Friday window as well too, that centralized banks use. So Bitcoin's power is derived from its two defining characteristics, which solve fundamental flaws and really put the power back into people's hands once again. So the Bitcoin protocol is hard-coded to produce a maximum of 21 million Bitcoin. Okay, so there's 21 million Bitcoin in total. And if you don't know how Bitcoin is created, here's how it's done. So people take computers, okay? In order for a computer to work, it has to be fueled by power, okay? So POWs are going to be the unit that's needed in order to create Bitcoin. So it's not like fiat currency or the United States dollar where it can be put into a printer and infinitely printed out, okay? No, there's a fixed, stable amount, finite amount of Bitcoin. Okay, so power is then converted into the mining software. Okay, so it's looking for certain hash codes within the blockchain, and once enough of those are mined, all of those come together and you'll have a Bitcoin. So now you'll see a lot of people going to other countries where power and stuff like that is a lot cheaper than, let's say, the United States, and are mining Bitcoin and then selling it for profit. So the future is really changing the way people are living, and as far as where their country's main residence is. Okay, so some people are starting to have houses in multiple different countries due to the fact that Bitcoin mining is a really profitable way to get ahead in the future and make some good income. So this fixed limit makes it the hardest money ever invented. Unlike gold, where new supply can still be mined and total supply is really unknown, Bitcoin's supply schedule is perfectly transparent and predictable. declining exponentially until approximately the year 2140. Okay. So gold, we don't really know how much gold there is. We don't know how much diamonds there are as well too. Okay. But Bitcoin, just the fact that there's a finite amount gives people more of a haste to purchase every single low as well too. And let's talk about the monetary pausing as far as the halving. So every 210,000 blocks, roughly every 4 years it occurs, the reward miners receive for securing the network is cut in half. And this halving event is systematically reduces new supply, mimicking the increasing difficulty of mining a rare metal and making it mathematically impossible for any entity to inflate the supply, keeping it stable. Okay. And decentralization and censorship resistance. The network is run by thousands of independent nodes across the globe, meaning no single government, bank, or corporation can control the supply. Everything is done by autonomous, automatic, smart contracts. Okay, so no single bank or corporation can have transactions, halt transactions, seize funds, or freeze funds. Okay, and this distributes power and ensures the network remains neutral and permissionless, putting power back in the people's hands, ensuring a safe peer-to-peer transaction system. As much as humans love jewelry as well, we do love buying things online, especially as we progress into more of a digital future society. So using Bitcoin as digital gold is also going to be one of the main reasons why it continues to go up year after year. And the primary investment case for long-term holding, right, is going to be buying the dip. Okay, so one Bitcoin falls down in certain places, right, even after making new all-time highs, people are going to be quick to buy the dip due to the fact that people already see it as a digital gold. So when the dip happens, you have to capitalize. You can't be scared. You have to be ready to put that money to the side and invest and really sit on your investment. People have been holding gold for decades, eons. Okay. So you have to think of it as that. Don't expect to instantly make money overnight. Okay. You have to have that long-term, decade-based mindset. And I'm telling you, the money will be in your hands a lot quicker than you think, inshallah. So it's also protection against fiat debasement. So traditional government currencies, which are fiat, are subject to inflation, as central banks can print unlimited amounts, eroding purchasing power over time. So take real estate, for example. People wonder why rent and stuff like that has gone up substantially over the course of a few years. Here's the reason why. The government has been printing significantly more funds as of the years have gone by. Okay. So certain other things like programs that increase the US debt too, such as like food stamps and stuff like that. So the government has to compensate for giving out money. So they compensate that by printing more money. But as we can see, year after year after year, that does not work. And that leads to economy crashes and inflation being at all-time highs. So thank God people who coded Bitcoin decided to come out with a counter to that. Okay, so if you're able to still make purchases all around the world without having to exchange your currency, which would be a lose of value depending on a certain economy. Okay, take the US, right? If $10 in 2025 doesn't get you as much of food as it did in 2008, that means that the value that you exchange, even year after year after year, won't be the same. But Bitcoin, a lot of the times, will be that stable debasement. Okay. It's also going to have some superior physical characteristics compared to gold and diamonds too. You don't got to worry about getting robbed in certain ways physically. You don't got to worry about stashing your house, or if your house burns down, or God forbid you run into any type of unfortunate event, you're not about to lose all your wealth. You keep it parked though. Okay. Keys are going to be really important. Don't give anybody your secret key. There's also going to be things called cold wallets too, where you can keep all of your Bitcoin on USB drives, physical drives. But if you get it wet, destroy it, lose it, or something like that, you can also lose all your funds that way too. So choose what's the best option for you. So portability, right? Gold bars are cumbersome. Bitcoin is borderless. You can trade all around the world. You can buy stuff all around the world and send money to anybody all around the world. And it can be transferred via a simple 12-word phrase called your secret key. Make sure you guys don't give that to anybody. Keep that safe, keep it around, and you guys will always be able to get back in your wallet. Okay. Indivisibility. Gold is pretty hard to divide. If you have a nugget or a bar, that's pretty much what you have. It's not easy to split that down the middle or make some kind of easy trade. Somebody has to be down to accept what you have. And one Bitcoin is divisible into 100 million Satoshis, for example. okay, allowing for microtransactions and small investments, or if you just want to purchase something. Okay, if you have 50 gold bars and they're 3 pound solid gold bars, it's not easy to exchange that for currency immediately. Bitcoin, you can easily send it to a broker like Kraken, Coinbase, or something like that and instantly get your money in your hands quickly. And gold requires specialized assays as well too. Okay, so you can't just pull up on anybody in the world and give them a gold bar and expect some money. Okay, they're going to want to verify the gold, want to do certain tests, make sure that the quality is decent that they want, and see what carat it is, and all that is really going to determine how much you're going to get. And all that also is really based upon how well you're taking care of the gold bar too. Bitcoin, you just buy and hold, buy and hold, and that's really the beauty of it. Buy and hold. So it comes to the point of, okay, instead of you buying that McDonald's for the day, you bought some Bitcoin for the day. So it's really a test of who's feeding their flesh and who's being disciplined. Okay, if you're being disciplined, inshallah, you'll be rewarded. Okay, so because Bitcoin is still early in its adoption, right, compared to gold, which is still at all-time highs as of this recording, right, investors view it as an emerging store of value, and this is just massive potential. Okay, and a lot of asymmetric upside, especially as we start seeing stuff like the US government invest into it, start seeing other countries start teaching it within schools and stuff like that, and we could just see the world going into a lot more borderless financial revolutionary and freedom era within society. Whether you're a boss trying to place some employees in a whole another country, Bitcoin is really going to be an efficient way for easier payments. Just like I spoke about in the beginning of the video, there's been times where my bank has had maintenance at 3 a.m., 2 a.m., and I haven't been able to make some transactions, but was able to go dig in the crypto stash, go to my Phantom wallet, transfer it to my Coinbase, and was able to make the purchase that I needed to. Okay, so once again, having that decentralized, safe, and pretty much having your money parked away into a world that's not controlled by maintenance times and centralized control, whether it comes to banks, whether it comes to power with when you can send your funds and how you can send your funds as well too. Banks also come with certain things such as deposit amounts and withdraw amounts too. So a lot of things are really outside of your control when it comes to that. So having your money parked into a world that's going to be a bit more free is going to be best case scenario for yourself, for your survival as a human, and for your family if you have one too. So beyond its role as a reserve asset, Bitcoin and scaling layers are solving critical pain points in global payments, making transactions a lot faster, cheaper, and more transparent than the legacy banking system. Then it really streamlines international remittances. That's really the biggest part of Bitcoin, and it's really a blessing. Lets people from other countries be able to receive funds in case you want to send some money to your family, or you might have somebody that works for you or work for somebody in another country, and you'll be able to get paid quickly within the crypto. Okay, and traditional wire transfers can be extremely slow, like 1 to 3 business days, and don't forget that doesn't include the weekends, and it can get declined due to the fact that they don't have to let that go through if they don't want. They can be expensive. You're going to be paying that wire transfer fee a lot of the times, and pretty opaque, right? You're not going to know when the money exactly is going to hit. It's not going to be direct, and you're not going to be able to check certain things. When you send Bitcoin, you immediately can go check the confirmation link, and you can go see it on the Blockchain Explorer, see exactly when the transaction is going to get confirmed. And what a confirmation is pretty much lets you know when the other person has received the funds, most likely. Okay. And it utilizes layer 2 solutions like the Lightning Network, which allows the value to be settled globally in seconds, bypassing multiple correspondent banks and drastically reducing fees dramatically. Okay, so let's talk about the Lightning Network. It's a second layer protocol built on Bitcoin that enables near instant zero fee payments for the most part, almost zero fee. And this technology is being adopted for everyday purchases and micropayments, proving Bitcoin's capability as a medium exchange, not just a store of value. And transparent and security. So every transaction is permanently recorded on the immutable public blockchain ledger. And this enhanced auditability reduces fraud risk and fosters greater trust between distant parties, which is often lacking in complex legacy cross-border payment systems. Okay, so you don't have to worry about any things like weird holds, weird stoppages, or things like that, which can be extremely frustrating when you're trying to do business or just buy something pretty simply. And it's definitely a big help to society, right? It's bringing in the democratization of finance. Bitcoin's greatest societal contribution is arguably the empowerment of financially undeserved and its ability to act as a lifeline in politically or economically unstable regimens. And banking the unbanked. Globally, billions lack access to traditional bank accounts due to high fees, certain things like ID requirements, and stringent KYC, which stands for Know Your Customer, and AML requirements, or geographical remoteness. Bitcoin only requires an internet connection and a smartphone or computer, and the wallet-based infrastructure opens up participation in the global economy to literally anybody on planet Earth, regardless of their location or documentation status. Which means that even if people in other countries don't have their papers and stuff like that, doesn't mean that they have to starve. So you have the ability to send people who don't have their papers and stuff like that, or have a traditional bank account, money, even if they're working for you, helping out family. So it really just comes in clutch in a lot of areas. And it's a refuge in hyperinflationary economies. So in countries experiencing currency collapse, like for example, Venezuela, Lebanon, or Turkey, citizens often see their life savings wiped out by government mismanagement. Okay, because at the end of the day, if the government controls the fiat currency, Bitcoin is decentralized. So it's not fair that you wake up, pray every single day, grind, and slave for your family. And just because the government wants to go to war or help out too many other countries, your life savings are now pretty much obsolete. So keeping your money in Bitcoin is going to be a really strong scenario if you really care about your family's well-being and future as well too, because you can see governments consistently go into debt, lose certain funding, shut down, and a lot of things happen. And Bitcoin provides a permissionless escape, allowing individuals to store their wealth in a digitally scarce asset that cannot be devalued by local central banks, thereby preserving purchasing power. And users must take direct responsibility for their Bitcoin's custody, right? So you're pretty much like your own bank. You got to be responsible of your secret keys. Don't be being loose with your information. And while channeling, this promotes a culture of self-determination and deepens understanding of monetary policy, leading to greater personal financial literacy. Okay, so be your own boss. Take control of your own account. And you don't even have to have your cryptocurrency on a network with a password and username. You could just hold it on a cold wallet or hold on a network like Phantom, which is just held by secret keys. So pretty much no one can go in and grab your money, not even the IRS. And how you make your money is going to be baked into just purchasing the asset. The potential for profit is rooted in Bitcoin's fundamental economic design and its non-correlated nature relative to traditional assets. And the supply shock mechanism. The price is a function of fixed declining supply meeting exponentially increasing demand. When a halving event occurs, which is once again when 210,000 blocks decide to get put into the cycle and halve, the daily supply of new Bitcoin is suddenly cut in half, while global demand from institutions, ETFs, which stands for exchange traded funds, and retail remains constant or increases. This creates a severe supply shock that historically precedes major price action, and it's going to be a lot more superior than other cryptocurrencies due to the fact that it's finite. Okay, so this is a really superior supply shock compared to other things too. Okay, a lot of other cryptocurrencies are going to be infinite, so don't expect other cryptocurrencies to hold the same base or store of value that Bitcoin has. You have to remember that finite superiority baked within it. Okay, it's not the same as other cryptocurrencies. And institutional adoption and validation. The introduction of Bitcoin spot ETFs and the allocation of Bitcoin to corporate and hedge fund balance sheets provides massive new avenues for capital influx. And institutions have longer time horizons and deeper capital pools, which adds legitimacy, reduces volatility over time, and drives up the baseline demand, especially as we see more governments holding it. And the power of long-term holding, right? The long-term strategy known as hodling leverages Bitcoin's historical performance, the fact that it's an asset that helps future. And a lot of the times when it comes to cryptocurrency or stocks, inshallah of God wills, you don't even have to look at the chart. If you invest your money into something that's putting a smile on people's faces and helping the world, a lot of the times you'll end up with the positive P&L within like 1 to 5 years, a good chunk of the time. It's plenty of millionaires of people who've never even looked at the chart once. Okay, so take that into consideration when it comes to your psychology of where you're investing. So despite extreme short-term volatility, right, it's a side effect of inelastic supply, Bitcoin has delivered superior annualized returns over the past decade compared to most traditional asset classes, rewarding patience and a belief in its technological and monetary fundamentals. So keep all those strong choices in mind when it comes to why Bitcoin is going up year after year after year. There's a lot of reasons. And Bitcoin is not just a high risk investment. It's a foundational technology designed to offer a superior form of money, one characterized by digital scarcity, righteousness, and offers borderless transaction capability. So feel free to help anyone around the world, help your family, or hire people from other countries due to the fact that now that we have this currency, we can easily have peer-to-peer transactions without a centralized base controlling and holding everything. No more getting your transactions declined. No more the bank stopping your payments from coming through. And by buying and holding Bitcoin, participants are betting on the continued adoption of a sound, mathematically enforced monetary system that stands as an alternative to the inflationary pressure of a fiat currency. And its utility ranges from institutional portfolio diversification, like digital gold, to providing essential financial services to the world's most vulnerable populations. Stay prayed up to God, keep grinding. And if you guys want to learn how to invest, head over to stackmode.net. Catch you in the next one. Peace.
All right, class, we've all heard about passive investing, how we can live off our money, just making this money infinitely and forever. Let's talk about one of the most popular ways of how to invest and how to live off passive income through what's called dividend investing. Let's jump into it. So let's understand what the core is and what are dividends in the first place. So let's break down the definition and the mechanics of a dividend. So a dividend represents a distribution of a portion of a company's earnings decided upon by the board of directors to its shareholders. And it's essentially a reward for owning a piece of the business. So shareholders pretty much get rewarded for investing into whatever ETF they invested to, whether it be SCHD, BTIC, QQQI, any dividend that you invest to, which is going to be a bundle of stocks essentially. And instead of just investing into one stock individually, you could buy a ETF, which pays out dividends, and certain stocks pay out dividends as well too. And they pretty much give you your money back for investing it. They say, hey, thank you so much for investing into us. Here's some money back. Okay, so you can use that into an infinite loop and invest into that and live off of passive income. Okay, so it's essentially your reward for owning a piece of the business and the investment. So it's a source of income. So unlike capital gains, which is required when you're selling a stock or when you sell at the highs, dividends are going to be more of a direct cash flow, and they're often paid quarterly. And this creates an immediate tangible return on your investment. And they're on a fixed payment schedule. There's some dividends that pay annually, once a year, quarterly payments, which are going to be between January, April, July, and October. Okay. Some companies and ETFs pay monthly, and some pay semi-annually or annually. And the key is going to be consistency, depending on the type of income that you're looking for. Do your research before you invest in any type of dividend, ETF, or stock to see what type of cash flow you're going to be getting. Okay, you don't want to be investing in something and see one ETF or dividend pays out every month, and then you invest into something that pays out once a year, and you're not getting the cash flow you expected. All right, don't just ride somebody else's wave. Make sure you guys are doing your educated research. There's so much free information out there. Head over to Stackmode.net if you need some more investment education. So let's talk about some tax implications, right? So even though dividends can be reinvested, right? So let's say you are getting $5,000 a month from a dividend, right? That dividend money is still taxed. So even if you reinvest all $5,000 of it back into whatever stock or ETF you invested into to get the money in the first place, it's still going to be taxable. Okay, so keep that in mind. Break down your income. Make sure you guys are putting a percentage away of your dividend income away so you don't get taxed on Uncle Sam. You pay your taxes by the year. So let's talk about some declaring dividend dates, right? So the crucial dates include: one, the declaration date. The declaration date is going to be when the board announces it, and the ex-dividend date. Okay, the cutoff to buy and receive the dividend. That's what that date is. And the record date. That's the shareholder list check. And then we're going to have the payment date, which we're all looking for. Okay, the payment date is going to be when the funds hit your account, and you can go pay your bills, pay your debt, or go ball out, take your family on the trip, do what you need to do. Okay. And you must own the stock or dividend ETF before the ex-dividend date to qualify for the payment in the first place. So the power of compounding, right? Your wealth engine. All right, so look, if you're in your bag for, say, a couple of years, you're grinding hard, okay? You're waking up, you're praying, you're working out, you're grinding your business. Say you run up a couple of M's within, I'll say 5 years, 1 to 5 years, you run up around 1 to 5 M's. You could put 2 of those M's into an ETF, stock, etc., and potentially live off of that passive income forever. You'll be getting around $5,000 to $10,000 a month
There's no reason to ball out, start spending 100K a month. There's no reason to live that, that crazy. Stay down, you can still take your nice trips, and you could pay all your bills and live in a pretty nice house for $10,000 a month. And that's just that income alone. Okay, so you can leave your business income alone, leave it for your kids, leave it for your family, your husband, wife, family, grandma, whatever. Okay, and then stay down, pay your bills, make sure you put in money away for taxes though. Pay your bills, do what you need to do, pay your mortgage, rent, whatever, with that dividend income. Okay, because we're only getting older day by day. Tomorrow's not always promised, God forbid, there's going to be things like sometimes people go disabled, so we want to be making sure we can still feed our family if any situation occurs. So what we're going to do is plant these seeds now, today. Okay, so even if you go disabled, even if you die, your family can still be eating, because of the fact that you planted your seeds. Okay, so stay down. You don't got to pop it. Save, save a little bit. Sometimes it's not time to pop it. It's not time to be outside. Okay, if you work outside, eat at your job. Okay, if you can, any type of food court, try not to spend any type of external money. Okay, try and get what you can, any type of discounts, go back in the house. Okay, if you work in the house, no DoorDash, no Instacart, no none of that right now. Okay, let's try and stay down. And if you are gonna DoorDash, don't DoorDash individual meals. It's something my wife really helped me out with. Okay, I was realizing how much money I was spending on individual meals, wasting my time, wasting my money, when that could have been going into some Bitcoin, going into some dividends, etc. Okay, making that income grow. Okay, get some groceries, buy one bundle of groceries, okay, a couple times a month, and your income is going to be spread out a lot more strategically. I promise you. All right, so think about it. Reinvest your dividends as well too. Okay, so once you start stacking up some cash flow, don't get fancy in life right away. Okay, that's something that could really hold you back. Okay, once you start getting financially free, once you clear that debt that's been haunting you down, as you guys been waking up praying to God to just go away so you can increase your income. All right, once you pay off that car, okay, once you get the debt off your back, please don't immediately go get fancy with your life and put yourself right back in the hole. Okay, use the dividend income and stack up. Okay, stack up, get some reserve for yourself. Okay, and take that dividend income and replace the bills, even if that's the case. Okay, even if you guys are getting $400, $300 a month from dividend income, that's your car note now taken off. Now you have $400 extra. It's either A, put it into some business. Okay, you can go donate, do what you need to do, take care of your mom, take care of your family. That's some more grocery money, or put it into some Bitcoin options, futures, Forex, whatever you want to do. Okay, just the fact that you have that money stacked away though into something paying you out a consistent dividend, you're not going to get bills chopped off. The more bills you have chopped off, the more free cash you're going to have to play with. Okay, the more you can help your family out, do what you need to do, and just stand on business. Okay, if you want to go put some money into your business, do that. Okay, get some more income flowing, then take that income, increase your dividend income, and that way you guys can pretty much live off of doing nothing. Okay, if you have a month where you know what, say be like, I've been hustling hard, I just want to focus on myself, I just want to get closer to God, I want to work out, okay, I want to start just working on myself. Okay, you guys can do that. Okay, you could take 3 months off because you're going to be good. You planted your seeds in the dividend income. Okay, you're getting that money every single month. Okay, you could take time, get closer with your family if any situation happened. Okay, you guys are feeling like you're not as close as you need to be. You could take a break. Okay, you could pause, and rent's still going to be paid, mortgage is still going to be paid, and you're still going to be putting money in the stash because of the fact that you had that money planted in the dividends. All right, so make your decisions. Okay, you guys want to go ball at the mall? Okay, or put that money into some dividends. Okay, because I'm telling you, if the more you invest today, the more you stay down today, your future self is going to thank you. Okay, because sometimes life's. Okay, God definitely throws some curveballs. Okay, there's going to be times where, God forbid, people lose jobs. Okay, things like that, stuff happens. Okay, sometimes businesses crash, websites shut down, etc. Okay, certain TikTok bans, certain creators couldn't post then, and that was a big major source of income. So what we want to do is prepare for any type of situation so our family and ourselves are not in jeopardy if things hit the fan. Okay, so saving money and investing, it's not just trying to make money, it's survival. Okay, it's survival. Because not everyone has family they can depend on. Not everyone has people they can depend on to go to their house if something hits the fan, or if they happen to not have a place to stay. Okay, so what we want to do is always protect ourselves. All right, so money is going to be survival. Okay, don't just think of it as luxury and leisure items. Okay, protect yourself and protect your family. You don't want to have them starving. or have them getting fed by somebody else's accord because you're not hustling, because you're not staying down. So be the one who stands on business. So dividends are also going to be extremely effective during flat or declining markets. And dividends provide a consistent positive return, and they help mitigate overall portfolio losses. And they offer psychological and financial cushion to keep you invested. So you guys can honestly just stay down, invest in the dividends, stack up your cash flow. Okay, if you feel like market's at all-time highs, you could buy some dividends. Okay, you could buy some dividends, and you're still going to be stacking some type of cash flow, essentially. Okay, and the power of compounding, guys, I'm telling you. Okay, the power of compounding is going to be extremely, extremely essential. Do something every single day. Stack up those wins. Okay, and we're going to talk about drips. Right, drips are going to be extremely important, and that's pretty much just taking the dividends and reinvesting it back into the dividends. And they just automate the process of buying low, fostering consistent investments, and taking those dividends and reinvesting it back into those stocks, ETFs, whatever you bought. Okay. And the inflation hedge, right? So investing in companies that constantly raise their dividends, which means they're getting paid. Okay, if a company's raising their dividends, that means one, they're putting smiles on people's faces because one, people are using their products. So the more people that companies using their products, one, the more taxes that go to the government, the more the United States government benefits, the better. Okay, so everyone wins when these stocks go up in an upwards direction. Okay, don't just think all stocks are just going up to go up. No. Okay, a lot of these companies, Amazon, for etc. Okay, that you can go trade right now, employ hundreds of thousands of people, Microsoft, Google, etc. Okay, so these are really, really important companies that put food inside of people's stomachs. Okay, these companies pay people salaries, help them live. So think about that. Okay, that's also why we don't really want to ideally short the stock market in a lot of times. A lot of ETFs you'll see will be very, very consistent, especially if they pay out consistent dividends. Okay, they're going to consistently go up in an uptrend due to the fact that the economy is just a lot more beneficial as long as stocks are going in an upwards direction. That means more jobs for people, less homelessness, less government downfalls due to the fact that we don't have enough money to pay certain funding, things that need to be paid, such as government branches like the CDC, etc. Okay, which would mean less jobs. Okay, so the more money the government has, the better. Okay, because the less scientists we have, the worse for the world in general. Okay, we got to figure out what's going on. So understand that stocks, the higher they go up, the more it literally affects how the world functions. Okay, so thinking of things logically and extremely literally is really going to change your perspective. So evaluating your stocks, right? The essential dividend metrics. So how to determine health and sustainability beyond the yield. So before investing, you got to assess a company's ability and commitment to pay and grow its dividends. And these metrics are fundamental screening tools to avoid yield traps. All right. So dividend yield percentages, annual dividend per share / the current share price. So while it's tempting, never let your yield be your only factor. Don't just be only looking at it. Okay. You got to focus on, is it consistent? Okay. You can't just focus on how much it's paying out because it could pay you out a lot in a 3-month span. And the next thing you know, it's gone. Okay. And then your reliable source of income is not dependable anymore. Okay, so high yields are often a warning sign. So careful. Focus on the payout ratio. That's going to be a big safety check. So automating growth, right? Dividend reinvestment plans. Let's talk about drips again. So leveraging the power of zero cost reinvestment. A drip is a service offered by companies or brokerages that allow you to automatically reinvest your cash dividends back into the same stock. So you don't got to worry about nothing. Okay, money's going to go right back into the dividends, making your cash flow infinite. And it's often commission free, including fractional shares. And let's talk about fractional shares, right? Maximize. So drips ensure that every penny of your dividend is put to work immediately, maximizing compounding efficiency by buying tiny portions of shares you normally couldn't afford. And automated dollar cost averaging, right? DCA, dollar cost averaging is really going to be just a good way to stack cash, guys. Okay, put a good amount away that you have after your bills, groceries, etc. Okay, just keep stacking cash, keep dollar cost averaging, keep stacking up, get into stack mode. So since shares are bought at regular intervals, right, that's the payment date, regardless of the price, drips are automatically implemented into the dollar cost average, okay, reducing the emotional risk of time in the market. So you know how much you're going to invest, okay, just put yourself on a consistent plan, because I promise you a lot of the times within like a 5-year span, then you'll see positive returns. Okay, now buying at all-time highs though can be a little bit different, but if your goal is just dividend incomes, then just keep reinvesting. So exponential share growth. The number of shares that you own grow exponentially over time, which in turn accelerate the growth of your dividend income stream. And you literally get paid to increase your ownership stake. Okay, so think about that. So most brokerages allow drip commissions fee. Go into the settings. They can be a little hidden sometimes, but you can find it, I believe me. And they make it a highly cost-effective way to build with over time compared to manual purchases. Okay, so instead of going back, depositing over and over and over, it'll just automatically put everything on cycle. So imagine you receive $50 in dividends instead of taking the cash, right? Instead of having to have it settle, okay? Or if it goes automatically to a bank account and then deposit back into the broker, okay? Either way, the drip is just gonna go ahead and buy some more shares. And next quarter, you're gonna earn dividends on the original shares plus the new 0.5 shares, making your next payout slightly larger. And so the cycle repeats, and investing and increasing your base constantly. But please make sure you guys are looking out for your taxes, okay? Take care of that. Put some money away. Don't spend everything. So mitigate the risk, right? The downsides of dividend investing, okay? So they can be dividend cuts sometimes, okay? No investments can be without risk. And high dividend yields can be trapped sometimes. And tax implications must be understood to maximize the after-tax returns. We must be cautious investors, right? So the dividend cut is the ultimate risk. A dividend cut signals financial distress or a major strategy shift, often leading to a sharp decline in share price. Okay, that's why checking the payout ratio against the free cash flow is going to be essential, making sure it's profitable. And the yield, right? A very high yield, which is often above 8 to 10%. It's a pretty good range to check out, and it's frequently a sign that the stock price has collapsed and that the market expects a dividend cut. And when you buy the stock, the dividend is cut, and you lose money on the stock price and the income stream. Okay, and that could really hurt. Okay, so keep that in mind. So opportunity costs. By focusing on only mature dividend payers, you might miss out on certain high growth companies, like many in tech, that reinvest all their earnings back into the business, leading to higher capital appreciation and kind of income. Okay, so they're focused on like the super end game plan, okay, which is ultimately the smarter plan. And there's gonna be sometimes some new ETFs that are dividends that you can invest to, instead of just focusing on the super old ones. So do your research, okay, depending on any time period that you're watching this, okay? Some things are going to be more popular than others during certain time periods, and focus on whatever sector that's pushing the future forward is my best recommendation. So taxation, all right, understand the difference between the qualified low tax rate and the non-qualified ordinary income tax rate dividends. So use tax advantage accounts if you want to, like an IRA or 401k. Downsides of those though, they're capped out. So I believe 401k only holds around like $23,000 a year, and you could put way more money than that away, okay, in the stash, especially if you're in stack mode. And a Roth IRA, if I'm not mistaken, I believe it's $7,000, and then when you're 50, it goes up to $8,000. So that's not nearly enough money. You could put that money away in a single month. Okay, there's people who spend $50,000 a day on ads. Okay, so it really just depends. That's not enough money. Those can be traps, so don't really focus on those. Get in your bag and believe yourself. You can run up M's, I promise you, inshallah. So geographic risk. So international dividends often carry foreign withholding taxes, which can be partially or fully recovered, but add complexity and potential cost to tax filing. And they always investigate the specific tax treaties for international holdings, making sure that everything is proper before you just buy into something, okay? And you can construct your income portfolio, okay? So successful dividend portfolio is not just a collection of high yield stocks, but a balanced machine designed for stability and growth across various sectors and time horizons. So sector diversification, okay? Get some different sectors in there. If it's tech, maybe power, maybe it's healthcare, okay? Whatever is important within the time period you're watching this video, do your research first, okay? And go ahead and invest. Take your time. So spread your investments across stable sectors like utilities, consumer staples, healthcare, crypto, etc. Okay, there's gonna be a lot of different sectors you could check out. Okay, and strong industrial companies, etc. This ensures that if one sector struggles, another could be doing extremely well. Okay, or if the U.S. does a deal restructuring the power grids or something, then maybe power sectors might be doing well. Okay, things like that are going to be put into play depending on what's happening in the economy today. So apply what's happening in your current society and just go to the stock market and make the right decisions. And inshallah, you'll make some good money. So look for companies with high cash flow, low debt, consistent earnings growth, and a history of raising the dividend, not just paying it. And consistent growth is going to be your key to beating inflation. So the ETF, right, the mutual fund usage. So use dividend-focused exchange-traded funds like those tracking the dividend aristocrats. For example, Noble or high-yield funds. For example, VYM, to gain immediate diversification with minimal effort. And this can form the stable, low-maintenance core of your portfolio and your income calendar strategy. Okay. Strategically select companies with different payment months. Some pay in March, June, September, December, others in January, April, July, October. And this can smooth out your monthly income stream, giving you a more consistent passive income flow in general. So do your research, invest in the sector that's going to pay you out consistently and make you some good income. Okay. And cultivate passive wealth. So key takeaways. So dividend investment, it's not about getting rich overnight. It's about building, once again, passive income. But what people don't know about what's called passive income means you got to hustle for the income in the first place. Okay, so you got to be hustling for as much active income as possible. Then once you invest, then you earn passive income. Okay, everything in life has to be earned. Okay, you have to understand that. There's no such thing as just chilling. No, you got to earn it and then you could chill. All right, so go hustle, go get some money on, then invest and you could chill, live off your passive income. Okay, but right now, you're in stack mode, you're staying down, you're grinding, get to it. So focus on safety and growth. So prioritize dividend growth and safety. Okay. So look for a low payout ratio and low debt. Okay. Especially after you just got in the stack mode for years, however long you just took grinding your company, okay, scaling up your job, doing whatever, okay, putting money away. You don't want to invest into a dividend that you expect to pay you out stably to just crash. Okay, so do your research, make sure they don't have a lot of debt. Okay, even God talks about debt for a reason. Okay, debt can really be a sinkhole. Okay, if you get into debt, it's like your money pretty much gets negated for no reason. You make money, but then it has to go to debt. So it's like you get nothing in your pockets, you can't put it into investments, and you're just in debt. Okay, so debt is extremely trash and it pretty much cancels out your money. Okay, so focus and see, okay, did the company pay it off yet? Okay, is the company drowning? Is it a fresh new company that just took a big loan from someone? Okay, and if they fail, then they're going to be drowning. Okay, that might not want to be something where you want to invest your hard-earned active income into. Okay, so take your time, do your research, and then hop into something. Okay, avoid Euro traps. Don't just focus on that. Okay, sometimes there's things way bigger than the direct active income. Focus on the stability. And you can use drips and monthly contributions to take advantage of compounding and other cost averaging automatically. Okay, pay your rent, groceries, do what you need to do, give your money to whoever you need to give. Okay, and then put some money away into your dividend investments. Okay, keep stacking cash and watch it grow quickly. And utilize tax advantage accounts if you want. If you have a job, then do a 401k. I don't recommend a Roth IRA. Just do a normal tax account. Okay, once again, believe in yourself. You can do way more than $8,000 a year. Okay, putting away that money is something that everyone could do. And $8,000 a year, you can definitely put way more than that a year away. So do a normal account, individual, taxable, and just take care of your taxes. It's not that bad. Okay, and your growth isn't going to be stopped. But if you have a job though, and they pay out 401ks, I would take advantage of that. Just put a piece of your check away, and then if you want, as soon as you're older, you have that money there, and then you can pull it out tax-free if you even want it. So you can maintain diversification like this too. Okay, you can invest into certain ETFs that have a bundle of stocks, so you don't have to just rely on single stocks. Okay, and you could use, once again, dividend ETFs to build a robust, diversified foundation. Okay, so that's how passive income is going to be formed. Stay prayed for God, keep running. Head over to Stackmode.net for all trading education. Mentorship stocks, they're getting filled up. Class has been getting booked up. So yeah, if you want to book the next call, go ahead and book before all the slots are filled up. Peace.
So if you don't know, what controls the price of your rent, your groceries, the gas prices, as well as the crypto and stock market is going to be something called the Consumer Price Index, also known as the CPI. CPI is basically a giant shopping list that the government tracks every single month. They track food, housing, transportation, medical care, all the essentials. And when the total price of that basket goes up, inflation goes up. When it goes down, then inflation eases. And it sounds simple, but here's the catch. Even a small change can shift interest rates dramatically, which can impact your investments and even move the entire economy. Let's go and let's jump into what CPI is and how we can understand what the report is. Inshallah. So let's understand the Consumer Price Index, also known as the CPI. It's going to be extremely simple, and I want to break it down, and I want you guys to understand. Let's go. So what is the CPI in the first place? So the CPI, think of it as a basket of goods. So imagine a giant shopping cart that represents what the average American buys. This is going to go ahead and represent gas prices, groceries prices, food prices, the price of the current rent, housing, etc. Okay, all of this is going to be compiled into a big list, and the government tracks everything. And depending on how much this stuff costs, is going to give us a certain result based on the CPI report. So the Bureau of Labor Statistics, also known as the BLS, tracks the price of this specific basket every single month to measure inflation. Okay, so they measure housing, food and beverages, car prices, okay, and things related to cars as well too. Cars themselves, gas prices, and even ticket prices for planes and stuff, etc. Okay, and as well as the medical care prices, prices of certain pills, prices of certain procedures, etc. All of that gets tracked by the Bureau of Labor Statistics and gets put into a big report, and that lets us know how well the economy is doing. Okay, so let's continue on, and breaking it down and understanding this is really going to help us know, okay, is the market in a desperate period right now? Are people saving right now? Are people selling their houses right now? Okay, and you really got to ask yourself a couple of questions and put things into perspective. Okay, so let's continue on and let's understand what the CPI is. So let's talk about measuring the inflation. Okay, measuring inflation. So the year over year review, YOY. Okay, when you hear inflation is 5%, it means that the basket of goods cost 5% more today than it did 12 months ago. So that means that the price of a hot dog, let's say in 2015, let's say the price of a hot dog was $2. If in 2025, the price of the hot dog is now $6, okay, inflation occurred. The price went up. The price of the hot dog got more expensive year after year after year. So within a 10-year span, hot dogs went from $2 to $6. So that means that it got $4 more expensive just because time occurred. So that's what inflation is, when stuff is getting more expensive over time. And the reason why that's occurring is because more dollars are getting printed. The more dollars that get printed, then the more prices have to equate for that. Prices are going to equate with how many dollars are available. If there's a lot more dollars getting printed year after year after year after year, then logically things have to result and coincide with that and get more expensive. So why investors even care in the first place? So if inflation is 5% and your portfolio grew 4%, then you actually lost purchasing power. Okay. And the core versus the headline. So stripping the noise. So there's going to be two main types of CPI numbers that are going to go ahead and be released. So there's going to be the headline CPI. The headline CPI is everything in the basket. Once again, we're calculating the food, rent, gas prices, okay, price of certain waters, whether that be for water in our houses, for shower, toilets, etc., or the price of bottled water, okay, price of ice cream. All of that is going to be calculated inside of the basket. And the actual raw number is going to let us know how much Americans are spending on consumerism. That's why it's called the CPI, Consumer Price Index, letting us know how much the economy has consumed. And the core CPI, okay, it removes the food and energy prices from the equation. So the core CPI removes food and energy prices because food and gas prices are going to be volatile. They change every single week, okay? And they change a lot quicker than other things as well too. Okay, food can be thrown on sale one day. A box of macaroni could be $5. Okay, you come back to the store next week, it's back again at $15. Same thing with gas. You could go to one gas station, they might be charging you $3 a gallon for some 87, and then at another gas station for some 87, it might cost you 2.79. Okay, so it's really going to go ahead and differentiate, and food and energy are going to be a lot more volatile than other things related into the basket. So the Fed prefers just the core CPI, and the core CPI is the number calculated in the basket of the stuff that Americans are consuming, okay? And other countries have CPI too, but in this case, we'll just talk about US, but it takes the amount of resources that a country is consuming, and the core CPI report is just going to go ahead and remove food and gas prices since they're volatile and could hedge the numbers and make them spike up higher than they maybe should be. So the federal connection. So we'll talk about the policy tool. The Federal Reserve has a mandate to keep inflation at around 2%. 2% is going to be a pretty stable rate, and that's letting us know that the economy is not going in haywire. So a high CPI, the Fed will raise interest rates to cool the economy down, which is going to be really bad for stocks and bonds. If people are paying more money and percentage yields on interest, then that's going to go ahead and leave them less money to invest. Or what people would go ahead and do is take out their investments in order to make up for certain interest rates getting more expensive, etc. And we'll talk about a low CPI rate. So when the economy is in a good position, it's very stable, and it's in a cool position, the Fed may lower the interest rates to stimulate the growth because people are going to be paying back less in loans, paying back less in debt, etc., leaving a lot more supplemental income to invest into stocks. So when the CPI report is low, a lot of the times you start seeing market burst up in an upwards direction because it's letting us know that everyone else has money, and the stock market and crypto market, we move as whales and sheeps. Everyone has to be doing the same thing in order for the market to move. Everyone has to be buying at once in order for it to go up, and everyone has to be selling in order for it to go down. So that's why it's really imperative to make sure you're trading with the trend. If you're not trading with the trend, you're just going to be losing money for no reason. And that's why Wall Street really holds its breath on CPI release date. It's really a big report that predicts what the Fed will do next and a big predictor on how the market will move. A lot of the times right after the CPI report drops, especially if you're a futures or Forex trader, you can get on your 1 minute and you could see the actual candle of CPI. So seeing that and watching those month after month after month of CPIs really taught me and let me know how the market decides to trend after CPI report hits the market. And market volatility, so the tantrum that it throws. So algorithms read the CPI report in milliseconds, and the market reaction can be extremely violent. In a second, CPI could make the market zip down or burst in an upwards direction. And once again, if you're on your futures 1 minute, you can see it and see the news directly. And CPI coming in hot is going to mean that stocks have a higher chance to drop in a downwards direction due to the fact that interest rates are going to be higher. So interest is going to be bad. There's a reason why God talks about it in a negative manner. Interest does not benefit anything. Interest only hurts. It hurts the people, hurts the stock market, and it just leaves us less money in order for actually building our actual assets, whether be it for real estate, building your stock portfolio, etc. And if the CPI report comes in cool and lower, a lot of the time stock has a good chance to rally in an upwards direction. Same thing with the indexes known as the NQ, which is going to represent for the NASDAQ 100. You're going to have the ES, which is going to represent the S&P 500. You're going to have the Dow Jones, which is going to represent the YM, also known as US 30. Okay, so each one of these things are going to be affected by the CPI. So CPI is an extremely, extremely, extremely important report. And what you might see actually a lot of the times is price action slowing down, getting a little choppy, getting a little slow before the CPI report comes out. Because people are holding their tongues, they're freezing their wallet. They're like, hold on, before I deploy this bread, let me make sure market's doing what it actually needs to be doing. and then boom, they're going to go ahead and put that money down. So watch the trend. One bad month is not a crisis, but a trend is. Watch how the trend shifts after CPI. Does market want to head in an upwards direction? Does market want to go in a negative direction? Okay, and for how long? Make sure you're trading with the trend. Trading with the trend is going to be the separation tool between being profitable and unprofitable. Okay, you have to make the decision that the market is making. Otherwise, you will lose money. If market's going in an upwards direction, that is the direction that you should be playing in. And it's not at all-time highs, then that's how you should be playing. Okay. If you're on a Forex trade for something like that, for example, and the CPI report comes out and a currency pair starts going downwards, okay, then that's going to go ahead and let you know the trend. I don't care if you're on stocks, Forex, futures, wherever. Be wary of the CPI report, especially before you put in the trade. Okay. Keeping an eye on news. And a lot of the times you'll notice too, news is going to be baked into the price action too. So try not to fight the Fed. If CPI is high and rates stay high, try to adjust your portfolio. Okay. Stay prayed up to God. Keep grinding. If you want to learn more about investing, head over to stackmode.net. I'm here for you guys for any type of situation, whether you guys are struggling with unprofitability, whether you're profitable right now, but you just want to be a little more consistent. You want to see how you can funnel more of your income. Just come book a free call. I'm here for you guys. I'm going to catch you guys in the next one. Peace.
Class, let's go and let's talk about fundamental analysis, what it is, and how you guys can use your outside of chart skills to make profitable trades. So you can see, is the company going to be futurely effective? Is it something that's going to advance society, put some smile on people's faces? And these are all going to be questions that we're going to need to ask before we even look at the chart as well too. Okay, so let's jump into it. Let's see if the company makes some money. Let's determine the fundamentals before we put down some size. Let's go. So what is fundamental analysis? FA, the core definition and the goal. Fundamental analysis is a methodology used to evaluate a security's intrinsic value by examining regulated economic, industry, and financial factors. And the core idea is to determine if a company's stock is truly worth its current price, whether we're looking at the real business behind the ticker symbol. And the goal is simple. Find stocks that are trading for less than the calculated intrinsic value. And this is the margin of safety. So we assess everything that could affect the company's value, from the strength of its balance sheet to the quality of its management team. Everything that's going to be extremely important to take a look at, okay? Because this is all going to be affecting future growth, okay? You want to be investing in a stock that's going to be making money, okay? Because if it's making money and it's profitable, then inshallah it's going to be in a much better position to go in an upwards direction than a company that's not making money, okay? Because then they're going to take their shareholder profit, put it back into the company, and they're going to be paying out higher dividends, which are going to be payments that stocks give if they're making good money to their shareholders. Okay, so if the dividends are increasing, not getting cut, then that means that the company's also going to be making money. So a lot of good things we can look at too to see if a company's profitable or not. Now let's talk about fundamental analysis versus technical analysis. So the difference in focus between the two. Technical analysis focuses on price and volume movements on the candlestick chart, still extremely important to know. And it studies charts and patterns to predict future price direction, and it assumes all fundamentals are already priced into the stock. In fundamental analysis, it focuses on value, and it studies the financial health and futures earning power of the business. It assumes the market can be wrong in the short term, creating opportunities. Let's talk about the two main pillars. So 1, quantitative factors. The numbers, revenue, profit, assets, debt, and key financial ratios derived from financial statements can all be used to see if a company's making some money or not. And this is going to be the bedrock of our analysis. And some qualitative factors, the intangibles, management competence, industry standing, brand loyalty, patents, and competitive advantages, right? The economic moat are all going to be things we can take a look at as well too to determine if a company is going to be worth investing into or not. So the top-down approach, right? Let's talk about the EIC analysis. So before diving into a single company, let's understand the environment that it's operating in the first place. Let's take a look at the economy, then the industry, then finally the company EIC. So let's talk about the E, economic analysis, right? The macro. So understanding the national and global economic landscape is going to be crucial as it dictates the environment for all businesses. And a rising tide lifts all boats, but a recession sinks many. Now let's talk about GDP. GDP stands for gross domestic product, and it measures the total output of goods and services. And a high GDP growth generally suggests strong corporate earnings, okay? Which means that it's exporting and putting out a large amount of goods, which means people are buying, okay? So interest rates, they're set by central bank, and their higher rates set could increase the cost of borrowing for companies, affecting debt costs, and consumers, affecting the spending power of the company, okay? So if the interest rates are higher for borrowers, that means that more of the company's money has to go into paying off debt versus growing the company, okay? Which could lead to slower stock progression. Keep that in mind. Inflation. Inflation is the rate at which prices rise. High inflation can squeeze profit margins if a company cannot pass on increased costs to its customers. And the unemployment rate, a key indicator of consumer health. Low unemployment usually means that companies are hiring more and more and more and more, and they have enough money to even hire new people. Let's talk about some industry analysis, right? MISO. Some industries offer better long-term prospects than others. You want to invest in companies that are favorable, growing, or defensible sectors. And you want to look at the industry life cycle. Is the industry in the growth stage? Does it have high potential? Okay. Or is it in the mature stage? Is it already super duper stable and a competitive competitor? And adjust your expectations accordingly. Take a look at its competitive structure. How intense is the rivalry? Does it have low competition? Because low competition allows for higher profit margins. And high competition, like airlines, for example, often means thinner margins because there's so many companies that do the same exact thing. And bargaining power. Do suppliers or customers have high bargaining power? High customer power, for example, a few big retailers can force prices down, harming the company. So for example, the tech industry is currently in a growth phase, okay? While the tobacco industry is in a decline, thank God. Okay, people are starting to get healthy, change their ways, and the crypto industry, for example, is also on an uprise as of when I'm dropping this video. So depending on the time era, invest based on that. That's also going to be taking a look at your fundamental analysis, looking at what time period you're in and making your decisions based off of that. So the company analysis. This is going to be the final deep dive stage where we look directly at the individual's business health, operations, and future prospects. This is going to lead us directly to the financial statements. And let's talk about the competitive moat. What makes this company hard to replicate? Is it a powerful brand, network effects, or patents? And this creates pricing power. And let's take a look at the financial health. And we must verify their ability to generate profit and cash, manage debt, and efficiently use shareholding capital. This is the heart of quantitative analysis. And operational efficiency. Are they managing their inventory and accounts receivable effectively? High efficiency often translates to higher profitability. So the three pillars. Let's decode financial statements. So these three documents, released quarterly and annually, are going to be the company's report card, okay? Remember back in school when you guys were scared of showing your mom your report card, for example, okay? Companies can sometimes be nervous to show earnings, especially if they're not putting out good profit. So that's why you might see a company put out bad earnings, but it might follow up with a video or display of what the company holds for the future to save the shareholders and to make the current people holding the stock, even if it dumps down, invested so they can trust the future. So let's talk about the income statement, right? So what does it show? It shows profitability over a period of time. For example, 1 quarter or 1 year. And it details revenue, cost, and ultimately the net income, okay, which is going to be the profit. And the revenue, right? The total sales from goods or services. And the growth here is going to be critical, okay? You want your companies that you're investing into to be making money. So the gross profit, the revenue minus cost of goods and sold. And this shows how profitable the core product is. And operating income, it's profit after deducting operating expenses like salaries, rent, R&D, and this indicates core business performance. And the net income, right? The bottom line. What's left for shareholders after all expenses, interest, and taxes? And the balance sheet. So what does it show? A snapshot of a company's assets, liabilities, and shareholder equity at a single point in time, and it must always balance. All right, let's talk about the accounting equation, right? So assets equal liabilities plus equity. So assets, it's what the company owns. It's its cash, inventory, property, plant, and equipment. And liabilities, right? It's what the company owes. It's accounts payable, short and long-term debt, and watch for companies with high debt. And equity, this residual claim shareholders have on assets after liabilities are paid. And the cash flow statement, CFS. So what does it show in the first place? The true movements of cash, tracking how much cash the company generated and where it was spent in the first place, separating into three main activities. Okay, so we're gonna have the OCF, and the OCF stands for the operating cash flow. And this is cash generated from normal business activities. Okay, this is the most important business section. Then we're gonna have the ICF. The ICF is cash used to buy or sell long-term assets, like equipment or real estate. Then we're gonna have the SCF. Okay, this is financing cash flow. Cash from issuing debt, paying dividends, or buying back stock. And the key takeaway, a company can show a profit income statement, but have a negative cash flow if customers haven't paid yet. So understand that cash flow is gonna be king in this scenario. So the power of ratios, quantitative deep dive, right? I'm gonna give you guys a deep dive here of the power of ratios. So ratios normalize the data, allowing you to compare companies of different sizes or evaluate a company's performance over time. They distill the financial statements into actionable insights. And the profitability and efficiency. These ratios measure how effectively a company is converting sales into profit and managing its resources. And the net profit margin, NPM. It tells you what percentage of every dollar of revenue ends up as net income. And a high and stable NPM suggests strong cost control and pricing power in general. And the ROE, the return on equity, ROE. It shows how much profit a company generates for every dollar of shareholder equity. And the higher ROE, which is typically above 15%, suggests management is using shareholder money very, very effectively. Let's talk about the ROE. Return on assets. It measures how effectively a company uses its assets to generate a profit. And it's crucial for asset-heavy industries like manufacturing. All right. And liquidity and solvency, right? The risk. So these ratios assess the company's financial health, specifically its ability to meet short-term and long-term debt obligations. And the current ratio. It measures a company's ability to cover short-term liabilities, which is due within 1 year, with the short-term assets like cash and receivables. And a ratio above 1 is generally preferred, indicating ample liquidity. Let's talk about the debt to equity ratio. It compares a company's total liabilities to its shareholder equity. And a high ratio indicates that the company relies more on debt financing than shareholder funding, leading to higher financial risk. And the interest coverage ratio. It determines how easily a company can pay interest expenses on its outstanding debt. And the high number suggests minimal risk of default on interest payments. All right, the context checked. So remember that a good ratio is highly dependent on the industry. And a utility company, for instance, can safely carry a higher debt to equity ratio than a high growth technology startup. Because one, the cash flows are more predictable, and always compare ratios with the same sector. So valuation metrics, finding the intrinsic value. Valuation is going to be final, and it's a crucial step in determining what the company is actually worth to you. If the market price is below this value, then that means it's a potential buy. And the price to earning ratio, PE. So this is arguably the most common valuation metric, and it tells you how much investors are willing to pay for $1 of a company's current or expected earnings. And the high PE, a high price to earnings ratio, often suggests investors expect high future earnings growth. All right, so that means it's a growth stock. And think of tech companies, for example. And a low price to earnings ratio can suggest the stock is undervalued, or that investors expect slow or negative growth. All right, and it's a value stock. And the caveat, comparing to price to earnings across industries is meaningless. Compared to the historical price to earnings for the same company and to its direct competitors. Let's jump to DCF, right? Let's talk about discounted cash flow. And this is considerably the gold standard of evaluation. And conceptually, it attempts to estimate the value of a business today based on cash flow, okay? And it's expected to generate the future. And it focuses on its future cash. The model requires forecasting the company's free cash flow for many years into the future. So the discount, future money is worth less than money today. And the model uses the discount rate, which reflects the risk and cost of the capital, to bring those future cash flows back to a present day value. And inherent subjectivity. The final value is highly sensitive to the inputs, like future growth rate and the discount rate, making it more of an art than a science. And the margin of safety. A key concept popularized by value investors like Benjamin Graham and Warren Buffett, it's the difference between the intrinsic value and the market price. And protection from error. We buy when the market price is significantly lower than our calculated intrinsic value. And this margin protects us if our valuation assumptions were slightly too optimistic. In an undervalued asset, if we value a company at $100 per share and it's trading at $60 per share, the $40 different is the margin of our safety and the remainder of our profit. And the concept encourages a disciplined, conservative approach to investing, avoiding speculative purchases of overvalued assets. So the intangibles, right? Qualitative analysis and synthesis. So numbers don't tell the entire story. The best fundamental analysis blends hard numbers with an assessment of the company's non-financial and leadership. And management and leadership. Okay, the people running the show are crucial. Even a great business can be ruined by poor management. And the integrity and vision of the business is extremely important to take a look at. Does the management team communicate honesty with its consumers? And do they have a clear, credible long-term strategy for their business in general? And as far as capital allocation, how have they used the company's cash? Are they wasting it on poor acquisitions, or are they intelligently investing in R&D, buying back stock when cheap, or paying dividends? And his track record, look at his past performance. Have they met guidance? Have they successfully navigated previous economic downturns? Okay, and have they survived? All factors we have to keep it in mind whenever we're going to be investing. So the competitive moat. So this term is often used by Warren Buffett, for example, and it refers to what a company uses to protect them from being eroded by competitors. So one, their strength. Are they iconic? Okay, certain irreversible brands are here to stay. So for example, a certain beverage company, certain tech companies allow for premium pricing and customer loyalty. And network effects. As more people use the product becomes exponentially more valuable to existing users. For example, social media platforms. And switching costs. How difficult is it for a customer to switch to a competitor? And high switching costs, for example, business software systems lock in revenue. Okay. So, synthesis, forming the investment thesis. Fundamental analysis isn't about finding the best ratio. It's about building a compelling investment thesis. And this thesis is the unified argument that's based on your EIC review, the quantitative data, and the qualitative assessment. The company is undervalued and the market will eventually recognize its intrinsic worth are all going to be things you can put into play before making it your trade. And check some things out on the chart too, just to make sure it all lines up. Okay. Always look beyond the price of the intrinsic value of the business. Focus on free cash flow. Okay. It's the honest measure of a company's health, and invest with a margin of safety. Okay. Don't pay $100 for something that you value at $80. Okay. And if you value something at $300 and it's at $80, then inshallah you can make your decision. And management and the competitive moat are just as important as the numbers. Okay. Does the brand have its own stable concept? Okay. Is it super competitive in the industry that it's in? Is it a leader? Okay. Is it an innovator? All questions you got to ask before you put money into something. Okay. I love you guys so much. Stay prayed to God. Keep grinding. And if you want to learn how to invest, head over to Stackmode Network. Catch you in the next one. Peace. So if you lost all your money, you're at zero. It's happened to pretty much almost every single trader before. Okay. And I don't want it to happen to you again. Okay. It's going to be important to lower your ego, humble yourself. And this is why it's really important to get with God. Okay. It's really going to help us build consistency, waking up, praying every single day. Okay. Let's wake up. Let's work out every day. Okay. And let's transmute this pain and let's work harder, whether at work and or your business. Okay. So you should either be having one job and working on your business, or you could have two jobs. Okay. And then on the weekends, work on your business. Okay. Do what you need to do to grind. Run it back up. Don't stop. Keep pushing. No matter in any situation, you have to keep pushing. You can't stop. You can't let things get to you. You can't let things break you down within your mental. Okay. If you say you want this, if you say you want to be a profitable trader, if you say you want to put your family in a better position, we got to lock in. We can't be getting broken down. We got to bounce back, inshallah, if God wills. Okay. So here's going to be the full guide to financial and psychological recovery. We got to keep pushing forward underneath any circumstance. We can't stop. We can't let our emotions break us down. That's all just the devil. Okay. The devil doesn't want you to progress, but God wants you to progress. Alhamdulillah. Okay. So turn to God. Okay. Wake up every day. Pray. Get yourself right. Lower your ego. This is why you're blowing up your account. Why can't you just accept the fact that you're losing? Okay. If you lost a trade, get off the charts. Why are you trading over and over and over and over and over again? There's no point to that.
It's time to transmute all of that pain, okay? Put it into more work, put it into your business, set your alerts at your key levels, and go work on your work and your business, okay? Why are you sitting there trading over and over again? Why are you sitting there taking 10 trades in a day, blowing up your account? How do you expect to progress? Okay, take one trade, risk management, and have some long-term investments, okay? Invest in shares, okay? Cryptocurrency, some long-term investments so you don't have to sit there trying to day trade every single day. The reason why you guys are also blowing up your account so quickly is because you're trying to day trade. All the money you've been losing trying to day trade, one, you could have put it into mentorship. Stackmode.net, the first call is even free, okay? So I give you guys a free first call. And on top of that, there's just no reason to be blowing up your account in the first place, okay? Because all that money you've spent trying to day trade, trying to make profit, you could have been putting in long-term investments, and your profit would most likely still be positive today, and you'd still have a large majority of it. And so you'd be up and you still have your money, okay? So focus on long-term trading too, okay? It's not just all about day trading, 0 DTE, futures, etc. Don't let that prop firm mindset destroy you. All right, let's go. So the immediate aftermath, the psychological toll, losing a significant amount of money in trading is more than just a financial event. It's a deep psychological blow, and you may experience a range of emotions, including shock, denial, regret, shame, and even a profound sense of failure. And it's crucial to understand that these feelings are normal and a part of the grieving process for your financial loss. Acknowledging this emotional state is the first critical step towards healing and recovery. So acknowledging the pain. Do not suppress your feelings. Allow yourself to process the loss without judgment. And this is a necessary emotional release that has to happen. And combat cognitive bias. Your mind might trick you into a get it back quick, okay? Get it back quick, okay? So pretty much if you lost some money, let's say you lost $200, okay? You might think, okay, I'm gonna go ahead and risk even more money so this way I can go ahead and get my $200 back and I can go ahead and end up profitable on the day. No, man, you lost. If you lost, you lost. You get off for the day. You plot out anything cleaner setup. You come back with even more logistical analysis and more of a good reason to put on a good trade. And until then, you're gonna wait. I don't care if it takes days, weeks, or months, okay? You wait for a good setup. Don't just come on here and burn your money trying to fiend for money, okay? Wait days, weeks, and months. It takes a long time to get profitable, okay? But it can happen now if you just plant yourself in the right positions, okay? Invest in things that have future value. Invest in things that put smiles on people's faces, okay? Some stocks just go up in a straight line year after year after year after year after year. You just have to do your research, okay? So don't get tricked within the get it back quick mindset, especially day traders. Day traders, you got to control your emotions. You got to think more long term. Even if you make some profit off a day trade, think about how you're going to reinvest that back into a long-term play. And recognize that this is a cognitive bias, specifically the recency bias and loss aversion. And this resists the urge to jump back in. So conduct a brutally honest financial audit. So before you can rebuild, you must understand the full extent of the damage. This is not about self-blame, but about creating a clear picture of your current financial reality. And these detailed audit will be your map for the road ahead. So identify the full loss. Tally up every dollar lost. And this includes not only the principal, but also any fees, interest borrowed on funds, or opportunity cost. And categorize your remaining assets. List every single asset you still have, from checking account balance to the value of a car or your home, okay? Be meticulous. And document your debts. Don't run from your debt, okay? Don't run from your debt. You know you gotta pay it off, okay? Certain things that you might have piling off. I pray that you guys don't have any debt, but if you do, let's tackle that. Let's pay it off. Let's stay down. Let's get in stack mode. Okay, stay down, stack mode. Okay, get in stack mode for the rest of your life. Okay, only spending 50% of our income, keeping the other 50% in the stash. This way, after we pay taxes, we're still gonna have money left over in the stash, inshallah. So document your debts. Create a comprehensive list of all your liabilities. Credit card debt, personal loans, mortgages, etc. And after a $50,000 loss, for example, a trader might discover they only have $500 in their checking account and $2,000 in their savings account. They also find they have a $10K credit card debt occurred trying to recover the loss. Okay, so while they were just trying to make up for the money lost in cash, they were just spending money on their credit card debt. Okay, something that's happened to me, and I don't want you guys to go through that. It can be extremely daunting, extremely frustrating, and scary when you start seeing your debt pile up like that. So be financially responsible before you start trading, and don't trade with any money that you can't lose. So their audit reveals a negative net worth, but it also provides a clear starting point for a new financial plan. So focus exclusively on earning and saving, stack mode, okay?
Stack mode's about being a God-fearing, righteous individual, okay? And it's about staying down, okay? Saving up your money, because we got people that's protecting and provide for. We can't be spending all of our money on stupid stuff. We gotta be investing smart, growing our money, and making sure our money is always making us more money. Money is gonna be a tool, okay? Don't use money just to consume. Use money as a tool in order to generate some more money. This way you can work, okay, less, okay? So as you get older, you're not gonna be able to work the same, but you still gotta be generating some money. Inshallah, still gonna be people that need help. Still might be family that need you. Still might be people to take care of. So your money needs to always be making you money. So use it as a tool and set up your investments. So for now, all trading activity must cease, okay? If you go broke, if you lose all of your money, trading is stop, okay? Pause it. Your number one priority is to rebuild your financial foundation with stable, reliable income. And this is a period of accumulation, not speculation. So work on increasing your income. So every avenue that you can explore, whether it's working harder at your business, okay, trying to get monetized on certain things, okay, creating certain programs, lots of things you could do to generate wealth. Especially with AI, it's extremely simple to just choose a niche and jump straight into it and just work hard, okay? So this can mean working more hours, okay, freelancing, certain businesses. Just do what you need to do to generate some more income. So create a strict budget. So develop no frills budget that prioritizes essential living expenses. So stack mode, right? So when you're in stack mode, you got to really be staying down. When you get older, you can't work 16, 18 hours a day. Okay, you're going to be too old, but you got to be using money as a tool still. You still got to be investing. You still have to be generating income. Okay, so this is why investing is going to be so important, inshallah. So while you're healthy, okay, invest your money so then when you get older and you can't work as long hours, you're still going to be able to survive. You're not going to be down bad. Okay, I don't want you guys to be broke, okay, with no options and just nothing to really just say that you did on this earth, okay? So please save your money and get in stack mode. It's important. So every dollar should go towards building an emergency fund and paying down high interest debt, and eliminate high interest debt. So use strategies like the debt snowball or debt avalanche to aggressively pay down credit cards and personal loans. And this is a guaranteed return on investment. So a deep dive into education and risk management. So once your foundation is stable, okay, you started clearing your debt, you got your money back on track, it's time to re-educate yourself. Your previous approach failed, so a complete overhaul is necessary, okay? Lower your ego, and you have to completely change everything. Restart your mindset, restart how you think about everything, restart how you approach the charts in life, okay? Completely overhaul your mindset. Quit things that you used to do, okay? Start doing some new things, okay? And this step is about replacing reckless habits with a structured, disciplined methodology. Okay, so here's a market study. So dive into the market history, economic cycles, and different trading philosophies. You can go ahead and read books. I have so many videos too, okay? And you can go ahead and check out how to balance your account, okay? Do your research, okay? I also have an ebook as well too, free course, many free videos. Please just do your research before you hop onto the charts, trying to throw some money at it or trying to make some money, okay? Because you might just end up losing some money. And that's really gonna hurt. So do your research first, please. Master your risk management. This is a non-negotiable. Learn to calculate your position sizing, set your stop losses. That's an area where the price is gonna go ahead and close out your trade automatically if it hits that certain area, okay, causing you to only lose a certain amount of money. And never risk more than 1 to 2%, especially when you're a new trader. But as you get better, you can go ahead and bump that up to 1 to 10% of your account. And a well-defined plan is gonna be your roadmap for everything. It must include your entry and exit criteria, your risk-to-reward ratios, and a detailed list of rules that you're never going to break. So instead of day trading with leverage, for example, a recovered trader decides to focus on a long-term swing trading strategy in a single sector they've studied for months. Their new rule is to never risk more than 1% of their account on a trade, ensuring that a string of losses won't wipe them out again. Okay, you're coming onto the market to make some money. Why are you coming into the market and going back to zero? It's not making sense. So you need to be focusing on the trades that are going to keep your account alive, and not the account or not the trades that's just going to make your account money. Okay, money is not always everything. Focus on what's going to keep your account alive. Focus on the safety, okay, and that inshallah will transpire to profitability. So conquer your emotional demons. Okay, trading is going to be 80% of psychology. I've seen it firsthand. You can give someone the best levels and they don't close that take profit because they think it might go further. Okay, so psychology is going to be extremely important, and your perspective. So your biggest opponent is not the market, but it's going to be your own emotions. Okay, and a lot of times it's going to be the devil trying to attack you. So just pray to God, you know, out of Allah, and just, understand that it's just evil trying to decept you. Okay, anything that you guys might want to do to tempt you to do anything bad, it's all just evil. Okay, don't do it, because when you're crying afterward, when you're sad afterward, that just means that the devil got you. Okay, so don't be weak, be strong. Okay, and keep your head on. So you must learn to separate your personal feelings from your trading decisions too. Okay, so even if you take a big loss, even if you just went down to zero, don't treat people bad. Okay, don't treat people bad around you. Don't talk to anyone bad. Don't get emotional. Okay, I know there's some times when you take a loss, you can't even speak to anybody. Okay, I've had those days. I've definitely had those days, but you can't let the trading loss affect your real life. Okay, you have a whole life that God has blessed you with. Okay, there's still grass outside, you know, still fresh air, etc. Okay, so even if you lose all of your money to trading, don't get depressed, don't spiral, and just manage your expectations. And understand that trading is going to involve periods of drawdown. Okay, and especially when you're first starting, if you go down to zero, it's okay. Okay, many people fail with their businesses, have gone down to zero, failed businesses, and I wish you guys just know how much trial and error it takes to actually be successful. Okay, this is why God is important, so you don't go insane. Okay, it takes an extreme amount of trial and error. Okay, so winning every single trade, that's an illusion. Okay, in hindsight, kind of not really. You are gonna lose sometimes, but it depends what you're trading. You can win like 99% of your trades though. I can say that confidently. So focus on long-term probabilities of your edge, not the outcome of a single trade. So start a trading journal. Okay, document your trades on YouTube, Notion, Discord, whatever. Okay, coming out with the app, Stackmode app, where you guys can also track your profits and trades too. Okay, so document every single trade, your profit, your loss, your entry, your thought process, how you felt, and the outcome of it. This is going to help you identify recurring mistakes and any emotional triggers. And practice unwavering discipline. Stick to your plan no matter what, and do not chase trades, do not get greedy, and do not panic. Discipline is the bridge between your goals and your execution. So start with paper trading too. Okay, you can paper trade on TradingView. A lot of brokers too allow it. And don't jump back into the market with large sums of money. Wait. Okay, play with small percentages of your work check, your business check, whatever. Okay, pay your bills first, get some groceries, and then whatever you have left over, start investing with. Okay, let that grow over time. And by this whole time, while you're playing with small amounts of money, you're gaining info. Okay, so say your business, something like that blows up, when it's time for you to get into the big bucks, when it is time for you to throw it into the market, you're going to be well informed and you're going to be all good. Okay, so alhamdulillah. Okay, so it's a lot better being in this position versus being somebody who has a lot of money trying to come into the market with no education and then losing it. Okay, because that can hurt. And even if that has happened, it's fine. You can run it up again, inshallah. So start with the tiny account, scale it up. If you can't grow a small account to a big account, you can't grow a big account to a bigger account. That's just the truth. So increase your position size when your account grows through profitability. Okay, be disciplined and don't just keep adding more capital in your pocket whenever you're making bad decisions. Okay, you have to grow your account. Okay, let it grow through discipline. So losing money can be the most valuable lesson you'll ever learn. It's definitely taught me a whole bunch, got me closer to God, made me realize how unstable I was in certain emotional aspects. I realized I was just extremely greedy. Okay, there'd be times I just wouldn't be satisfied with my profit. Okay, and that was leading me to spiral over and over and over and over again. Okay, leading me to take more trades than I need to, trying to chase more dollars, instead of just realizing if I would have just stayed disciplined, been consistent, then I would have gotten to the position of where I wanted to at the same pace anyways. So instead of trying to make $2,000 in one day, if you make $500 4 days separately, that's still the same amount. Okay, so just focus on the long-term vision. Okay, get rich slow, focus on the discipline, and confront your weaknesses. Okay, and rebuild your strength and your wisdom. Okay, God tells us to be reborn, and the journey back is not just about financial recovery, but it's all about personal transformation. And you're no longer the same trader who took on too much risk. You are a new, more disciplined, and more resilient individual. Okay, rebuild yourself back up and become a boss. Every boss has taken a major loss, and it's about bouncing back. Do you have that hustle in you? Okay, it's really gonna determine if you're built for this. Okay, if you have that hustle in you, you'll run it back up. All right, God got you. Don't give up. You got people to provide for. I love you so much. Head over to Stackmode Network for all trading and business education. Catch you in the next one. Peace.
Most beginners lose money trading futures, not because the market is hard, but because they start wrong. Today, I'm going to show you the right way and the simple steps to your first profitable futures trade. By the end of the video, you'll know exactly how to pick the right contract and how to avoid the traps that wipe out new traders, and the exact setup professionals use to stack consistent wins. No fluff, no complicated math, just a clean, actionable beginner framework that actually works in live markets, prop firms, and even if you've never traded futures in your life, inshallah, if God wills, you'll know how to trade it by the end of this course. Let's jump into it. Okay, so this is going to be how to trade futures and catch dips and certain lows. Okay, so we're just going to go ahead and jump straight into it. So what you want to do is start off doing top-down analysis. Okay, top-down analysis is when you're going to be starting from your highest time frame and scaling down to your smaller time frames. So what we're going to go ahead and start off with is our weekly time frame. Okay, our weekly time frame are going to be our eyes. Okay, you're going to be able to see absolutely everything you need to see on the screen. You got to start on a higher time frame. Especially on futures, you cannot sit there and tunnel vision on things like the 5-minute and the 1-minute and not understand the true directional bias. Okay, we're also going to talk about some logical things and some logistics of why it's better to play certain directions within the US market. Okay, and futures is going to be a US market. Okay, we're going to talk into everything, and this is going to be the full futures guide. Okay, so we're going to go ahead and have the weekly here, right? Weekly time frame is going to be our eyeballs. Okay, we're going to be able to see everything we need to see on the higher time frame basis. That's going to be pretty relevant. Then from there, you want to go ahead and head down to your daily time frame. Okay, you're going to go down to your daily time frame. It's going to show you a little bit more candles than you would see from your weekly. Okay, and each one of the candlesticks that you're going to see is going to determine the amount of price action that's happening within a certain time frame. So if you're on the weekly time frame, each one of the candlesticks that you see will represent 1 week. If you're on the daily, each one of the candlesticks will represent 1 daily. Okay, so that's how things fluctuate and change. Okay, so it's just about knowing when to use certain time frames and how to use the flow. Okay, and once again, the flow is going to be going from your highest time frame to your lowest time frame. Okay, highest time frame to your lowest time frame. So we're going to go from the weekly to the daily to the 4-hour time frame. Okay, the 4-hour time frame is going to be extremely important, and we're going to talk about why. So if I get on the 4-hour time frame, we're going to see here in the bottom right of trading view, okay, you're going to see the words ETH. Okay, so look in the bottom right here, you'll see the words ETH. ETH is going to stand for extended trading hours. Okay, it's going to stand for extended trading hours, and what that is going to show you more candles that would be hidden than if you didn't see. So market is open normally from 9:30 a.m. Eastern time, okay, to around 4 p.m. okay, Eastern time. Okay, that's going to be like the basic stock market time. But with extended trading hours and with futures, market is also open on Sunday. It opens at Sunday at 6 p.m. and is open until I believe Friday at around 6 p.m. as well too, Eastern time. Okay, so extended trading hour is going to show you the Sunday hours, which you need to see. Okay, if I turn off extended trading hours, okay, the chart is going to look a little different, and you're going to see little areas like this, okay, where you're going to see gaps in between certain spaces. But if I turn on electronic trading hours and I go back to the same place, I'm going to see price have a filled in area there. Okay, so that's why extending trading hours is extremely useful to use, and why you can't just live completely on your higher time frames. Okay, all your time frames are going to be useful. Okay, you got to use all your time frames. Got to. Okay, all your time frames are going to be important to use. They're all going to help you out, and it's about knowing when to use what, once again. Okay, so that's going to go ahead and be that. So you're going to go from your weekly to your daily to your 4-hour to your 15-minute. Okay, weekly, daily, 4-hour, 15-minute. Okay, that's how your futures flow needs to go. Do not just tunnel vision on the smaller time frames. Yes, the futures income is nice. Yes, you can scalp and make some money, but it's not just about that. It's going to be about the discipline. It's going to be about catching your nice big trades, okay? You don't want to be just trading for pennies, okay? Especially on futures. This is why on futures, I recommend be on the live account, okay? Because when you're on the live account on futures, things are a lot different, okay? You can hold your trades overnight, okay? When you're on prop firm, you cannot hold your trades overnight, which hurts your profit significantly, okay? The extended trading hours time is going to be when a lot of price action decides to occur. So when you get a good entry and you see which way price is flowing in, you can make some nice money and turn a small account to a lot, okay? Fairly fast with futures. Now it's going to be a lot of power in your hand, okay? When it talks about futures, it pretty much just means make or break, okay? You can make or break all your profit, okay? So let's talk about some certain things when it comes to futures before we get into the chart. Let's talk about margin. So margin is going to be an important thing when it comes to the futures market. Margin is going to be the amount of money required in order to open a contract. So in order to outplay this, right, thank God we have the new micro futures accounts. So micro futures accounts cost less than normal futures contracts. So let's say you're trading the NASDAQ 100, also known as the NQ, okay, which mirrors the QQQ, okay, stock or ETF. So index. So NQ, right? Let's say it costs $1,000 to open up one contract of NQ, okay? On most brokers, it'll cost you like at least $1,000 to open one contract of NQ. Thank God, though, we have something called the micros, which helps us trade more efficiently, and this way we can trim and get more value for what our account size is. So now we have micros. So now you could play something called MNQ, okay? And instead of spending $1,000 on a contract, you can then spend $100 on a contract, okay? And you could flip that fairly simply, okay? Let's say you're on YM, okay, which mirrors the US 30, okay? It might cost you $500 to open one contract, okay? And if you're trading MYM, for example, it will go ahead and cost you just $50 to open one contract, okay? And you could still make some great money. And instead of buying one contract of YM, you could buy multiple contracts of MYM and be in a much better position, okay? So you could think about that. So the micro contracts are going to be new contracts. I believe they came out like 2021, something like that. Fairly new, thank God. And now we have the ability to trade with less money. So even if you do have a big account, you could trade a bunch of micros and trim and trade how you want and hold your trade as long as you want. And as well, when you trade the micros, they're going to have lower overnight margin, okay? So OVM, overnight margin, okay? So it might cost $50 to open a micro contract during the day, but if you want to hold it past 5 p.m. Eastern time, then the margin might go up to like $400 a contract, okay? So you got to make sure you're having the overnight margin and the day margin if you want to hold overnight, okay? So pay attention to that, and every broker is going to have its own different amounts, okay? It's a lot of important things to know before we just jump into trading futures, because you can get what's called margin called, where if your account goes underneath the amount that required, let's say MYM, okay? Let's say it requires at least $50 in your account. If your account goes underneath $50, let's say it goes to $48, it'll go ahead and just wipe all of that and put it straight at zero, okay? And if your price action goes against you too fast, you might even owe the broker money sometimes, okay? So you want to make sure that your dollar amount is a pretty good amount over the amount of margin. So if it requires $400 to hold overnight, then try and have at least like $800, $700 or something like that, okay? This way, you're going to have some wiggle room and things like that. So the things outside of futures are going to be really important too. And how long you hold the trade is also going to go ahead and be limited. So how long you hold the trade is going to be based on the certain month too. Okay, you can't sit there and hold futures forever because they do expire and have certain expiration months, which the broker will tell you a lot of the times. So now let's go ahead, and which is why you'll see on your broker sometimes they might ask you to roll over your contract. Okay, so once again, starting on our higher time frames is going to be our bread and butter. Okay, it's where we're going to succeed at. We want to see the higher time frame trend. Okay, let's talk about some logical things too as well before we jump into the chart fully. Okay, I want you guys to pay attention to this. This is going to be MYM, right? Look at how this chart trends. Okay, year after year, even with certain dips, we're trending in an upwards positive direction. Okay, we're trending once again in an upwards positive direction year after year after year after year after year after year. So personally, I don't think it's smart to trade futures to the downtrend. Okay, the Forex community has spread over to US traders, and now US traders think that they should be shorting a market that goes up year after year after year after year. There's also certain laws in place called the short sale restriction, okay, SSR. And the short sale restriction prevents stocks from just flash crashing to 0%. Because don't forget, definitely remember this, but don't forget, futures are just indexes. They're just a bunch of stocks put into one big giant conglomerate, and then you can trade it like that. Okay, that's all it is. So if stocks crash, futures will crash. Okay, that's just how it is. So you want the stocks to be up and afloat. And same thing for the US government. It's beneficial for the world, okay, the global economy, okay? The more money the US has, the more we can look better and help other countries out, etc. Okay? So, if the stock market goes within a positive upwards direction, right? If futures goes in an upwards direction, okay, that's going to incline more companies to be able to hire more employees, okay? And the more employees that are hired, the more taxes that are going to be paid. The more taxes that are being paid is going to equal a richer White House. A richer White House is going to give the country more credibility, recognition, and ability to do more things. Okay? So, there's logical reasons why we want the stock market to go in an upwards direction. Okay, logical reasons why you don't want the market to crash down. So don't fear crashes whenever you're trading. But in futures, I recommend to buy lows. Okay, there's going to be two things we're going to be looking for in futures. We want price to already, and we're going to talk about support or resistance. So support is going to be an area where price is bouncing in an upwards direction. Okay, so if you're on your higher time frame and you see price made a certain low going in an upwards direction, okay, that's going to indicate an area of support. Okay, it's going to indicate an area of support. Then the opposite of that is whenever you see price falling in a downwards direction. Okay, whenever you see price falling in a downwards direction, then that's going to be called an area of resistance, indicating that sellers are coming into place. So resistance is going to be when price is falling in a downwards direction. And then we're going to have support when price is bouncing in an upwards direction. Okay. And that's just going to go ahead and be the difference between the two. So putting this into perspective, we have to go ahead and realize, like, okay, support and resistance correlate with each other. Market can only go in two directions. Okay. But I can see on my weekly time frame, year after year after year after year after year, market's going in an upwards direction. Okay, so my US futures traders, please do not have that Forex mindset. Okay, I want you guys to look at the Forex chart real quick. A lot more sideways. This is why Forex traders short. Okay, there's a reason why they short. Okay, because you can get off with things like this a lot easier, a lot cleaner, and a lot better. Okay, this market is not meant to go in an uptrend. Okay, as we can see, futures goes in a consistent uptrend. Okay, due to the fact that it's going to help the US in a lot more cases. Okay, so we have to keep that in mind. That's why price is going in upwards direction. So let's talk about once again how we can go ahead and trade. We want to be buying two things. Okay, you want to be buying when price makes an area of support. Okay, because all your setups are going to look the same. Your setup should always look like a V. Okay, so market will always make the left side of the V, and we'll talk about this in a second. And then you're going to catch the remainder of the right side of the V, because price always wants to try and break all-time highs. So as we can see on the futures market here, we're always constantly making new all-time highs pretty much. Okay, and that's due to the fact that, once again, it's most beneficial for the world, the economy, and the global infrastructure of everything. Okay, so price is always going to be hunting towards all-time highs. which means price is always going to be hunting to go in an upwards direction. So even if price is in a downtrend, I personally don't like to short. I like to just wait for price to make a low, and then I'll go ahead and I'll take my trade. Okay, so let's talk about how you know when price is ready to make a sweep up. Okay, there's going to be two things we're going to be looking for. So you want price to be, once again, just bouncing at an area of resistance going in an upwards direction. Okay, and then you want to close at an area of resistance or support above current price. That's because price has an ability to reject at an area of resistance multiple times. Okay, and one day it might break, but you don't want to eat the reversal. Okay, you want to catch your formation and structure completion. Think of trading as a puzzle piece. Everything should click and form together. So resistance areas can short within a downwards direction twice. Okay, and then we're also going to go ahead and have an area here where resistance gets broken, turns into support, and then price goes in an upwards direction. Resistance here getting broken, turn into support. Okay, this is going to be another example of the V formation too. Okay, and in this instance here, you would have bought at this area of support here. Okay, and catch it up, because you know price wants to mirror or at least reach the area of resistance. You don't know if it wants to break out immediately. Okay, but price at least wants to go ahead and reach it, and that's what matters. Okay, catching your resistance gap fills. So let's go and let's keep talking about it here. So I like to go ahead and start on my weekly here because it lets me know, like, okay, am I at all-time highs or not? Okay, because if I'm at all-time highs, then I know I'm going to be needing price to dip down, make a certain low, and then I'll be able to go ahead and catch my sweep in an upwards direction. Okay, so let's go and let's go to daily here. Okay, now I'd like to go ahead and wait for certain formations. Okay, so take an area like this on the daily. Okay, I see price made an area of support down here twice. Okay, and even if I wanted to go ahead and just take it up to like this area of resistance, you know, that would have been solid. And as you can see, just based off this tiny support here, went ahead and caught the whole gap fill, and this would have been around 669 points within a couple of days. And on futures, that's disgusting money. Okay, that money is nasty. So what I'm looking for, especially on my, so I like to see my weekly here, make sure I'm not at super all-time highs, because I'm looking to long the market. Okay, and I'm waiting for price to make a little base on the daily. Okay, so I need price to make a little base. So right now I can see price making the left side of the V. Right now we're heading straight down. Okay, we're heading straight down, and then I need price to form a low, and then I'll be able to catch the right side of the V and catch it back up. Okay, so that's what we're going to be looking for. But in order to do this, we got to be patient. So right now I wouldn't short, okay, because people are going to be fiending to buy any low opportunity. So I'm going to wait for price to go ahead and create its low. Okay, I'm going to show you a good example of what that looks like. I'm going to go to my 4-hour again. Okay, when you start seeing price make that nice curl, especially with 4-hour closes, then that's when you know you're going to go ahead and catch your nice trade. Okay, take this little sweep curl up right here, right? Even if I decided to close the trade at this area of resistance up here, that's still a really nasty futures trade. Okay, this is 862 points. Okay, just catching the V. Okay, catching it to this area of resistance up here. Okay, and as you can see, price decided to go ahead and fill the V. Okay, and you're just going to go ahead and be able to farm money on the micros, farm money on whatever. Okay, let me go ahead and just log into the paper trade here and just show you how much this would have made, for example. Okay. Go ahead and close that. So boom, even right here, right? So let's say you opened a trade right here. Okay. And I like to play with like 100 tick stop loss. Let's say I'm trading YM. Okay. 100 tick stop loss, right? I'm risking $50, and my take profit would be this resistance all the way up here. Okay, 473 ticks. So I'm risking $50 to make 236. And as you can see, price decided to continue forward. So as soon as price starts to make that nice V, So I'm looking for multiple 4-hour candles, and then I'm waiting for price to sweep in a upwards direction. Okay, I'm waiting for price to sweep in an upwards direction. So I can see price making an upwards V, even if I entered right here on this candle, okay? Because I want price to go ahead and make the formation of the bottom for me. Okay, I don't know where price is going to bounce at. Okay, it's too many people try to predict the ultimate bottoms. Okay, but you know that price at least wants to try and mirror areas of resistance. Okay, before it gets broken. So take advantage of the V. So even if you entered right here, right, you'd be able to enter right here. Okay, 100 tick stop loss. As you can see, stop loss just didn't get hit. And then we decided to go ahead and take profit all the way up here at this resistance of here, 484. Okay, and then you can go ahead and catch nasty trades over and over and over again, waiting for your V formation. Okay, so what I'm going to be waiting for is for price to make a certain low. I'm waiting for price to nosedive down. After price makes a low, okay, let's say maybe about this much on like the 4-hour at least, okay, then I'll be able to catch the remainder up until the previous resistance or support that it stopped at. Okay, and then I'm going to go ahead and close there. I'm not going to play for the breakout. Okay, I'm just going to go ahead and catch the V fill. All your trades should look like a V for the most part. Okay, so right here, I'm waiting for price to go in a downwards direction. Okay, I'm waiting for multiple 4-hour candles. I don't like to just go off of one 4-hour candle. I can't just see price make this one wick area here near this area of support and be like, oh yeah, this is going to be the best trade ever. Nah, I want to actually wait. This is where the 15 minutes is going to come in too. So I can see on this area here, I have a previous area of support over here, and then I have an area of support over here too. Okay, price going in an upwards direction, starting to curl. Okay, but I'm going to wait for more 4-hour candles. Okay, maybe even some more daily candles to form too. Okay, and then I'm going to go my 4-hour here or 15-minute. Let me find myself a good take profit. Okay, so take profit here, even if I want to close at like this resistance area up here. Okay, so let's say I get like one more 4-hour candle or something like that. Okay, I might be able to go ahead and take this V formation up until at least this area up here. Okay, and then I'm going to go ahead and put a 100 tick stop loss. Okay, and then I can see if this area actually wants to go ahead and fill and catch it up to this area of resistance either here, or I could try and catch it up to the, yeah, I mean, honestly, I wouldn't be greedy. Try not to be greedy when it comes to futures. Just take your nice trades and just wait for redips and just do it again. Okay, because the greediness can really get you nipped in the butt. So I would really just take like your 15-minute take profits like this, catch your nice sweep, catch your nice V, close at this area of resistance up here. Boom, close out the area of resistance right there. Get on my 5-minute here, you're going to see the resistance here. You know, price might want to mirror that. And then you can go ahead and close your trade up there. Okay, very simple, very easy. And just go ahead and take your money. Okay, so even if price is in a downtrend, okay, price still has to go up to come down. And price has a better chance of going in an upwards direction than it is just falling in a straight downward direction. Okay, especially when it comes to futures. Okay, use your higher time frame, look at your bias, and put everything into perspective. Does it make sense to short something that continuously goes up in an upward direction year after year after year after year, regardless of inflation or anything? And the answer logically would just go ahead and be no in every single scenario. Okay, so when you're reading your futures chart, it's really just about taking your time, getting in your bag, and really just making sure you understand and can read what you're looking at. Okay, it's about taking your time. And when you take your trades, you got to take your profit. Okay, you got to be closing at these areas of resistance or support above current price. You got to. Okay, I wouldn't hold past up here. Okay, we also have this take profit up here too as well. Okay, if you wanted to take something like to up here. Okay, and this would be for like a 1-to-1, and then price decides to continue to go up in an upwards direction. Over and over. This area of support could be a take profit as well too. Okay, and then that's the cool thing about futures. As each take profit gets hit, you can go ahead and keep dragging your stop loss if you want, or you can go ahead and set your final take profit at a certain area, have your stop loss, and just buy at certain logical areas and just pray that you win, okay? Because price most likely wants to reach these areas of resistance again, okay? Even if price wants to fall straight down from these, that's fine. At least it went ahead and touched it. That's okay. Okay, it's not just going up for no reason. It might want to go ahead and touch this, okay? And that whole window of it going up is just money sitting there waiting to be farmed. So collect your income, okay? Whole sit there, whole bit of money just sitting there waiting to be collected, okay? So sit there and collect your money, okay? Even at this area of support right here, because as we know, just like resistance can be broken, turn into support, support can be broken, turn into resistance, okay? So that's why a take profit right here would be reasonable as well too. So if price goes up, okay, let's say it does this, breaks this, okay, price might want to fall down here, okay, or price might want to fall here, okay? So that's why these are all going to be different take profits due to the fact that these are areas of resistances and supports above current price. And I can see price is trying to recover here. Okay, so you can see it on your smaller time frame. Price really trying to recover certain areas. And it's about making sure you know when to close. Knowing when to close is going to be the most imperative and important thing. The trend already started. Okay, the chances of the trend just reversing here super duper hard, it could be pretty low. Okay, so it at least go ahead and touch this resistance. If it breaks this, then try the support. If it breaks this, then try the resistance. And it'll keep trying each leg until it finds a place it might want to reverse that, find a super low, then break that previous high and do it over and over and over and over and over again every single year. Okay, so it's about playing logically. So if you're a futures trader, if you're going to trade some futures and you want to make some quick income, okay, because futures, you only got to deposit one time. Okay, it's about waiting for the right setups too. But after you deposit that one time, you can go ahead and you can get in your bag. Okay, you can run up your bag super duper duper hard. Okay, and it really just depends. Okay, so do some practice. Stackmode.net for all trading mentorship. If you guys have any questions, stay prayed to God and keep grinding. That's how you guys are gonna be able to trade futures.
Bitcoin mining is the network's backbone, and it's not just about earning crypto, it's how Bitcoin's created in the first place. Miners use powerful computers to solve the puzzles. They secure the blockchain with an immutable new block each time. And this process is the global security system that prevents double spending and fraud. And it verifies all transactions across thousands of independent computers, replacing a central authority. Without miners, Bitcoin wouldn't exist, and it would collapse. But with them, it's become one of the most secure financial systems on Earth, powering the trust and transparency of decentralized money. Let's go and let's talk about how Bitcoins are created and why the government owns it. Inshallah, if God wills. Let's go. So, class, welcome. Let's go and let's talk about how Bitcoin is created in the first place. So Bitcoin is generated by mining it. Okay, Bitcoins don't just spawn out of thin air. And as you know, Bitcoin is also a limited cryptocurrency. So other cryptocurrencies for the most part are going to be infinite, but Bitcoin is actually going to have a limited amount of currency. Okay, there's only 21 million Bitcoins that exist. Okay, and each one of them is created by getting mined. So what happens is a computer, okay, and the computer is obviously powered by resources. Okay, so certain countries take more power than others to create certain Bitcoins. Okay, so if you're in a country that charges a lot for power, then you'd be paying more on your electricity bill in order to mine the cryptocurrency. Okay, and what you would need is a super powerful computer with a graphics card that can handle the Bitcoin mining. Okay, so what a graphics card is, it's a piece of the computer that's external. Not all computers have external graphics cards. Some have inbuilt graphics cards, which is why they're slower than others. But what you need is a really powerful computer. And then from there, you'll be able to load up the Bitcoin mining software and it can go ahead and get created. We're going to talk into the technicals, exactly how everything works. Bitcoin mining is super duper cool. You might even want to do it and see if this is a good way that you guys might want to generate some income, depending on what country you're in as well too. You'll be able to save a lot of money on power, and you could potentially mine yourself or create yourself a Bitcoin for way less than buying it. So let's jump into it, class. So what is mining even in the first place? Mining is not digging dirt. Bitcoin miners aren't digging into the ground with actual pickaxes, digging into the dirt, looking for resources. No. Okay, so what it is computers mining Bitcoin via a software. Okay, and the job is to secure the network and process transactions. Okay, so It secures the network by making everything decentralized. So in a traditional bank system, let's say you wanted to send a wire transfer, for example, right? The bank would be able to decide whether yes or no if the transaction wanted to go ahead and get approved or declined. Within a decentralized network, such as sending Bitcoin, things like that don't occur. Since everything is done by smart contracts, okay, everything is autonomous and automatic, done by computers, okay? And that's what Bitcoin mining comes into place too. Even creating Bitcoin, instead of just clicking print on the dollar like they do with fiat currency, Bitcoin actually has to go through a whole process in order for a Satoshi to be created in the first place. Okay. So Bitcoin mining helps keep Bitcoin decentralized. The reason why the US dollar fails is because they just go up to the printer and click print. Okay. There's no real strategical process that goes from start to finish for the most part that keeps its base value cooked in. Yes, you can just print more dollars, but that would inflate the other ones. Since there's a finite amount of cryptocurrency, there has to be a secure process in place in order for it to be created, for it to be fair for everybody. And mining is the way it's done. Let's keep going. So think of the blockchain network as a public notebook. So you might have heard of what the blockchain network is. So the blockchain network is pretty much a public copy of everything that's been done. Every transaction that's been created, every Bitcoin that's been mined, and every transaction that's happened, okay? So the blockchain is pretty much going to be a verifiable place to where you can see if your transactions were even completed as well, okay? So within the blockchain, you'll be able to put in your, let's say, address. Let's say you did a transaction. You could copy that transaction address, put it onto the blockchain or some type of blockchain checker, and you could see if there were any confirmations. Okay, confirmations are pretty much going to go ahead and let you know when your transaction is ready to be completed. Okay, either the money has been sent over and it's about to hit somebody's wallet, okay, or it's on the way to hit your wallet, okay, depending on the situation. So the blockchain is a public notebook that everyone has a copy of, and mining is the process of adding a new page, okay, which is a new block to this notebook. So page 1, right? Let's say Alice sent some money to Bob. Okay, let's say they sent 5 Bitcoin. You're going to be able to see that. Okay, you'll be able to see the Bitcoin addresses, etc. And you'll be able to see when the transaction was sent, how much Bitcoin or how much cryptocurrency was sent. And you'll be able to see the miners working on certain things as well too. Okay, you'll be able to see when Bitcoin transactions have been implemented and grounded into the blockchain. Whether a big whale is buying or selling, the blockchain shows us everything. Okay, keeping cryptocurrency really, really safe. So proof of work. So once again, Bitcoin, it's not created like the dollar. You don't just go up to the printer and click on print over and over and over again. It's created by POWs, also known as proof of work. So to add a page to the notebook, computers must solve a super hard math puzzle that requires a pretty powerful computer as well too. So make sure you guys have a good graphics card inside of your computer before you think of doing anything like that. Okay, so to add a page to the notebook, you got to have a super powerful computer, and then the computer has to do calculations and try to guess the number. Okay, so imagine guessing a number between 1 and 1 trillion. Okay, you have to guess randomly. So computers then make trillions of guesses per second to find the random number, okay, which is going to be the hash. Okay, so that's how the proof of work works. And that's pretty much all the work that the computer is doing. The computer is constantly running calculations, trying to find and guess the correct numbers in order to generate a Bitcoin. Okay, and that takes a lot of power, a lot of resources. So make sure you guys are watching your energy bill before you think about getting into this. So this is exactly what I mean. You need a powerful computer. Okay, your computer has to be good. It can't be a weak computer. Okay, so understand that you cannot mine Bitcoin from your laptop. Okay, you cannot mine Bitcoin on a laptop anymore. Okay, so these with, you know what I'm saying, with the screen, little keyboard, not cutting it if you want to mine Bitcoin. Okay, get yourself a real strong desktop with a real graphics card before mining Bitcoin even crosses into your brain. Okay, so you need specialized machines called ASICs. An ASIC stands for an application specific integrated circuit, and they do one thing: guess numbers for Bitcoin. Okay, they're loud, hot, and they use a lot of electricity. Okay, so before you guys think about just putting it into your room, keep all of this into play. Okay, keep all of this into play. Save for Airbnb owners as well too. If you guys have Airbnbs, what people are doing is signing up for Airbnbs and mining Bitcoin at Airbnbs in order to save money on power bills and stuff like that. Or people are also even moving to other countries in order to save on power bills too, so they can mine Bitcoin for a lot cheaper. So keep all of these things into play and understand that the future is really changing a lot. People are starting to get a lot more equipped and doing a lot more strategical moves to mine all the Bitcoin as possible before it goes away. So what's the point of this? Like, why do it in the first place? So the reward, right? The winner who solves the puzzle first gets paid in brand new Bitcoin, okay? A brand new Bitcoin. So Bitcoin is created by whoever has the best computer, right? And is solving the most problems, okay? The more computers you have solving more problems, okay, the more Bitcoin that you're going to accumulate in the first place, okay? So it's going to be either one computer or a whole room full of computers, okay? And what they're doing math, okay? 2 plus 2 equals, okay? And then whichever one of the computers can find the hidden number, okay, goes ahead and generates the Bitcoin, okay? After you find the random number, or one of the computers generates it and finds the right calculations, then a hash is going to go ahead and get created, okay? Then from there, you're going to go ahead and get paid within your Bitcoin. And you keep doing that, keep doing that. Now, the computers do have a high chance, once again, to consume a lot of power, which means that the resources inside of the computer, processor, graphics card, RAM, etc., have a high chance to go out and combust. So before you think about doing this, make sure you guys have some money to the side to pay your bills, maintain everything. So I don't want you guys going broke to do this. But this is how Bitcoin is created by computers solving complex math, looking for a specific number. And once again, the more you have, the more Bitcoin you'll be able to generate. Since the more computers you have, inshallah, if God wills, the quicker you'll be able to look for hash codes, and the quicker those computers will be able to solve different types of calculations. So what's the point of this? Why is it essential for security in the first place? So it's costly to cheat, right? So to fake a transaction, you need more computer power than all other miners combined, making it pretty much obsolete, not even worth it, and not even, once again, not even worth the while. So immutable. So once a block is buried under other blocks, it's mathematically impossible to change it, because the way that Bitcoin works is that the computer is hunting for hidden numbers, okay? It's hunting for random numbers and it's trying to guess the correct numbers. So the chances of it being faked or created within a false context would pretty much be almost impossible, okay? Since there's so many numbers and it's looking to guess the correct one. And it's decentralized. So no single boss controls the ledger. So no people can just be like, you know what, we're going to decline this transaction. We're going to approve this transaction. Oh, you want to send $10,000 to somebody in another country? You know what, we're going to go ahead and decline this and shut down your bank. Okay, that's happened to people. Okay, and that's not fair. It's not fair. There might be money you might need to send to somebody in another country to help send your family some money, to help pay your employees or whatever. Cryptocurrency is such a beautiful blessing on this earth. God is the greatest, you know? It's being able to send $1 million to somebody the next day, boom, just like that, snap of a finger, and nothing is even remotely concerning, okay? It's beautiful. We want to be focusing on buying as much cryptocurrency as possible, guys. Focus on it, okay? Focus on it. So no single boss controls the ledger, guys. It's decentralized. We're all in this together as a family, and thousands of miners protect it together. Okay, the cryptocurrency community is really a family. They just want people to send money and collect their money freely, without any restraints, without any cringe blockages or anything like that, without any 3 a.m. shutdowns. They just want people to send their money borderless all around the world and spend their money all around the world. God is the greatest. You know, to be able to live in this type of time period where we can have this type of decentralization, it's really a blessing. Okay, take advantage of this time period, guys, and let's keep learning about cryptocurrency. So let's talk about the wall of energy. What is this? Okay, so it's a feature, not a bug. So people complain about energy use, but that energy is a wall protecting the money. So you have to understand that the printers, okay, if they just keep printing the dollars, inflation is going to continue to increase. Okay, which is why the US government, for example, is running to cryptocurrency to kind of save its tail. So energy equals real world cost. Okay, you can't really fake that. When that mean power bill gets sent over to you, you got to pay that. It just is what it is. Okay, it's kind of hard to dodge that because it costs real actual money, electricity to mine, and the actual account too. You can't just be like a fake person. You got to actually go sign up for the power account, put your card on there, etc. So because it costs real money, electricity to mine, you're incentivized to play by the rules, keeping it safe and free though for everybody. Okay, free for everybody to jump in, I'll say. Okay, because some things are going to be gate kept through certain other things, but as far as just the freedom to start, anybody can start. Okay, you might just need the ASICs computer, pay for the energy, but as far as just the freedom to start, anybody can start. So if you cheat, you waste electricity and you lose money. Okay, so it's pretty much not going to be worth it at all, because the point of this is to gain some Bitcoin. So inshallah, you can maybe see some profit. So keep everything stable and keep everything well-rounded. Make sure you have everything planned before you just start trying to do anything. Okay, so let's talk about the life cycle, right? So a broadcast. So if you send one Bitcoin to a friend, the network is going to hear it. Okay, the blockchain is going to see it. You could see if the transactions were completed via what's called confirmations. Okay, so compete. Miners then race to solve the math puzzle, the hash, to box up transactions. Okay, and then verify. The winner shows their proof and everyone checks it instantly. And this keeps it secure. Okay, this page is glued to the notebook forever, also called the blockchain, and then the miner decides to go ahead and get paid. So that is the full 1, 2, 3, 4 cycle of how Bitcoin mining actually occurs. Okay, so the computers are looking to solve the hash puzzle. Okay, after the computer solves the hash puzzle, then the miner will go ahead and get paid in Bitcoin, inshallah, if God wills. So keep it simple. All right, y'all. Happy Bitcoin mining. I pray you guys do well. If you want to go set up a rig or set up your own basement, do it. Okay, be ready to pay that electricity bill, but I believe in you guys. If you're interested in Bitcoin mining, head over to stackmode.net for all trading education, and I'll teach you guys and we can talk about absolutely whatever. Stay prayed up to God, keep grinding, and I'll catch you in the next one. Peace.
So what's the difference between major, minor, and exotic Forex pairs? Let's go on and jump into it, class. So an introduction to the Forex market. So the foreign exchange, also known as the Forex market, is the largest financial market in the world, with the daily trading volume exceeding 7.5 trillion as of 2022. So this is a pretty recent study. It operates 24 hours a day, 5 days a week across major financial centers like London, New York, Tokyo, and Sydney. And it's a decentralized market where currencies are traded over the counter. And it involves speculation on currency, and speculation is going to pretty much mean to where traders can get paid based off of directional bias on currency value fluctuations driven by economic, political, and geopolitical events. And participants include banks, corporations, governments, hedge funds, and retail traders, which are just single individuals. So let's go on and jump into the classifications of the currency pairs, their characteristics, and how they impact the trading strategies. Let's go. So what are currency pairs? In Forex trading, currencies are always traded in pairs because you're essentially buying one currency while selling another. The first currency is the base. So let's say, for example, USD, okay? And the second one is the quote currency. So the first one here is going to go ahead and be the base. So USD before the slash is going to be the base currency. And the second one, okay, is going to be the quote currency. So let's say Euro. Okay, so let's say you were trading USD Euro. The first term, USD, is going to be your base. And then the second one is going to be your quote. So an example, for example, here in Euro USD, then Euro will be the base and USD would be the quote. And if the pair is at 1.10, it means 1 euro buys 1.10 US dollars. And currency pairs reflect the relative value and are influenced by interest rates, inflation, and economic data releases like GDP and employment reports. And understanding pairs is crucial for risk management and profit potential in trading. So for example, if you believe that the euro will strengthen against the US dollar, you go long on Euro USD. Conversely, if you think it'll weaken, then you'll go short, okay? And long means price is gonna go in an upwards direction that you speculate, and going short means that you think price is gonna go in a downwards direction. So some categories of the currency pairs. Forex pairs are categorized into 3 main types, okay? Based on liquidity, trading volume, and the economics involved. Majors, minors, and exotics. So majors, they're mostly traded and involve the USD and major economies. And minors could cross pairs without USD and still for major economies. And exotics involve emerging or smaller economies. And these categories help traders choose pairs based on their risk tolerance and strategy. So, major pairs, here's the definition. Major currency pairs are the most liquid and widely traded in the forex market. They always include the US dollar paired with another currency from a major global economy. And the majors account for about 85% of the daily forex volume. And the US dollar dominance due to the US economy size and the dollar's role as the world's reserve currency. And high trading volume leads to tighter spreads, okay, which means you're going to be hit with less fees whenever you do close or sell off your trades, and better execution, which means you're going to go ahead and get filled. So when you click buy, you're going to go ahead and be entered in the trade, or sell, you're going to go ahead and be exited out the trade. And major pairs are traded heavily during the overlapping sessions like London session or New York session. And New York session is from like 9:30 a.m. to 4 p.m. Eastern time, okay? And in between that, London session overlaps. So London session ends at 11 a.m. But due to the fact that New York session opens at 9:30 a.m., there's going to be time where New York session and London session are going to go ahead and overlap. And major pairs are going to be ideal for beginners due to their predictability and abundant market analysis available with so much data. And we know this is a left to right chart. That's just how it works. So examples of major pairs. Here are the 7 most common major pairs. Euro USD. So Euro/US dollar is the most traded pair globally, has the most volume, has the most money running through it, and has the most people trading it. So USD JPY stands for US dollar and Japanese yen, and is known for carry trades. GBP/USD, that stands for British pound. So GBP stands for British pound. Okay. /US dollar is volatile due to UK politics. So the United Kingdom politics really affect the pair GBP/USD. And USD/CHF, okay, US dollar/Swiss franc, it's a safe haven pair. And Australian dollar/US dollar, okay, it's commodity driven. And USD/CAD, US dollar/Canadian dollar, it's oil influenced. Okay. And New Zealand dollar/US dollar, it's very agricultural focused. A detailed example, so Euro USD, it's influenced by ECB and Fed policies. And for instance, if the Fed raises rates, USD strengthens, pushing Euro USD downwards. So some characteristics of major pairs. Majors exhibit specific traits that make them attractive. Okay, so high liquidity, major pairs is really going to be a spot where trades are going to be able to take place quickly. So if you click buy, you click sell. Since there's so much liquidity, aka people trading or money being flowed into it, when you click these buttons, you should be filled pretty quickly. Okay, so high liquidity, they're easy to enter and exit positions without price slippage. Okay, and more stable. Okay, but can spike on news like non-farm payrolls. And tight spreads, often around 0.5 to 2 pips, reducing the trading cost. And there's going to be abundant information on major pairs, extensive coverage, a lot of government information, economic information, etc., affecting the price. And there's going to be extensive coverage from sources like Bloomberg and Reuters, for example, and different correlations. They often move in tandem with the stock markets or bonds. And these characteristics allow for scalping, day trading, or long-term position holding. And advantages of trading the major pairs. The pros include some lower risk due to the stability and liquidity. They can be cost effective, they have minimal spreads and commissions, diverse strategies are going to be able to play it within them. They're suitable for technical and fundamental analysis, so when you put news and charts together and your TA together, technical analysis, then it could be a really good way to make some money, inshallah. But not without risk, be careful. And global impact, you can react to worldwide events, providing opportunities. So for example, during the COVID-19 pandemic, majors like USD JPY saw safe haven flows, creating a predictable trend. And so disadvantages of trading major pairs. So some cons to consider. Lower profit potential, less volatility means smaller price swings, and high competition. Crowded trades can lead to reversals, and new sensitivity and sudden announcements can cause whipsaws. For example, in 2016, Brexit, okay, which was something that involved the European Union, it caused GBP, okay, which is the British pound, US dollar / US dollar to drop 10% in one day, catching many traders off guard. So even if you were in a good position, due to the fact that you're trading something that's based off of economic news, can still be subject to certain drops or certain uprises. So be careful. Make sure you have your stop loss set, and make sure you're trading within your risk parameters. Trade within 1 to 10% of your account. So the definition of minor pairs are going to be known as cross pairs, and they consist of two major currencies, but exclude the US dollar. They represent about 10 to 15% of the Forex volume and are traded between major economies, and they're derived from majors. For example, European / GBP is influenced by European USD, and GBP / USD reflects regional economic dynamics without USD influence. And USD stands for, once again, US dollar. That's going to be the fiat currency used in the United States. And they're more active during European or Asian sessions. And miners often offer diversification from USD-centric trades. And some examples of minor pairs. Some common miners include Euro / GBP. And remember, minor pairs do not include US. Okay, so minor pairs are going to be Euro GBP, Euro AUD, which is going to be for Euro Australian dollar, GBP JPY, that's for British pound Japanese yen, AUD JPY, Australian dollar Japanese yen, Euro CHF, that's Euro Swiss franc. Okay, so CHF equals Swiss franc. Okay, and Euro GBP is Euro British pound. And then we're going to have CAD JPY. CAD is Canadian, and JPY is Japanese yen. So for example, with GBP / JPY, known as the guppy, it's volatile due to the carry trade interest rate differentials. So some characteristics of minor pairs. So minor pairs have moderate liquidity, less than majors, but sufficient for most traders. And they have higher volatility. They have more price swings than majors due to the fact of different certain parameters. They also have wider spreads. It can consist of typically 2 to 5 pips. Okay, so low liquidity is also going to lead to wider spreads. So beware of that too. And they have a regional focus, influenced by local news. For example, European data for European pairs and correlations, often inversely related to US dollar strength. And they're suitable for intermediate traders seeking more movement. And pros and cons of minor pairs. Advantages: higher volatility for profits, bigger moves in shorter times, and they're used for diversification too. So you can avoid the USD exposure. Let's say the US economy is going through something, then you can trade minor pairs. Some disadvantages: they have higher cost and wider spreads eat into the profits. So let's say you made $200, okay, on your trade, the spreads would go ahead and make it like 184, for example, okay? So this way you're going to be down like $16, something like that, okay? So they also have increased risk too. They're more unpredictable during off hours as well. And during 2022 for inflation, for example, Euro / GBP fluctuated wildly on the ECB versus BOE policies. So once again, any big economic news that occurs is going to go ahead and affect the price. So be wary, have your stop loss set. Stop loss is going to be an automatic order that cancels out your trade for you, so you guys don't lose money for no reason. So exotic pairs, here's the definition of that. Exotic pairs are a major currency, usually USD, with a currency from an emerging market or smaller economy. And they normally have low trading volume, making up less than 5% of the market. And emerging economies like Brazil, South Africa, and Turkey are going to be involved. And they have high sensitivity to local events like elections or commodity prices. And they're traded sporadically, with liquidity peaks in specific time zones. And exotics are for experienced traders who are willing to take higher risk, who believe in the future of a certain country, for example, or smaller companies' progression. So some examples of exotic pairs: you're going to have USD / TRY. That's going to be USD / Turkish lira, okay, for Turkey. So USD / MXN, USD / Mexican peso, so the US dollar and the Mexican peso. USD / ZAR, the US dollar / South African rand. Okay, it's going to be South Africa's currency. Euro / Turkish lira, so the European Union currency can be traded with the Turkish currency. And USD / THB, the US dollar and the Thai currency, the baht. So THB is going to be representing Thai's currency for the baht, and USD SGD. Okay, that's going to be for the Singapore dollar. Okay, so SGD is going to be Singapore dollar. So, for example, USD TRY. It's highly volatile due to the Turkish inflation and constant political instability. And certain other countries too that have not a stable government can be subject to certain volatile price action fluctuations, so be careful. So some characteristics of exotic pairs. So some distinct features, class. They normally have low liquidity and they're prone to slippage and gaps. And they have a high volatility and large swings can happen depending on the news. And that can be a good thing or a bad thing because it could throw off your technical analysis depending on just certain events. And they have a huge spread when it comes to fees, and they have up to spreads of around 10 to 50 or more, okay? Which could mean that if you make like $200, you can be getting like $100 back, depending on the certain amount of spreads. So be careful. And local influences, commodity and politics dominate, okay? And certain governments are gonna be corrupt. And higher swap rates, overnight costs can be significant. And this requires deep research into an emerging economy and see if they're actually improving. And some pros and cons of exotic pairs. Advantages, they have high profit potential and volatility allows big gains. And unique opportunities, okay, less crowded markets. And some disadvantages, they have high risk and sudden devaluations possible. They can be expensive as wide spreads and low liquidity can make certain things not work out. And limited data can be harder to analyze too. In the 2023 USD/ZAR surged hard due to the fact that South Africa decided to invest heavily within energy business, okay? So it surged hard due to the South African energy crisis. So if you make a good investment and the economy starts improving, you could potentially make some good profit based off of that. So the key differences. So comparing the three. So liquidity, majors are gonna have the most, then minors, and then exotics are gonna have the least. And volatility, exotics are gonna have the most due to the fact that they're gonna be the most unstable, then minors, and then majors are gonna be the most stable. And spreads, majors are gonna have tight spreads, so you're gonna get most of your money. Minors and exotics have wide spreads. And trading volume is high for majors, low for exotics, due to the fact that majors are more trusted, more news, more data, and risk levels are low for majors and high for exotics. And you could choose based on your experience and goals. And once again, I'm not saying one is better than the other, just do your research before you trade. And liquidity explained. Liquidity refers to how easily you can buy and sell without affecting the price. And majors have extreme liquidity with minimal slippage. And minors can be good but thin out after off hours. And exotics can be poor, leading to higher costs due to the fact that slippages can be destroying you. So if I would think different about trying to swing trade or trying to day trade exotics, I would maybe swing trade. And during low liquidity, exotic pairs like USD TRY can gap up like 100 pips on news. So be careful. And volatility explained. Volatility measures price fluctuations in the magnitude. So majors have an average daily range of around 50 to 100 pips. Minors move around 100 to 200 pips with more opportunities, and exotics can move 200 plus pips with high risk to reward. Not saying one is better than the other, do your research. And use tools like ATR, average true range, to measure if you want. And here's what spreads are. Spreads are going to be the difference between the bid and the ask prices. A lot of the time, the ask prices is what you're going to be buying at, and the bid prices is what you're going to be selling at. And majors have a 0.1 to 1 pip on average. Minors have 1 to 3 pips, and exotics have 5 to 20 pips or more. And a 10 pip spread on exotics means you start 10 pips in the red. And trading strategies for each. Tailoring strategies. Majors, okay? You trend and follow. Following the trend is really going to depict what you want to do on the majors, okay? And news trading. And minors, they can carry the trades and have different range bound systems. And exotics, okay? They have fundamental analysis and different long-term holding. And always use stop losses and position sizing. And some real-world examples. Applying concepts. So major, European/USD. During the 2022 Fed hikes, the USD strengthened. And minor, GBP/JPY in 2023, volatility from BOJ, policy shifts. And for exotic, USD/MXN during the US-Mexico trade talks, swings on tariffs, okay? So different examples like that can be used. So for example, for a major pair, in this scenario, let's say you're trading USD/JPY during a risk-off event. Japan's yen is a safe haven. In the 2022 market crash, the USD/JPY dropped from 1112 to 101 as the yen strengthened. And the strategy, short USD JPY on the stock market decline, and you ended up outcome with profitable low spreads, since it's a major pair. And exotic pairs risk. Let's say you're trading USD TRY during a Turkish lira crisis. Okay, Megabus. Okay, in 2018, let's say TRY depreciated 40% against USD due to inflation and politics going on. And strategy, then you could long USD TRY if you wanted to, but wide spreads cost extra. And with high rewards but overnight swaps, eroded the gains. Okay, so exotic pairs, even if you make a really good trade, fees, spreads and stuff like that could just wipe away the money that you make, and the whole purpose of putting on a good trade. So in conclusion, major, minor, and exotic pairs is the key to successful forex trading, and it starts with majors, you can graduate to minors, and approach your exotics cost sheets. You can practice on demo accounts and stay informed with economic calendars. Stay productive, God. Keep grinding. Put any comments below. I'll catch you guys in the next one. Head over to Stackmode.net if you want to trade forex or anything trading related. Peace.
All right, let's go and let's talk about how to catch big moves, right? This is going to work for crypto, stocks, forex, whatever. All right, how to catch big moves. So what is a big move? A big move is going to be pretty much a move that involves catching a lot of points and potentially can make you a lot of money. And the reason why we want to be focusing on big moves is because big moves help you turn a little amount of money, okay? So if you have a small account, for example, and the whole goal of trading is to turn a little bit of money into a lot of money, okay? We don't want to be trying to turn, risking a lot of money to make break even or the same thing, okay? Want to be using a little bit of money to try to make a lot of money, okay? And that's going to be scaling with the amount of figures that you have. So 5, 6, 7, 8 figures, etc. You're still going to have the same mental perspective, using a little bit of money to get a large return, okay? So, and that's going to mean a little bit of your portfolio, once again, relative to your scaling. So if you have a $10,000 account, then ideally you want to be using max 10% of your account per trade. Okay, so max $1,000. That's what you want to be using. Okay. Don't want to go over that because then you could potentially just be out of your risk management parameters, throwing you off. Okay. So you want to be using, once again, 1 to 10% of your account per trade. So if you want to catch a big move, focus on the chart too. Okay. Forget about P&L. Forget about the dollar sign. Okay? We got to learn how to read the chart, learn what we're looking for if we want to catch a big move in the first place. Okay. So when catching big moves, once again, don't focus on the profit. We got to be focusing on the process. Okay. Let's go ahead and let's jump into it. How to catch big moves. So if you're on the crypto stock market, you're most likely trading an upwards trending market. Okay, so I can pull up most stocks and I could see that most stocks from left to right goes in an upward staircase direction. Okay, so that's going to be the same for stocks. And let me go and pull up Bitcoin here. Even if I zoom out on Bitcoin, I can see the same thing here. Price started below down here, and I can see price made its way all the way up here to this day. Yeah. So that's going to let me know that price makes upwards direction. Why is price making upwards direction? Okay. So price is making upwards direction movement due to the fact that, one, for stocks, these companies aren't just moving for no reason, okay? These companies employ people, okay? So these companies help the economy. Okay, the more people working, the more people paying taxes. Okay, the more people paying taxes, the better the economy can be because the less debt the United States will suffer. So these stocks aren't just stocks for no reason. Okay, they're not just going up in value as well for no reason. They're helping people, they employ people, they feed families. Okay, and as far as the cryptocurrency tokens, right? So the crypto tokens. A lot of crypto tokens are created by humanitarians, okay, like Ethereum, for example, created to counter Bitcoin's power wattage mining system, okay? So a lot of humanitarians create crypto, okay, people who care, Okay, it's people coding these networks. Okay, coding the blockchain network, coding the hash, etc. Okay, lots of coding involved within the cryptocurrency network. So there's people behind these projects. Okay, they want to see these projects succeed. Okay, they want to see it go up in value. And not only that, a lot of these CEOs of these stocks and owners of the token currencies own shares or a percentage of the crypto token. Okay, so they also want to see it go in an upwards direction. So once again, why else do things go in an upwards direction? Let's talk about safety. Okay, when people feel safe to invest into something or keep their money into a certain place, everyone's going to do it. And the benefit of that on the stock market and the cryptocurrency market, etc., is that the more people are doing one thing within the trading world, so if a bunch of people are doing some buying, then inshallah, you can go and put into place and assume theoretically that price wants to go in an upwards direction. Okay. If you start seeing a bunch of buying on the order flow on your tape, you start seeing whales buy in, etc. Okay, you can assume that price wants to go in an upwards direction. Everyone's doing it. Everyone's putting big money at it, and everyone's betting on it going in an upwards direction. Okay. So keep that in mind. Things that are safe, people are going to feel comfortable investing in. Okay, that's why Bitcoin's been going up exponentially past couple of years, especially once the SEC, okay, government body, decided to gain regulation over the Bitcoin. Okay, and regulation then leads it to a whole new masses. Okay, people who watch the news and stuff like that, etc., then they're going to feel safe to invest. Hence why Bitcoin rose to 112,000 as of right now. Okay, fairly quickly as well too. So let me know if you guys were an early investor as well. So that's going to be a reason why price goes in an upwards direction. Now let's talk about them. Two things. We'll break down resistance and support. So the market can only move one or two ways. Okay, one or two. It's simple. That's it. Okay, it can either move down or up. When market is moving in a downwards direction, right? All it is people selling. So I like to do everything on my higher time frames too. Personally, I like to use the daily and 4-hour time frames. And those are going to be the 2 time frames I scan everything with. So I'm going to start off with my daily here. And I could see, once again, this is a left to right chart. But I could see that even from all the way back here in 2017, why did price make this spike right here and then dip down? Why didn't it just go up to infinity? Okay. Let me go ahead and answer this question for you guys. This is why stuff just doesn't go up in a straight line. And this is why you shouldn't panic when stuff dumps as well too. Because anything that goes down will try to come up within the market. So check it out. Price created this area of resistance right here. Okay. And resistance is going to be an area where sellers are present. Resistance means people sold heavily on this or at this level. Okay. And it's going to be best to see resistance on things like the higher time frames. Okay. You want to see resistance on the weekly, on the daily, on the 4-hour. Okay. You want to see support on those time frames as well too. But resistance means that people sold heavily. So why would people sell? Okay, if they're already up so much profit, why would they not think that's going to go to 1 million? Okay, let's put in a logical perspective here. So this is why it's kind of difficult to trade at all-time highs. So people got in way over here to the left, okay, and then price just starts pumping in an upwards direction. Okay, they have no take profit above them. They don't know how high it wants to go up in this one cycle. Okay, so the market's going to start collectively selling, okay, creating a massive sell-off. But once again, anything in the cryptocurrency or market world, as long as it finds its value within the world, it will make its mark. And we can see here, once certain things started to change, when people started investing into it, you can see this area of resistance here, where price fell down heavily at, decided to be passed. Okay. when market decides to pass the heavy area of resistance or support, we know that's going to be called a breakout. So a price broke out right there easily, okay? And a breakout couldn't be a good move here because why? You don't know how high price wanted to run up to. Price ran up all the way to here, okay? And there was no previous highs. So this is why when they're structured, it's a lot easier to trade, okay? And there's going to be some things that you buy and hold and sit in a long-term position. But as far as catching the trend and catching a big move, you want to make sure you know where price wants to exit, where it started at, okay? And what type of trade it is, okay? Is it a bullish trade or is it a bearish trade? So let's take this example here, right? I have Amazon here. So one thing I know about the market too, I know market's always trying to break all-time highs, okay? Because everything's trying to be the best, okay? Companies want the highest rated currency, stocks want the highest rated value as far as numbers. Okay, tokens want to be the most popular and most used. Okay, so it's very, very competitive. So in order to compete, let's analyze. So you can see here, this area of resistance up here, and this area of resistance up here. Okay, why is that important, Chris? So areas of resistance are going to be extremely important due to the fact that price is always going to hunt them. No matter if price is at $0, if all-time highs is at 200, it's going to try and break that one day, inshallah. Okay, if an investor gives them $2 billion to revive the company from the ground and people start buying into it, it's aiming right for that previous all-time highs, looking to break it, okay, because it's looking to be the best, okay? It's looking to break its future records, break its future numbers, okay? And a company is trying to get better, okay? Just like human beings, we're trying to get better every day. Companies are trying to be the biggest, okay? And be in new levels, have a new stock share value, so they can pay out their workers and shareholders more if they give dividends, okay? So Amazon, for example. So I could see this area of resistance is up here, and I have another area of resistance up here, okay? Price paused. I just think of resistances as areas where price paused, okay? Check out this area here. Price decided to create this V area here and bounce in an upwards direction. Okay, so the opposite of resistance, we're going to have support here. Support is going to be an area where price decides to bounce from a downwards demand area. Okay, so price is going to come down, make a low, okay, and then bounce up from that low. Okay, and that's going to mean it's in demand at that place. Okay, so demand is going to mean support, and resistance is going to mean supply. Okay, so if you ever heard the two terms, that's how you break it down. So when market is shorting, okay, and shorting means selling off, okay, going in a downwards direction, market is always trying to meet with a area of support below current price or an area of resistance below current price. So resistance can be broken and turn into support. And when price is going in the downwards direction, especially on the stock and crypto market, it's not crashing. What it's doing is looking for a new low. Okay, it's looking for an area where people demand it, and then they're going to go ahead and get it. Okay. So the area of resistance is always where we're going to know where we want to exit at. So if I have this strong area of resistance up here, I know I'm going to go ahead and close and take my profit up here. Okay. And this is how you can catch big moves, especially on things like options. Okay, it's just closing at the right time and one buying at the right time as well too. Okay, so if price starts showing me price action down here from this area of support, and that breaks all-time highs, etc., okay, then you can keep studying that congruency. Okay. So we got Google here. Okay. Create an area of resistance all the way up here at 257. Okay, we're dumping down to 237. Let me go to my 4-hour here and check it out. Okay. So price kind of met up with this area of support over here. Okay. And I don't like to just get in on the first week once again. I like to wait for that daily close. Okay. That's not the daily close. I'm gonna wait and then boom. So we'll jump into another example here, some Tesla. So I can see area of resistance above current price. Okay, price is falling in a downward direction. Okay. Once I start seeing price curve and give me some bullish momentum, I know price is going to try to reach this area of resistance. Okay, trying to beat its competitor. Okay, so take this example here. Okay, amazing example. So we have this area of resistance all the way up here, and you can see price decides to create its own area of support system here. Okay, and then looking to curl and fill in these areas of resistance. Okay, that's 50 points here of Oracle. And finding a trade just comes down to really just taking your time. So Visa here. Price has this area of resistance up here. My daily, let me zoom all the way out. I can see we're making higher lows. Ultimate low, higher low. Low, low, and then higher low. Okay, so let's start seeing higher lows, price going in upwards direction. That's definitely gonna let me know we're trending hard. Yeah, so I'm gonna go ahead and mark out this other area of resistance over here. Got resistance right here too. Cool. Price falling down in the same exact area. Okay. So, wait for price to curl, or wait for price to blast past this area, turn it into some support, and then take it up to the next area of resistance. Okay. And then a ruler. And you always know price is trying to hunt resistances. Okay? So don't think that these gaps won't try and fill itself, okay? Because inshallah, they really will. So boom, and that's about 20 points here. And it's definitely a neck out flipper. So I'm going to pull up some crypto examples here. Okay, same thing on the crypto market. Okay, we're not going to make it hard. Just keep it simple. I'm going to pull up Ethereum here. Okay. Market's making that big red dip on the daily. Okay, we played all the drawings here. All-time highs is going to be all the way up here. So, price is looking to make a low. Okay, so we do have a strong area of resistance right here. Right here. Right here as well too. Okay, two very strong areas of resistance. And I believe way over here as well too. Okay. So then price came down. Broke the area of resistance, and then turned it into support.
Now price is heading within an upwards formation. Okay, and everything remaining till the area of resistance is going to be a move you can catch. You can just enter in the middle of it. Okay, don't stress over perfect entries. Our only God's perfect. Yeah, we're going to slow down, see what the price action is talking about. If we can catch our take profit still, we're going to catch it. Okay, if price made a low, it made a low. You start seeing daily closes and curves, you know what time it is. Okay. It's about having the risk appetite too. So even right here, have this area of support right here. Area of support right here. And then area of support right here. Or resistance right here. So support got broken, turned into resistance. The resistance got broken, turned into support. And now price is trying to sweep with an upwards direction. Okay. So if this is successful, I see price wants to sweep here. And I'm going to go ahead and catch the whole rest of the move up to this level up here. Then you can catch the rest of the upward up here. Okay. And then the whole remainder of the move is pretty much going to be in your pockets. Okay. So that's going to be 1, take profit, and then 2. So extremely simple. That's just making it easy for ourselves. Knowing what we're investing into, knowing what we're buying, knowing what we're going to exit. It's really going to be imperative to just making good decisions, okay, and just making sure we're profitable at the end of the day, which is really what matters. So cool. So I'm going to go and pull up another example here. Let's do some XRP. XRP just took a massive dip. The price might be trying to bounce here. We'll see. It bounced really quickly. There's also an area of resistance over here too. Yeah, we have this area of resistance here. Looks like price is reflecting off of that here, and may potentially be going to go in an upwards direction. Okay, so let's go and let's check out this area of resistance up here. Okay, you know we're trying to break all-time highs, so we can keep making new highs. Sure. Okay. So think of market logically like that. Solana, for example. We have Solana is super useful. Can't trade Bitcoin without it. Can't trade not Bitcoin, like Pepe the Frog coin with etc. Can't trade without Solana. Okay, so meme coins. So even the same layout here, have support, turn into resistance, turn into support. Okay, so the same thing as Solana. Okay, so this is why it's important to have a just certain strong mindset too. Don't panic sell the same place everyone else is doing it. Okay, be calm. Okay, and you got it. Okay, really sit on your trade, let take profit get hit, and yeah, and doing that really can help your flow up. So let me pull up TRX here. It's the same thing. One thing you're gonna notice too about me pulling up all these crypto pairs, they're all very similar. Each and every single one of them are really similar. So they all do the dip. Okay. And price action was just a little different here. So it looks like we had a dip here. We had a heavy dip on September 6th too. And that's also another thing too when it comes to catching big moves. Be aware of like news too. Be aware of news, the most volatile times, etc. too. Okay. So cool. So yeah, that's gonna be how to catch the big move. So pray to God, keep grinding, and head over to Stackmode.net. Hey class, this is going to be the full masterclass on how you can turn your money into more money by just investing virtually. Let's go and let's jump straight into it. So, building the financial foundation. So before committing any capital to the market, okay, make sure you guys are humble, okay? Humble yourselves. Before you invest even $1 into the market, understand that the market is not a place where you can have ego, okay? If you don't accept your loss into the market, if you don't accept the fact when you're just not correct, you can destroy all of your capital that you've been working hard for. Okay, I don't care how much capital you're investing into, 4 figures, 5 figures, 6 figures, doesn't matter. Okay, the more capital you're investing into is not going to make you a better trader. Okay, so also try and have a steady income. Okay, so don't think you're just going to come into the market and just turn nothing into something and professionally just trade forever. It can happen for some people, but it's really stressful, really anxiety driven. So try and have a steady income. Okay, work on your business. Okay, and then come into the market and invest. Okay, so stay prayed up to God. Make sure you guys are worshiping God and be humble. Okay, have some humility before you come into the market and have a steady income. Now let's jump straight into it. So before committing any capital to the market, a successful investor must ensure their personal financial structure is stable. And this initial phase dictates your risk tolerance and emotional resilience. Okay, there's going to be times where the market's going to be trying to break you down. Okay, it's going to be trying to beat you up. It's going to make you think that you're not meant for this. Okay, especially on certain things like options, which we're going to talk about in this, for example. But you guys got this. Okay, invest your money, take your time, and buy at the right times. Okay, if you want to learn how to buy at the right times, head over to stackmode.net and I'll teach you how to read the charts. I also have tons of free videos on my channel. So establish a solid budget and have a roadmap. So detail your income and your expenses. Okay, know how much you make and know how much you are going to lose in bills, and then go ahead and have a leftover amount of that, whatever that is. Okay, because you want to have some spending money just in case, because life happens. Put some of that away, and then whatever's left of that you could go ahead and invest. Okay, and only invest money that you genuinely do not need for daily life or near long-term goals. So pay your bills, get your groceries. Okay, take care of whoever needs to be taken care of, wife, kids, whatever, do your thing. Okay, and then you can go ahead and invest. And this way you can invest stress-free. Okay, if you lose money, you're not going to be tripping. That's not money that you completely need entirely. You're going to be fine. Okay, and try and have a safety net too. This is going to be paramount. Try and have 3 to 6 months or 6 to 12 months for higher job instability, as certain recessions and stuff like that come into play as the economy just becomes unstable in certain time periods. And you can have a bunch of living expenses saved up in a high yield savings account, or you can have it put in the stock market. Okay, stock market. I don't really recommend a high yield savings account though, because it's interest is wrong. So I don't really recommend a high yield savings account, but you guys can put it in a stock, put it in an ETF, and that's going to go ahead and make you guys some money. Okay, and this prevents you from being forced to sell investments during a market downturn just to pay your rent. So, and eliminate high interest debt. Okay, high interest credit card or personal loan debt often carries an effective return of 20% or more. Mathematically paying off this debt is usually the best guaranteed return and you can achieve before investing. Attack and eliminate consumer debt first. Okay, so try and eliminate your debt before you guys invest too. It's also just going to give you guys a bunch of mental health back. Okay, so if you have a credit card balance of $5,000 at 22% APR, then you must generate a new 22% return, okay, just to break even. And paying off the debt is a guaranteed 22%, okay, will significantly de-risk your financial future. So just pay off the debt so then you guys don't gain any interest, which is going to lead you to have to make more income in the future just eating into your investing profit. So pay off your debt. It's logical. And core investor principles and account types. Successful investing is less about timing the market and it's more about time in the market and adopting disciplined habits. So timeless principles. Be patient, okay? Don't think you're going to be getting rich overnight. And in certain cases where you do make a lot of currency overnight, okay, that doesn't mean you just blow it, okay? Don't go blow it. You need to go ahead and put yourself on a withdrawal schedule, okay? Before I start telling you guys how to make money, this is what to do with the money. Once you make the money, okay, let's say you make $500, take 50% of that and put it away. So 50% is 500, is going to be 250, okay?
once you have that, this is going to be the amount that you can go ahead and put into your bank account, or you can go ahead and reinvest that into certain things like dividend ETFs we're going to talk about, okay? Or you can use it to pay off debt or pay your bills, etc. And diversification. Never put all of your capital into a single stock, sector, or asset class, and do not keep all of your eggs in one basket, okay? So try and have a diversified portfolio, okay? We're going to talk about the different types of diversification, but don't just put all your eggs in one basket. And DCA, dollar cost averaging. Invest a fixed amount of money at regular intervals, okay? So for example, $500 every month, okay? And this smooths out the entry price and removes emotional buying from just buying huge leaps at one time or another, okay? You're going to set yourself on a consistent schedule, take care of your bills, and keep stacking up, okay? It's going to be in stack mode. It's going to require sacrifice. If you want to get to where you want to be, it's going to require sacrifice. Stay down. Don't buy anything you don't need to be buying. Pay your bills, get some groceries, and that's it. No extras, okay? And your brokerage account, okay? This is what is going to be used for really just playing options, okay? Playing options, futures, or Forex, any type of short-term trading, okay? I would recommend a taxable account, and it offers maximum flexibility. You can have an infinite amount of money invested into it, and after tax and profits are taxed as capital gains when you sell, okay? There's also going to be some benefits though for long-term benefits if you hold for over a year. And retirement accounts, okay? They're tax advantage. So 401ks or Roth IRAs or IRAs, they're incredible tools for retirement savings, and the tax benefits, either upfront tax reduction or tax-free growth, are critical to maximize long-term returns. And as far as Roth IRA, contributions are after tax, but all growth and withdrawals in retirement are 100% tax-free. So that's going to be the difference between that. And you can go ahead and use, once again, brokerage taxable accounts in order to invest into certain amounts. Okay, so you can go ahead and use that into just invest into your day trade or swing traders. But if you want a retirement account, then you can put that into your IRA. But you think about the IRA though, is that you can only invest a certain amount. It's going to be capped for a lot of the time. So I think it's around like $7,000 and $8,000 in 2025 this year. So yeah, it really depends. But taxable accounts, you can deposit an unlimited amount, make unlimited income. So depends up to you. So strategy 1, investing in shares in good companies. So the essence of value investing and buying a piece of a profitable business at a fair price and holding it for a long term. This is arguably the most stable path for beginners after index funds. Okay, so shares give you a piece of the pie. Okay, so say company is the pie, say I open Stackmode, okay, on the stock market, and you want to own a piece of the pie, okay, you're going to be able to have jurisdiction and a vote in who runs Stackmode company, okay, and as Stackmode company increases on the stock market, you make money too, okay. So that's going to be the point of people investing into shares. As the share price increases within an upward direction, people make money. Okay, so let's go and let's talk about the economic moat concept. So what is a moat? It's a sustainable competitive advantage that protects a company's long-term profit and market share from competing firms. And the wider the moat, the safer the investment. Okay. And the value of service increases as more people use it. Okay, so the value of a service increases as more people use it. So the more companies putting a smile on people's faces, more people are going to use it. More people using a company's service or buying products equals more money. More money, a lot of the time, equals a higher value share price on the stock market. Because since this shit generates so much money, it's going to be a valuable company. And valuable companies are normally highly priced on the stock market. And this makes it extremely incredible hard for competitors to challenge, especially once they have a high stock price compared to the other ones. And intangible assets, brands, patents, and regulatory licenses. And think of pharmaceutical patents or universally recognized global brand names. And these cannot easily be replicated. So, analyzing growth versus value. Companies are often categorized by their investment profile, and beginners should be aware of the trade-offs involved in each style. So growth investing, right? The focus.
So rapid revenue and earnings expansion. And these companies often reinvest all profits back into the business to fuel future growth, okay, making it a money powerhouse. And valuation. They typically have high price to earnings ratios, which means that the company is making good profit year after year and being able to most likely pay their employees good money. So, and they typically have high price to earnings ratios because investors are paying a premium for expected future cash flows, but they carry higher risk. And let's talk about value investing. Value investing is buying mature, established companies that appear to be trading below their intrinsic value, often found in older, slower growing sectors. And they lower price to earning ratios and often pay dividends, okay? And the expectation is that the stock market will eventually recognize the company's true value, leading to stock appreciation, okay? Just like the dividend, for example, SCHD, okay? For Schwab, for example. And you can go ahead and start with broad market ETFs, food, you could do SCHD, okay? And as you learn the market, okay, it's gonna be a good way to just grow your profit over time and chill, okay? But come on with a full plan and know what you're gonna do before you just start investing. So, build passive income with dividend ETFs, okay? A dividend is a portion of a company's earnings that get paid out to its shareholders. So after the company decides to go live on the stock market, okay, or the New York Stock Exchange, okay, it decides to go ahead and pay money to whoever owns the shares, okay? And due to the fact that it's supporting the people who supported them, okay? So it's pretty much putting the money back in the cycle. And dividend-focused exchange-traded funds offer a powerful, diversified way to generate income. So what are dividend ETFs in the first place? So dividend ETFs provide diversification and stability. An ETF holds a basket of multiple stocks, let's say for example 50 to 100 plus. The dividend ETF specifically targets companies with a history of paying and increased dividends, reducing the risk of relying on a single company. And dividends are typically paid quarterly. The ETF collects the dividends from all underlying stocks and distributes them to the ETF shareholders. And as far as dividend reinvestment plans, this is the key to compounding. So having a plan with it automatically uses the cash dividend to buy more shares of the ETF, and this increases your share count, leading to larger dividends next time, creating a powerful compounding effect. So you could look for ETFs focused on dividend aristocrats and companies that have increased dividends for 25 or consecutive years, right? Focus on high yield, stable sectors like utilities or consumer staples that pay out dividends, and make sure you don't see too many splits. Okay, split is when they're going to be paying out less dividends. Okay, so we're going to be wanting to look for an increase of dividend payouts, not a split to where they're going to be paying less dividends. That means that they can't afford to keep up with the amount that they're paying. So you could buy Bitcoin as well too. So Bitcoin, until it expires, until it's all fully mined up, it's pretty much just going to be virtual diamonds and virtual gold. Okay? It does have a limited resource. It's going to go away at some point in time. And Bitcoin is introduced to the world to the decentralized digital scarcity. So a decentralized world is a world where no middlemans are involved, like the banks we were talking about. It's peer-to-peer transactions, and everything's done via autonomous contracts called the smart contracts. Okay, and the whole Web3 decentralized space has been broken down on my channel multiple times. So if you want to learn more about that, you can check it out. So buying Bitcoin is also going to be a really, really good solid way to make some currency due to the fact that one, has some value behind it. It's virtual diamond and gold. And two, it really helps society. People are able to trade money within a quick way all across the world, okay, due to the fact that Bitcoin exists and they get something out of it. So it's while a potential long-term asset, carries significantly higher volatility. Sometimes it can go downwards in the downward direction, okay, causing you to lose your money, but no risk for and different risk factors compared to equities. So the HODL mentality. Okay, HODL stands up for hold your life, which reflects the need for extreme patience. Okay, so you cannot sell early. If you put yourself in a trade, okay, and if you marked it out and the trade's working out, don't just sell early, taking your profit.
Okay, let it ride out. Try and hold the trade for some years. Okay, and see how much progress it's gonna make. Okay? Especially something on Bitcoin, like it's not something ideally that you want to be scalped. And given the volatility, most the time I would say try and keep your account with like the remaining amount of money that you have. So even after you bought your stocks and stuff like that, your crypto should be your final portfolio that you invest in. And unlike stocks and a brokerage, you're responsible for the security of your crypto assets. Okay, so use good brokers and use brokers that are going to be safe and keep your money secure. And you could directly buy cryptocurrency with your card, okay, like Coinbase, Kraken, or whatever. Okay, and then you can go ahead and send it to another wallet if you would like. So stock options, okay, it's going to be a great place to make some income, but it's also going to be a great place to lose some income. Okay, so you have to really be technically advanced. Make sure you're studying. So stock options are advanced. They're leveraged financial derivatives, and as a beginner, make sure you guys are mastering and studying the charts before you even touch options. Okay, if you're struggling with options, head over to Stackmode.net. I'll teach you guys how to trade it. Okay, options is not something that you want to be playing around with without the information first. Take your time. So the contract. Okay, an option is a contract giving the buyer the right, but not the obligation to buy or sell an asset at a specific price, also known as the strike price, on or a specific date. Okay, so if you think price is going to go in an upwards direction, then you would buy what's called a calls contract. If you think price is going to go in a downwards direction, okay, then you go ahead and buy a puts contract. Okay, so if price went from $32 a share and you think it's going to go to $40 a share, and it did, and you have the right contract, you would make a lot of money. Okay, if you think price is going to go down to $20 a share, and price is at $25 a share and it goes down, and you're in a $20 a share contract, or $21 a share, $22 a share, anything, anything under that, and take profit's going to be 20. Okay, so anything under 25 would go ahead and be an ideal contract, and that would go ahead and work. And it gives you the right to pretty much get paid based off directional bias. And options allow you to control $100 worth of shares for a small fraction of the cost, and this magnifies profits, but critically it magnifies losses just as quickly. And the intrinsic value of the option decays over time. Okay, meaning the contract is constantly losing value as it approaches expiration. So, eighth wonder. So compounding is going to be the process of generating earnings on both your initial investment and on the accumulated earnings from previous periods. And it's the engine of long-term wealth creation. Put your money in a loop. Okay, when you get some money from your business, invest it. And then when you make money from that, invest that. Okay, put your money in a loop. Your money should be like a tornado, a big whirlwind. Okay, and that's going to cause exponential growth, inshallah. And the returns generated in the last years of an investment journey are vastly larger than the returns in the early years. Even if the dollar amount invested remains the same, the accumulated interest is doing the heavy lifting. And time is the key multiplier. Time is going to go on anyways, as long as you're on Earth. So just let your money make some money. A person who invests $5,000 per year per 10 years, okay, so let's say they have 50K, starting at the age of 25, will have significantly more money at 65 than a person who invests $5,000 a year for 30 years, okay? For a total investment, it's going to go ahead and be $150,000, okay? So, invest, okay? Get into stack mode, take your time, put money away, and just keep grinding, okay? You guys got it, okay? And don't let your emotions get to you, okay? This is why God's gonna be really important, staying humble, okay? Because sometimes you can have a lot of fear, especially as a beginner trader, and don't panic. Don't sell when it's not time to sell, okay? And don't buy when it's not time to buy, okay? That's being greedy and being fearful. Once again, being emotional can destroy it all within your trading assets. And buying into an asset just because everyone else is making money, okay, during a speculative bubble, for example, this usually results in buying at the peak at all-time highs. Make sure you please know how to read the charts. It's a left to right charts, and it's called trading for a reason. When you're losing, somebody's winning. When you're winning, somebody's losing. Stick to your fundamental analysis and plan allocation. Okay. And as far as the IPS, the investment policy statement, Write down what your goals. Okay. Write down what you want to achieve. Write down how you're going to achieve it. Okay. And write down how you're going to break it down. I reckon even you guys have 2 accounts. Okay. 1 account for your long term, and then another account if you want to go ahead and day trade, swing trade, whatever. Okay. Up to you. Okay. They have 2 different types of tax benefits. Your long term account, I recommend you guys holding a trade for over a year. Okay. So you get the long term tax benefits. And then if you're going to have a day trade account, just use that and then pay your short term tax. Okay. So get ready. Okay. Fund your emergencies, pay your bills, clear your debt, and then you're going to be ready to trade. Okay. And then you can go ahead and do a Roth IRA and a brokerage account if you want. Okay. And go ahead and set up your initial long-term investments and start saving money through there. And stay the course. Okay. Check your portfolio quarterly, not daily. Ignore the market noise and volatility, and let compounding work as magic over decades, over time. And the biggest risk is the risk of not investing at all. So start today. Okay. Stay praying to God. Keep grinding. I'll catch you guys in the next one. Peace. All right, Stackmode Chris here, and this is going to be everything that I wish I knew when I started buying and selling stocks within the stock market. So it can seem daunting, but it's definitely a powerful way to build wealth over the long term. And it requires a lot of patience, humbling yourself, being close to God so you don't lose yourself or your sanity, and just being disciplined. So what exactly is a stock? A stock is also known as an equity, and it's a security that represents an ownership stake in a company. And when you buy a company's stock, you become a shareholder, and you own a tiny fraction of that business. And as a shareholder, you're going to be entitled to the portion of the company's earnings, okay, so the company's money they make, and assets, proportional to the number of shares that you own. Okay, so the more shares that you own of the company, the more piece of the pie you'll have. So the primary goal of most stock investors is to profit from the appreciation of their shares over time as the company grows and becomes more valuable. So imagine this, for example. So if I have a pie, okay, let's say the pie is called Stackmode pies. Okay, so Stackmode pies, the name is going to be the stock. Okay, whatever the name is the stock. Okay, so stock is essentially the name. Okay, say I own 50% of Stackmode pies and I own 5 million shares. Okay, so shares are going to be the percentage ownership. Okay, and then there's going to go ahead and be directional bias. So if I said I was going to hand out 4 slices of pie today and I was correct, then that's going to pretty much be an options contract. Okay, a stock options contract. So options contract, you're getting paid to pretty much predict price within a good time manner. Okay, so that's the difference between all of them. So for example, imagine a company, okay, Stackmode Network. Let's say we decide to sell 100,000 shares to the public, for example. And if you buy 100 of those shares, okay, you'll then own 0.1% of the company. And if the company's value grows from 10 million to 20 million, your shares value will likely double as well. So having an investor's mindset is going to be extremely important. Don't hop on the market thinking that it's a quick money grab, thinking that it's a quick get rich scheme. No, it's going to require discipline, day after day after day after day after day after day after day, repetition, not giving up, feeling like a failure. Okay, so many times where I just felt like I just wasn't for me, felt like I wanted to stop and was just feeling unmotivated, but I kept pushing through. I knew there was an end goal to it. And now, alhamdulillah, we're seeing green profits. Okay, so having an investor's mindset, having a resilient mindset is going to be extremely, extremely important. You've got to be patient. Okay, always be working on some other business or something like that while you're in a trade. Okay, you can't sit there having anxiety about the trade all day. You can't put yourself in lock. Okay, you got to keep going, keep flowing, keep building the wealth. Okay, and shalom. So investing is not about getting rich quick at all. It's about building wealth patiently and systematically and logically. And the biggest enemy to a new investor is often just their own emotions. Okay. So key principles of the mindset, long-term perspective. And think of terms and years, not days or weeks. Short-term market fluctuations are normal and often unpredictable. And true, wealth is truly built over decades, not quarters. Even if you run up $8 million, for example, in 2 years, okay, if you're not disciplined, if you're not structured, you don't know how to continuously win trades. Let's say you hit a couple meme coin plays, right? If you don't know how to continuously win trades, put the money away for taxes, budget, reinvest, you could end up definitely destroying that. Okay, you could destroy any amount of money by being undisciplined. Okay, so have a long-term perspective on it and avoid emotional decisions. Do not panic sell when the market drops. So the left to right chart. Okay, if the stock market or crypto market goes down, understand that inshallah, especially if it has value or something called market cap. Okay, market cap is going to show you the number of how valuable a company is. Okay, so if something has a high market cap, okay, and certain things occur on all of them, then you know it's also going to be something that you want to be looking at too. Okay, so a lot of the high market cap stuff can have decent volatility. Okay, and embrace that. Okay, the market's going to go up and down, and volatility is a natural part of the investing landscape. And you can view market downturns as potential opportunities to buy quality assets at a discount, also known as the dip. Okay, so if the dip is happening fast, people think price action is just willy-willy. Okay, so if you see your 4-hour candlesticks curling upward, daily candlesticks curling upward with closes, you know that you might be able to find the low. Make your take profit in an area of resistance or support above current price. Okay, and just take your time. Okay, so taking my take profit is something that I wish I stuck to. I would hit take profit, but sometimes I would get greedy, hold past it, okay, or try and make 10 bands in a day instead of being happy with the 900 that I just made. Okay, I've had instances like that too. Okay, so it's about instances of being grateful, and this is why just reading the wisdom that God has left here for us, Quran, you know, etc. So it's really just going to help us put everything together and lock it all down and understand, like, okay, I can't just be playing with my money emotionally. I actually got real people to protect and provide for. I gotta be serious with my trading. I gotta be serious with my money. Okay, and trade with this mindset. Never trade with the mindset of, oh, I'm trying to make some money. Not trade with the mindset of, I'm not going to lose money on this trade. Okay, and do your own research. Okay, never blindly follow a stock tip from a friend. Instagram, okay, there was times where I traded in a group of friends. That was before I even started mentoring on YouTube. Okay, I started off mentoring a group of friends, okay, and then they told me that I should start taking it on the internet. Okay, but that's how it started at first. Okay, started helping people get funded. Okay, after I figured out how to get funded and stuff like that. Okay, but trading with friends sometimes can lead to bad decisions if you don't do your own research. Okay, because no one is perfect, only God is perfect. So sometimes, like, especially if they're not studying more than you, okay, just try and stay in your own lane and your bag and your investor. Okay, study from your mentor, okay, and just stay locked in with your mentor and focus on the charts. Okay, so God got you. Okay, find yourself a good mentor that you can trust. Okay, and just trust your vision and your view. Okay, don't be arguing with anybody who doesn't believe in your view. So understand what you're investing in. So fundamental investing concepts. So to navigate the market, let's understand the language of it before we're just on here lost. Here's some of the most critical terms and concepts you'll encounter on your journey here a lot. So stocks, once again, stocks represent ownership in a company. They're higher risk but higher potential return, and you can participate in the company's growth. So if you catch a good company at the low, let's say you catch it at $32 a share or something like that, okay, and then price decides to go to $100 a share, okay, you would make a large percentage gain on your money. Okay, why? Because $32 a share went to $100 a share. Okay, that's a 68-point jump, if I'm not mistaken. Okay, so it's a lot of points, a lot of percentage gains to go ahead and be paid off of. So with stocks, you get paid as price decides to go in whatever favorite direction you purchased it in. Okay, whether be it you're wanting it to go up or down with the options contract, for example. So bonds are debt and stocks are equity. So bonds, they represent a loan to a company or government, and they're lower risk but lower potential return. And you receive fixed interest payments over time. And think of it as being a bank for the company. So let's talk about market capitalization, a very, 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 very popular term. Market cap is the total value of a company's outstanding shares, and it's a simple way to gauge a company's size. So a large cap is going to be anything over 10 billion. Mid cap is 2 billion to 10 billion, and small cap is generally considered below 2 billion. Okay, so small caps can be high risk, high reward because no one's really found them yet. But if you catch a small cap and it turns into a large cap, you'll be rolling in some dough, inshallah. Okay, mid caps, they have some higher growth potential. Okay, but they can also be more volatile since it doesn't have the most value. Okay. And large caps, generally more stable. They do have a lot of volume though. So if price wants to correct, it'll definitely correct. So if it wants to dip down hard, it'll do that. So the art of research, okay, fundamental research versus technical analysis research. There was times where I only traded earnings, for example, okay? And I would just do research on the company, on the earnings, and that's fundamental analysis, okay? And then I started just trading with the charts, okay? And that's technical analysis, okay? And both are gonna be needed to mesh together the ultimate plan, trust me. So fundamental analysis, let's talk about what it is. So this approach is a company's intrinsic value, and you'll analyze its financial health, management, market share, and competitive landscape. Okay. And you're looking for a stock whose price is below its true value, believing that it's going to rise over time by helping people in the future. Okay. And putting smile on people's faces and so on. So some key metrics: the price to earning ratio, also known as the PE ratio. Okay. Earnings per share and return on equity, also known as ROE. These numbers tell a story about a company's profitability and their valuation. So for a PE ratio example, if a company's stock is trading at $50 per share and its EPS is $2.50, the PE ratio is $50 divided by $2.50, and that equals 20. And a low PE might suggest a stock that is undervalued, but it could also signal poor growth prospects, and it's a key piece of a larger puzzle. Put together what you wish. And technical analysis. This approach ignores a company's fundamentals and instead focuses on chart patterns, such as waiting for support to be broken, turn into resistance, or resistance being broken, turn into support. Okay. So instead of focusing on chart patterns, fundamentally, you could focus on chart patterns technically. Okay. And that's technical analysis. Okay. So technical analysis involves chart patterns, trading volume, studying the market momentum, and how the candles are moving. And technical analysis believe that all relevant information is already reflected in the stock's price. Okay. And the golden rule, diversification. Okay. And I also wish I was just saving way more money too. I would buy a bunch of Bitcoin, but then I would always just sell it. And I was like, dang, okay, everything that I've been buying and selling for the past 3 years, if I would have just held it, okay, then I'd be very, very up. But I'm glad I didn't do that because I get to teach this lesson here today. Okay, so the golden rule, diversification. So one of the most important lessons is to never put all your eggs in one basket. Okay, so don't just put all your P&L into just one share play. Okay, diversify a little bit, maybe like 1, 2, 3 plays at max. That's crypto and stocks included. Okay, 1 to 3 digital plays max. And diversification is the strategy of spreading your investments across different assets to mitigate risk. And when one investment performs poorly, another may be doing well, helping to balance your portfolio's overall return. So I hope you invest across industries. Don't just invest in tech, consider healthcare, consumer goods, energy, and finance. Different sectors react differently to economic cycles. Okay, so as of 2025, when this is coming out, we're in like the AI cycle. Okay, so AI stocks, for example, are super popular. Okay, or crypto brokers. Okay, anything allowing people to trade cryptocurrency, it's going to be popular too. So invest globally. Okay, the US stock market is not the only one. Consider international stocks to capitalize on global growth and reduce country-specific risk if you want. And use ETFs and mutual funds. Okay, these are powerful tools for instant diversification. An exchange traded fund, an ETF. That's a basket of securities you can buy and sell or an exchange, just like a regular stock. An S&P 500 ETF, for example, gives you an instant ownership in the 500 largest US companies. Okay. And mutual funds, a fund managed by a professional, which pools money from many different investors in a variety of assets. So here's some common mistakes I do. So chasing hot stocks, okay? So especially after I made my first couple bands with like C3 AI, say seeing that, okay, making my first like flip like that, okay, I was just like, okay, whoa, trading can be super duper popular. But then after that, I ended up losing profit just buying some stupid stocks that didn't end up going anywhere. So be careful chasing hot stocks. So stocks that are currently making headlines or being heavily promoted are often already way overpriced And the smart money has already made their move to go ahead and exit. Because remember, it's a left to right chart. So it's about who sees it first. And inshallah, I want you guys to see it instantly. And market timing. It's nearly impossible to consistently predict the market's short-term movements. And trying to buy at the absolute bottom and sell at the absolute top is a fool's errand. And time in the market is far more important than timing in the market. So ignoring your plan can sabotage you too. Many investors or traders have a solid plan. You know what you want to do. You know what your criteria consists of, but are you following it? Okay. Panic and greed could really lead you to abandon your trade. Okay. Or even frustration. Just why am I not winning the trade? Not accepting the fact that you lost. Instead of sticking to your steam, clean setup criteria. Okay. If you're struggling, head over to Stackmode.net, but I really do assure you play break and retest. Okay. You can wait for support to be broken, turn into resistance, or you can wait for resistance to be broken, turn into support. Okay. And that's it. Just keep it simple. Okay. Don't destroy yourself over the charts. Please keep it simple. Set a strategy. Okay. Stick to it, regardless of the market noise or whatever's happening. And investing money you can't afford to lose. Never invest your emergency fund or money you need in the next few years. The stock market is for long-term capital that you're comfortable seeing fluctuate. Okay. So opening a brokerage account. A brokerage account is a financial account where you can buy and sell stocks and other securities. Okay, you can't just go to the company and buy shares. You got to go to the broker to facilitate the transaction for you. Okay, so brokers, you can check about their fees, see about their rules, see how their support is. Okay, and then you're going to be able to get a card. Okay, certain of them, like Robinhood, for example, offer a card where you can go ahead and use your day trading profits or whatever profits that you make from the market and withdraw straight on the card. So whatever broker that you want to use, go ahead and use that. Okay. So open your broker. You can start small. Okay. Don't just dump all your money. Okay. Take your time. Make sure you know what trades you want to invest to and do your research. Okay. Even if it's worth it to spend your money on education, mentorship first, and then come into the market. Okay. This way you're not going to have to get your education by just losing over and over again. Okay. So on dollar cost averaging, okay, so the most powerful strategy for beginners. And instead of trying to time the market, you just invest a fixed amount of money at regular intervals. Okay, and this ensures you buy more shares when prices are low and fewer when they're high, averaging out your costs over time. Okay, so make sure you guys know where you're purchasing. Okay, if you're not purchasing at the right time, that could really jurisdict your trade and really just sabotage certain things that you need. Okay, so focus on ETFs and mutual funds. So for your first few years, you can focus on a core portfolio of low-cost index funds or ETFs, okay? That's going to be something to diversify too, especially as you're learning the market. So if you're new into the market, you still don't understand certain day trading while you're getting educated and stuff like that, ETFs can be something that you can look into as well too. Okay, so I wish I looked into more long-term stuff when I first started trading instead of just worrying about the instantaneous profit of like 0 DTE options, okay? So look at long-term stuff because a lot of the time, while you're learning the markets, you can still make money in these long-term plays, and your money a lot of the times is going to be a lot safer versus you just trying to throw yourself head into 0 DTE or something like that, or futures, and then losing everything. Okay, so that's where I wish I corrected myself. Okay, so start now. Okay, there's going to be no time limit, okay, to when you can start or end trading. Okay, you can trade until you pass away. Okay, and you can start trading right now, any age, any time, just start now. Okay, know yourself. Okay, this is why being with God is going to be really important. Already becoming humbled is going to be really important. Okay, you can't be coming with ego. Can't be coming with thinking that you're bigger than the charts. You can't be thinking that you're right and the charts is wrong. Okay, and use the right tools. Okay, TradingView, big tool. Come for mentorship. Okay, I offer a free call where you guys can learn how to trade as well too. And then I'll put a trading plan together. Okay. And patience. Okay. Be patient. Even if you're making $10 from the market. Okay. Stack that up. Okay. And after you withdraw, so whatever amount of money that you withdraw, let's say you make $10. Okay. I like to leave 50% in my account of whatever I made. So I would only put $5 in my account. After that, 30% of whatever I withdrew needs to go to taxes. And that's how I break down my money. So I hope this presentation helped. Stay prayed to God. Keep running. I'll catch you guys in the next one.
When the dollar starts becoming worth less, people start running to assets such as real estate, gold, and silver Today, we're going to talk about how to invest into gold and silver, why you should invest in the gold and silver, and what inflation is, and why people run to asset classes in the first place because the dollar starts failing. Let's jump into it, inshallah. So gold and silver are going to be hard assets that are going to be pretty safe to invest in, especially in an inflationary world where things just get more expensive over time due to the fact that more currency just gets generated over time. So the currency devaluation. So purchasing power is melting over time. So inflation isn't just about prices going up over time. It's about the value of the currency going down. So prices go up to correlate with that. So governments print money to service debt, which dilutes your savings over time. This is why I tell you guys all the time about the asset river. Okay. You want to always try and have your assets and your money flowing in your river. If things logically get more expensive year after year after year after year, then you have to have your assets flowing in a way that your money is always making you more money. Okay. So once again, I'm going to repeat. Your money should always be making you more money. Okay. Don't get outplayed by the certain calculations that just debase in the world normally. If things get more expensive over time, then logically, in order to counteract that, in order to feed yourself and your family, your money should always be making you more money. So we'll talk about the 1971 shift. So that's when Nixon ended the gold standard. And since then, the US dollar has lost over 85% of its purchasing power. And the hidden tax. Inflation helps debtors, which is pretty much just the governments, but it hurts savers. Anybody just stacking up cash in your bank account. If you have just a whole bunch of cash stacked up in your bank account, it's actually doing nothing but hurting you. Okay, even if you've worked overtime for a job before. Okay, you might have seen that you've actually had to pay more in taxes. Okay, the more cash that you have just stacked up stationary, the more that it hurts you. And it transfers wealth from you to the state, which goes back to the government. So in 1920, 1 ounce of gold bought a high-end suite. And today, 1 ounce of gold would be about $2,600. Okay, so it still buys a high-end suite. And the gold stayed constant and the dollar collapsed. Okay, so keep that in mind. The gold stayed constant while the dollar collapsed. So that means that having your money parked in an asset class like real estate, people are always going to need houses. Gold, people are always going to be wearing jewelry. And other asset classes that stay constant and only rise up while the dollar collapses are going to be the asset classes that you want to focus on for the most part. So gold, people call it the ultimate hedge. A lot of the times, if you pull up the chart, you'll see gold year after year after year after year heading in an upwards direction. Okay, it's not stopping. And due to the fact that something has to counteract the dollar. So gold is going to be the human standard that people just use whenever the dollar is crashing or the economy isn't in a good place. So here's why central banks buy it. And central banks are going to be the banks where me and you bank at. Okay, the banks that hold our fiat currency, where we can go pull out our money to pay our bills, go to the ATM, etc. And the fear trade. So gold performs best when real interest rates are negative. And that's when inflation is higher than bond yields. Okay, and central bank demand. So in recent years, China, Russia, and India have been buying record amounts of gold to de-dollarize their reserves. Okay, so they're trying to de-dollarize their reserves in a significant manner. Okay, buying less time storage for their fiat currency and buying more time on their actual currency by investing into assets. Okay, you're doing nothing but losing time if you have more fiat currency. So fiat currency needs to be thrown into the river immediately. Otherwise, you're wasting time. Think of theta on options if you're familiar with that. Over time on a stock options contract, the options expires. Okay, think of your fiat currency the same way. Okay, if rent over year after year after year after year gets more expensive, if 1 year a house cost $200,000, but then 5 years later it costs $500,000, that means that your asset class has to be in a constant river, each and every single one of them. Okay, all your businesses, your profit has to be being reinvested into that. More stocks, more shares, more cryptocurrency. Okay, buying more houses if you're in real estate, etc. Okay, buying more land, and you could do whatever you want with the land. You could farm on the land, pay people to host ATMs on the land. Okay, people could build stores on your land. People could build antennas, cell towers, etc. But when you own assets and you keep stacking up your assets, it gives you a multitude of opportunities to be presented in front of you for your money to just make you more money because you invested in the right things. So volatility. So gold is slow, and it's not for getting rich, it's for staying rich. And it's wealth insurance, not a lottery ticket. Okay, so stacking up gold over time. A lot of people might buy certain jewelry, okay, go smelt it, take it to the jeweler, whatever, and either the jeweler will give them an exchange rate for the gold. So you're going to have multiple ways to invest in the gold too, which we're going to talk about. If you don't want to go the actual physical gold route, you're also going to have the ability to buy things like shares, etc. So let's jump into it. So silver is going to be the industrial hybrid. So it's the green energy paradox. So silver is unique and it acts like money during crisis, but trades like a commodity during booms due to massive industrial use. So as far as conductivity, silver is the most conductive metal on Earth, and it's essential for electronics, 5G, and EVs. So for modern technology, silver is going to be needed. So silver is also going to be something you could invest to too. If you ever see a pullback on the charts or anything like that, silver is going to be an asset class that goes up year after year after year after year very confidently, especially while the dollar is collapsing. And let's talk about the solar boom. So photovoltaic cells, okay, solar panels, consume massive amounts of silver. As the world goes green, demand explodes. Okay, so photovoltaic, okay, that's just solar panels. Solar companies are booming all over America, all over the world, and other countries as well too. Okay, especially countries with less green, less trees, taking advantage of that solar energy. So seeing silver going in an upwards direction year after year after year would make sense. Try to plant your seeds with things that make sense with the future, whether it being putting smiles on people's faces or helping people work throughout the day by day. Silver is needed in absolutely everything. And let's talk about the gold to silver ratio. So it's historically about 15-1. So 15 ounces of silver will give you 1 ounce of gold. And today it's often 80-1. And many argue that silver is undervalued relative to gold. And we'll see how that starts changing, especially during the AI era. When we start seeing robots and certain things start getting developed, the use of silver could go up in an industrial rate. So there's going to be two ways to invest. So you could either have a bunch of bars, whether it be silver bars or gold bars, stacked up. Some people do that, put it in a safe or leave it with the bank, etc. Some people also have jewelry. Buy Rolexes, Audemars Piguets, Pateks, certain chains, real Cuban links, whether it be it bracelets, chains, etc. And some people take it to the smelter, melt down the gold, take that to the jeweler, and then you can go ahead and get some money for that. Or you're going to have the digital way, which is going to be via stocks and ETFs. So you could buy shares that represent gold. So in the stock world, it's going to be the GLD. So if you want to buy gold shares, you'd have to look up GLD. You could also buy gold options as well too. I have some recaps posted on my channel, some wins I've taken on that. Used to trade that a long time ago. And SLV is going to be for silver. And then for miners, as far as the mining industry, in order to mine the asset classes of gold and silver, you can look up GDX. And the pros of them have very high liquidity. A lot of people trade gold, from Forex traders to stock traders, options traders to futures traders. Golden is extremely, extremely popular asset class that's traded. It's low fees. It's easy to hold in the Roth IRA as well too if you just want to buy shares and hold. And the cons, you don't own the actual metal. So if the fund fails, then you have a paper claim, not actual gold. And as far as investing in the miners, it gives you leverage. So if gold is up 10%, miners might go up 30%, but they have risk as far as fuel costs, strikes, etc. And the physical side of everything, you have no counterparty risk, total privacy, and it's useful in extreme disasters. That can be true and also not true. Your house could burn down, etc., and then it could be hard to get to the gold bars. The gold could maybe survive depending on how long it's in the fire, but still, that could be relative to a lot of cases. And cons, you got to worry about security. You can't be letting everyone know that you got a whole bunch of gold bars stacked up. That's not going to be ideal. You got to keep that very private between just you and your family. And storage issues too. When you start stacking up more gold bars, having a safe might be hard if you're trying to move houses or something like that, etc. And it could be hard to sell quickly. You got to go to the smelter, melt it down, and then go to the jeweler, get an exchange rate on that. And they might give you a lower price than you might actually should get because they're trying to make some money too. You know, it's the world. We're all trying to make some money. And tax. So it's often taxed as collectibles too, which is a 28% capital gains in the United States rather than stocks. So a strategic allocation. So how much is going to be enough? So most financial advisors suggest precious metals should be a hedge, not your whole entire piece of the pie. So be conservative, 5%. Okay, it gives you just enough insurance to sleep at night. If you want to have a couple of gold bars in real life, then that would be fine too. And just keeping your asset classes divided in certain scenarios could really help you, especially during hard times. You might not have access to the internet, and you might need to go take the gold bar to someone who could exchange it for either some fiat currency or a car or just an item that you need. So having multiple sources of backup plans for your income is really, really going to help you. And gold pays no dividends. If you do just have the actual gold bars, it just sits there. So try not to just invest 100% of your money into gold, or you're going to miss out on compound interest. And not even interest, but just compound equity curve just in general. Whether you invested into a stock that goes up year after year after year, due to the fact that it's just making tons of profitable decisions, then you don't want to miss out on that. If you have one gold bar, 10 years later, if you don't do anything, if you don't get up and keep grinding and keep hustling, you're not going to have any more gold bars. Okay? But if you invest and put $1,000 into a stock, 10 years later, you could have did nothing and come out with $100,000. Okay, so having your asset classes divided is really going to help you. But there could be a time where you need to pull all your money out of your stock account and you have gold bars and you can exchange that, put it right back in your stock account. So there's going to be different scenarios and different floats, especially jewelry too. If you have any real gold jewelry that you don't care about, I would think about smelting it. Gold is extremely, extremely valuable, and just keep that in consideration. So is it a good hedge? I'm going to go ahead and say yes, but here's to clarify your goal. If you want to get rich, then focus on stocks, business, crypto. And if you want to stay rich and have protection over your purchasing power over decades, gold is going to be an extremely, extremely good standard. And if you want a speculative play to invest into, you could play gold futures. Gold is on Forex. Gold has stocks and shares you could trade. And same thing with silver too. So you could just make your decision in order to protect you over time. Take a look at the chart before you trade. If you're struggling with what to invest in, head over to Stackmode.net. Stay prayers to God. Keep grinding. Catch you guys in the next one.
Let's go ahead and let's talk about what a stock is. So don't go buy at nonsense and invest. This is probably why you're broke in the first place right now. Invest your money into things that are going to go ahead and turn your money into more money. If you want to stop being broke, if you want to stop being poor, if you want to stop having low bills and debt, start using your money to turn it into more money. If you want to be foolish and be a consumer, that's fine. Choose your pick. But life is only getting more expensive, so choose what you want to be on. Okay? Do you want to be someone who's providing, who's succeeding, and is going to be self-sustainable? Or if you want to be someone who's just not self-sustainable, no money in your bank account, and no wealth built or left for anybody around you, it's your choice. So invest. If not, up to you. But here's what a stock is in the first place. So a stock is owning a piece of the company. Okay. So instead of buying the actual product itself, buy the stock. Okay. A stock is going to go ahead and give you a part ownership of that corporation. And that money is going to go ahead and make you more money by buying and holding. So the reason why people even start the stock market in the first place is due to the fact that, or put their company on the stock market, is due to the fact that they want to raise funds for their company. Okay, more funds raised, which means more parts, materials, etc., can be put into the business. Okay, and when that happens, that means the business could potentially get bigger. Okay, and make more money, grow potential wealth. Okay, and the bigger the company gets, the more you'll get rewarded for that. Because since you're a part holder, the share price will go up. Okay, so the share price is going to be the price that pretty much just depicts its number value. And as the share price increases, let's say you bought in at a $39 share price, for example. If it went up to $100, okay, you would make a certain percentage gain depending on how many shares that you have. Okay, so a stock is formally called a share. And each share represents a tiny fraction of the company's assets and earnings. And the company divides its total value into millions of these individual shares. And why the price moves in the first place? So the stock price change based on supply and demand. And when more people want to buy, okay, that means demand is higher than the supply. Then the price goes in an upwards direction, okay? And this demand is driven by expectations of the company's future profits. So the reason why it's going up is becoming more scarce. Okay, so people who already have it or people who are buying into it are either going to be buying at the highs, or if you got into it at the lows, you're going to be holding onto it. And since the company is getting value, you're going to go ahead and be able to make some money based off of that. So why do companies go for public in the first place? Okay, the IPO. So first of all, companies go public due to the fact that it helps raise capital. Okay, once again, more research development funds, more material funds, etc., can be garnered by just putting your company on the stock market. So the primary reason is to generate large amounts of cash for company growth. So it helps you fund research and development, pay off existing company debt, and to expand operations globally. And the money raised does not have to be paid back, unlike a loan. And the initial public offering, the first time a private company sells shares to the public. So before a stock market company can be available to the public, it has to first go through a private investor. Okay, so someone on the back end has to purchase all the shares. Okay, they have to purchase all of it, and then it can go ahead and be available into the company. And after the IPO, the shares trade on an exchange, okay, also known as the New York Stock Exchange, the NASDAQ, S&P 500, etc. And the secondary market is where everyday investors buy and sell to each other. Okay, and this is going to be available on your brokers like Webull, Robinhood, and just the stocks are going to be able to purchase on your phone. So a reason why investing is going to be so powerful is when it gives you your time back. Okay, you can go and put your time into working harder at your business, working harder to developing yourself. Okay, stop being a consumer. Stop spending all this unnecessary money on shoes you can't even afford right now. Okay, some of y'all can't even buy the items that you own twice. If you own items that you can't buy twice, okay, that's not a good look. Okay, it's time to either A, run it up again, or you just have more stuff in like liabilities than assets. And the liability is something that's not making you any capital. It's just something you just spent money on. Okay, so don't make foolish decisions. Okay, stay down. Some people don't know how to stay down, and then people wonder why they're broke. They wonder why they're poor. They wonder why they don't get anywhere, and it's because people don't know how to stay down. Once people start learning how to stay down, they'll stop being broke. Okay, once they realize, okay, my money's a tool. Instead of me being a pansy animal and investing in somebody else's company who just dropped the product to me, instead of me putting money in their pocket, let me put money in my own pocket. Let me invest. Let me build myself up. But some people aren't ready for that. Okay, some people are just always going to be slaves. Okay, they're going to be broke slaves. But if you don't want to be a broke slave, you need to start investing. Okay, if you don't want to be someone who's controlled by just wages and everything, let your money make some money. Okay, God gives us a really beautiful opportunity in order to do that. But if you want to spend your money on nonsense and then not invest, that's going to be fine, because the people who are investing are making substantial income. Okay, I don't want you guys to be broke anymore. So keep investing, keep going, keep building that stash. So, stock terminologies, ticker symbol. The short, unique abbreviation used to identify a stock on an exchange, okay? That's going to be the ticker symbol. You're going to have Apple, okay, AAPL. You got Tesla, TSLA, Google, GOOG, also known as GOOGL. Okay, you're going to have certain other companies as well, too. They're going to be tradable on the stock market, okay? And when you're going to be able to invest in them, you can trade a couple of things. Either A, you can buy shares, which pretty much just give you a piece of the pie, okay, depending on how many shares that you do own. Okay, so shares equal ownership. The reason why I like shares too, I recommend you guys have 2 accounts, okay, or 2 portfolios. One for day trading, okay, whether you're day trading penny stocks or trading stock options, which is where you get paid based off of just directional bias, where you can trade in upwards direction or downwards direction, okay. So instead of having ownership, you're getting paid based off of your correct analysis pretty much with options. So you can either trade stock options or buy shares, or I like to personally do both. Okay, I like to take my options profit and reinvest it back into shares. Okay. So reinvesting your money into a cycle. Your money should be a wheel. It should be a wheel. I'm starting to really understand how everything comes into place. It should be a wheel. The reason why people are broke, the reason why people go down bad is because they don't put their money in a wheel. They don't put it in any type of water. They don't let it flow, and they're not letting their money do anything. Okay. So if you don't invest, you're going to be broke. So voting rights. Owners of common stock typically get 1 vote per share on a major company decisions. Okay. So the more shares that you have too, and especially people who own a large amount of shares, have a lot of jurisdiction when it comes to the company heads and as well as the votes. So the votes go towards who's going to run the company. Okay. And this is going to be a really big thing. Okay. When it comes to certain stock ETFs, exchange traded funds, say you invested like $2 million, right, into an ETF, and you could easily make $70,000 a year just based off investing that $2 million, which you could still withdraw at any time, right? But since you have $2 million in there, you could easily make $70K a year. Okay, you're gonna be able to make $70,000 a year, okay, just by having $2 million invested, okay? And you could live off that for the rest of your life, pretty much. So even if you touch $2 million, you could pretty much never go broke. Okay, going broke is really how you maneuver your money. Okay, I've really been staying down these past few months and just been running up a big bag. Alhamdulillah. Okay, so stay down. When you stay down, you don't buy what you don't need to be buying. When you should start investing, stacking up that money, it runs up quick. Okay, everyone should have at least $10,000. Okay, and if not, it's time to grind. It's time to pray and grind. Okay, but try to get to at least $10,000 in your bank account, in your brokerage account, and in your crypto account if possible. Okay, just spread across. So 2 ways to invest your profits. Okay, you're going to get paid based off of capital gains, and that's when you're pretty much just right. Okay, if you know that something's going to go ahead and go in an upwards direction, let's say you found a really good company that you just believe in, let's say Stackmode, right? Let's say the Stackmode company, let's say I opened it, boom, for example, okay? And let's say it went up, okay? If I got in at the lows at $2 a share, and then price went up to $100 a share, boom, I would go ahead and make some profit based off of that. Okay, so whatever the profit is, you can throw it into a stock calculator, okay, which will go ahead and show you how much profit you're going to go ahead and make too. So this is just getting paid based off of appreciation, okay, which pretty much just means you're getting paid as the stock goes in an upwards direction, as the share price increases, and as the future value increases. And it's making money when you sell a stock for a higher price than you paid for it. So if you bought it at 40 and then you sell it at 100, that's profit. If you bought it at 20, you sell it at 80, that's profit. If you bought it at 10, you sell it at 25, that's profit. Okay. And this is the most common and largest source of return for high growth stocks. And then you can also get paid in something called dividends. Okay. Dividends are going to be a really, really solid way to go ahead and generate income, especially once you have enough money invested into it, where you can receive regular cash payments from the company's profits. Okay. So if you, once again, if you have like $2 million invested into an ETF, okay, you can easily make $70K a year in returns. Okay. For example. So if you invest your money into the right places, you can never go broke. Okay. And they're often reinvested to buy more shares, utilizing compound growth. So you get paid based off of the shares and you're getting paid based off of the dividends. So if you invest in certain things, you're going to be in an extremely good position, inshallah. And the goal is to find companies whose value will grow over time. So some takeaways. So when you own shares, understand that you're going to be the owner. Okay. You can hold shares for 30 years if that's what you want to do. And I actually encourage you guys to hold shares for over 1 year if possible. Okay, when you hold shares for over 1 year, you're actually subject to a lot of long-term tax benefits. And it's going to be really, really good for your portfolio. And you guys are going to get, once again, a lot of benefits for just holding a trade for over a year. Now, when it comes to day trading, okay, the short-term capital gains tax is going to be a little more intense, but this is why you're taking that profit and reinvesting it into something that's going to make you more money, because that way taxes, inshallah, especially when you're making good trades, it should go ahead and all cycle out with each other as long as your money is always being thrown on the hamster wheel. And the secondary market, okay, secondary market is where you trade with other investors, not directly with the company after the IPO. Okay. And the secondary market is going to be the market that we normally trade, that we're able to go ahead and buy shares, buy options, etc. on. And take a look at the business. The stock price follows the success of the company right behind it. And investing is owning a slice of the company's growth and the economy's growth. Okay. Make wise decisions, spend your money wisely, invest. Okay. If you're noticing yourself, you can never afford your bills, Okay, you're spending too much money. Take a look at your bank statements. What are you buying? Okay, take a look at everything that you're wasting your money on. What can be reduced? Are you eating out too much? Okay, if you're eating out too much, it's time to start buying groceries. Okay, the technology that you have, dumb it down. You can't afford it right now. Okay, some of you guys have just things that you just shouldn't have, you know, priorities. And priorities are the reason why people don't get rich, you know, and not everyone is meant to get rich. I'm starting to realize that some people are meant to stay exactly where they are. Not everyone is meant to get wealthy, but if you're interested in getting wealthy, you got to learn to sacrifice. That's going to be one of the main things I can go ahead and tell you. If you're anyone interested in getting wealthy, putting yourself in a better position, putting your family in a better position, you got to sacrifice. Okay. Once again, not everyone is meant to be rich and wealthy. Okay. Not everyone is going to get there, and that's fine. But if you want to get there, sacrifice, stay down where everyone else is out doing nonsense. You have that fun later on. Okay. When you're secure, you're going to be balling, hooping, not stressing. Bills overly paid, stash overly healthy, in stack mode. Okay. While people are out and then they come back home and then they start stressing about bills and stuff like that, letting that real life hit them. And then that's why people go run to things like alcohol, drugs, etc. and stuff like that, because their life just isn't together. So just get your life together. Get your life together. Let your money make some more money and just start living a way better life. All right. Love you guys so much. Head over to stackmode.net for all trading education. I'll catch you in the next one. Stay prayed up to God. Keep grinding. Class, are you guys investing or are you guys gambling like a casino? Let's go and let's talk about the difference between disciplined trader versus the gambler. Each scenario is going to go ahead and represent the scenario that we should be doing, which is A, being disciplined, being humble, not having ego, making sure we're being persistent and consistent within our investment methods. Or a gambler, someone who doesn't play within their risk parameters, does anything, overtrades, is emotional. And let's talk about the difference between the two. And which one are you? So the gambler's mindset. Focus on instant gratification, which is going to destroy you. Anything that comes super quick could definitely be lost extremely quick. Things take time to build, have to be planted like a seed. Okay. And the gambler's mindset, trader and investor, is going to seek quick, massive returns. And they view the market as a zero-sum game of luck, often driven by the excitement of large immediate payouts, instead of thinking of consistently trading the market year after year after year, generating income so they could stop trading effort and exertion for income. Instead, they could make their money, make the money. Instead of having that mindset, they're thinking, okay, let me just make this quick play real quick and try to pull out $10,000 from this trade instantly without any experience or anything like that. And the gambler's mindset trader is going to have irrational hope. They believe they can predict short-term price movements through gut feeling, hype, or just any type of randomness to the trade, ignoring historical data, quantitative metrics, or technical analysis, just buying things based off of the fact that, you know, I think it's going to go up. I think it's going to go up. Okay. And without any true fundamental analysis behind it, make sure you have data behind why you want to get in, whether it be a technical data on the charts or fundamental data. Be like, you know what, this company's doing well. They just put an earnings report out of X, Y, and Z. I think the company's profitable. You know what, I think this dividends PE ratio is going to be worthwhile getting into due to the fact that it's pretty good, okay, compared to other dividends. Okay, so just examples here, but you can go ahead and use logical formations before you just enter in any trade. But the gambler is just going to be entering anything, and you don't want to be doing that. Plot your trades logically and take your time. And they treat capital as lottery tickets. And each investment is seen as an all or nothing bet. Never take your whole check. Never take all of your business income and invest it into one play. Don't do that. Okay, take your time, diversify, have risk into it. And that means that they often risk an unmanageable percentage of their total capital on a single position. Okay, so don't do that. Make sure you guys are controlling where your income is, spread it out, have it in different investments, and keep stacking cash. Okay, and the disciplined trader mindset. Focus on statistical edge. Okay, and they view the market as a long series of probabilistic outcomes, expecting not to win every single trade, but definitely expecting that, you know what, I can only lose the trade when I close too. So having that mindset is really going to keep you in the game. If you're here to trade year after year after year, stocks, cryptocurrencies, etc., go up year after year after year. So the goal is not to win every trade, but to execute a positive expectancy model of over 100 plus trades over the course of a couple of years, gaining data, and then having an edge. And disciplined traders are going to be process oriented. and understand that success is measured by adherence to a predefined trading plan, not by the single outcome of a single trade. So even if you make a whole bunch of money on one trade, you're still going to be disciplined. You're still going to be waking up, praying to God, being consistent, being humble, not losing sight of the plan. Okay, you can't just make $10,000 on one trade, right? Which might happen. Sometimes you catch a gap up and things like that. It might be unintentional money, okay? But you can't do that and then play with a whole different position size the next day that's way over leveraged, not in any calculations of your risk parameters, thinking you're the best trade ever just because you hit one trade. Relax, okay? Withdraw, take a step back, breathe, pray on it, be grateful, and then come back with a logical, process-oriented mindset and make the next trade. And the disciplined trader focuses on capital preservation and just cash preservation in general. And the primary objective is to project existing capital, okay, which is risk management, with profit generation as secondary. Independent outcome and losses are budgeted expenses. So for example, the gambler buys a volatile stock based on a Reddit post, for example, or Instagram post, instead of actually looking at the chart, doing their own statistical and fundamental research, making their own analysis, which you should be doing, expecting it to double overnight, right? And the disciplined trader buys the same stock only after confirming its consolidation near a key support level in a trend, allocating less than 1 to 10% of their capital per trade. Okay, letting their money make the money, letting it stack up, and letting their capital just always generate. So the edge, the chance versus quantifiable advantage. So the gambler's edge. The gambler operates with non-existent or poorly defined methodology, and their decisions are typically random and highly discretionary and impossible to replicate or backtest. And no validation. They never test their strategy. They remember big wins, okay, and have confirmation bias, thinking that, you know what, it's going to do this over and over again. Now, I understand that if you find a strategy that works or some technical analysis that falls into place repeatedly, that's amazing. But don't expect this to work 100% of the time. Don't have an idealistic view of this will work, this will work, this will work. Don't think that you're really going to lose, but be comfortable with losing. You should only be investing in something that you're cool with losing in this way, that if you win, you're not going to be emotional. And same thing if you lose. And that's going to go ahead and be able to cancel out any anxiety or fear that you're having on the markets. So the gambler is going to be following the noise too, and trades based on news headlines, social media chatter, or recommendation from unreliable sources without performing due diligence and doing their own research. Don't do that, okay? Don't be a sheep. Do your research. Make sure you want to invest in something that you believe in, something that you feel a connection to. Be like, you know what? I think this is a good strategy. I think this is a good investment. I think this play is strong. And go ahead and get into it. And unseen rules. Entry and exit rules change mid-trade, and the plan is subjective. So if they say, you know, I'll sell when it feels right, or I'll hold until I'm even, instead of having logical checkpoints where they want to exit their trade and enter their trade. And we'll talk about the disciplined trader edge. The disciplined trader must have a statistically verifiable edge and a set of rules that over time yields a positive expensive T, okay? So their win rate is high, okay? And their average win percentage is high, okay? And even if they take a loss, their whole account is not going to be destroyed due to the fact that being a disciplined trader means that you're not trading with more size than you should be trading with, meaning that even if you lose, your account's not going to be destroyed. Why? Because you're trading between 1 to 10% of your account. And the disciplined trader backtests and optimizes their strategy if anything is wrong. And strategy is going to be rigorously tested and studied and backtested over decades of historical data. And the trader knows the system's maximum drawdowns and expected monthly return range. And the disciplined trader has a written plan. Every scenario is detailed in a formal trading plan. And this documents defined setups and valid market conditions, risk rules, and exit mechanisms. Okay? The trader is going to calculate certain mathematical expectancy of their system, be like, you know what, my win rate is this percentage. There's certain trading journal programs that can go ahead and calculate it. And I'm working on the Stackmode app right now, which is going to help you guys calculate your trade journal as well too. So risk management, annihilation versus preservation. And this is arguably the most critical divergence. And a trader's long-term survival is entirely dependent on rigid risk control, which a gambler fundamentally ignores. So I'll talk about the gambler's capital allocation. So averaging down, they panic when a trade moves against them and buy more to lower their average cost instead of just staying on business on their position. Okay, be like, you know what, I lost. Let me go ahead and have a set place where I should be closing at, and if it exits there or if the price hits there, I'm gonna go ahead and close and exit for a loss. Okay, but instead, when the moves are going against them, they're gonna add more with that gambler's mindset, trying to convert the small loss into a big win. Instead, that small loss just turns into an even bigger loss most of the time, okay? Turning into a catastrophic concentration of risk. And sometimes playing with no stop loss can be bad. So it depends on what you're investing in and how you're investing too. If you're on futures and Forex, you should be trading with stop loss. Why? Because margin call is a thing. You don't want to get margin called by the broker and other broker money. So play with the stop loss, especially if you're on futures and Forex. Okay, stop loss in crypto, you can get away with no stop loss, depending if you're buying and holding. Same thing with ETFs. But for futures and Forex, definitely stop loss. Please do not gamble on futures and Forex, playing with leverage especially. And they believe that the market must come back, all right? And they refuse to accept a small loss, often leading to a margin call or a total account wipeout, which is most of the time only possible on futures and Forex. The gambler is also going to trade with emotional position sizing. And their position size is determined by current emotion or desire for profit, not mathematical risk. And they often risk very, very high percentage of their accounts, 10 to 50% of their account on one trade. And the gambler faces ruination probability. And that's the mathematical certainty of eventual losing all your capital due to oversized losses and emotional decisions. Now let's talk about how to be a disciplined trader. So the disciplined trader position size. So they have a fixed percentage risk. They never risk more than typically a fixed small percentage of their total capital per trade. Okay, so if you have $1,000 in your account, okay, and you're risking 1 to 10% of your account per trade, you're going to risk between $10 and $100 of your account per trade. Okay, keeping your risk in place. And let's say stop loss. So a stop loss is placed before the trade is entered. So once again, especially if you're on futures and Forex, you got to know exactly where you're going to exit at and where you're going to enter at. And it defines the point where the trade idea is invalidated and the risk is contained. And the risk position is sized. So the position size is calculated based on the distance between the entry price and the stop loss, ensuring the monetary risk does not exceed the 1 to 10% rule. And the disciplined trader ensures that even a string of 10 consecutive losses will only deplete the account by 10% if you're trading 1%, but if you lose 10 trades in a row, and I recommend 10%, 5 to 10% of your account if you're more experienced, because 10 trades, then you could destroy your entire account. But you shouldn't be losing 10 trades in a row realistically. Now, research and information processing. The gambler's information flow. Don't want to be trading like a gambler. So the gambler prioritizes novelty and social proof over objective data. Information is consumed for emotional validation rather than strategic input. There's a reason why God says don't gamble. Gambling is wrong. Okay, it's bad. It's the reason why is because you don't have any jurisdiction in it. Okay, you're not trading with any logical output. You're not making monetary decisions with any logical output behind it. Okay, just throwing your money into the void, hoping for the best. This is not what we want to be doing. So hearsay and media hype. So they trade based on unqualified tips, sensational news stories, or expert predictions on cable television. Don't trade like that. Do your own research. Hop on your charts, hop on your broker, make your own analysis and decisions. And superficial charting. They may use rudimentary technical analysis. Okay, so you might draw random lines, okay, but ignore volume, market structure, or context. And their analysis is descriptive, not predictive or actionable. Okay, so you can go ahead and mark out something, right, that may look bullish on the 15-minute, but then on the weekly time frame, it's a whole different story. Okay, so you can't just look at one time frame either. Don't trade like that. Don't just look at one view. Look at the whole global perspective on every single time frame, and then make your decision. So, lagging indicators. So you can only get in indicators after price has already done its thing. So indicators are going to be pretty late. And getting it late is not always going to be a bad thing. Sometimes it's going to make it more confirmed within a trend scenario, but getting in certain indicators is just, it's not going to be it. Okay, like MACD, for example, it's very late. A lot of indicators are just pretty late. They can be used for confirmation, but you don't want to be relying on that. Okay, understand how the wicks work, support and resistance, and read how the chart needs to correlate. So the disciplined trader. So the disciplined trader uses a multifaceted, systematic research process to validate setups that align with their quantifiable edge. Okay, know what you're getting into. If you're going to trade break and retest, you're going to trade some break and retest. If we're going to trade reversals, you get in a reversal. Okay, and get some data behind it. Study your setups, back test it, paper trade it first. Make sure it works before you start putting money into the market. And the disciplined trader is going to utilize a blend of TA, technical analysis. You can go ahead and look at your patterns. If you're looking for break and retest, put your volume into play. make sure it's something people trade, and look at the momentum, okay? See how it's moving. And relevant fundamental analysis, see if it's a profitable stock, see if it's something that trends heavily, to really form a complete picture. And track the events too. Know when earnings is going to be too. You don't want to get into a trade and the earnings is the next day. Okay, that's going to be a form of gambling. Make sure earnings is pretty far away and then make your decision. Even if you're a long-term investor, wait till earnings happens first and then go ahead and get in. And they're going to always be on top of the economic data releases or any stock or company releases that's going on, or any type of negative news that could affect the price movement as well too. Okay, you can over to couple of news sites which lets you fact it, like forexfactory.com. You can fact check and see all the news and the data reports and put that into correlation. That helps a lot with futures, for example. And TradingView, for example, shows you all the stock news, and a lot of brokers do too. And look at the market structure. Focus on the who, what, where, and why of market movements. Why is price making resistance here? Why is price making support here? Okay, ask yourself these questions before you get into the trade. Put everything together in your brain, lock it in, and then go ahead and make your trade. And work on the directional bias of the higher time frames. Feel like, okay, I want to get in the trade here because of X, Y, and Z, and then make your decisions. And the trader's analysis really answers, okay, why do I want to get in here? Okay, what's my maximum loss? And I understand we're on the charts trying to make some money, but don't lose yourself, okay? Take your time, build up your capital, be disciplined. Because if you full port your account in one trade trying to make some money, you're going to be wishing that you were disciplined and you took your time. So I'm telling you guys, being disciplined is going to be the most worthwhile decision in the long run. So impulse versus automation. So the gambler is going to be trading based off of impulse. You got to pretty much be a robot if you want to be a successful trader. So the gambler is going to be chasing the market, entering super duper late on big giant candles, getting in the trend late and just missing the whole thing. Okay, and getting pulled back on, getting wicked back on, and just living in drawdown. And they often buy at the high or sell at the super low after the move is already completed, catching the final remaining scraps and pieces. Okay, so revenge trading. After a loss, they immediately enter a new larger position to win back the money. And this is the fastest way to accelerate capital loss. Okay, don't do that. Okay, don't do that. You take your loss, you gotta get off. Okay, plan yourself a better trade. Be like, why did I get into this trade? Did this trade really make sense? Okay, and if it did, okay, cool. Accept that loss. Take a better one. Okay, or try again. Play something with better volume. Okay, there's probably some reasons why the trade didn't work out. Because if you notice, once you start playing S plus setups, they're gonna work out a large percentage of the time. Not every time, but a very, very, very large percentage of the time. So ask yourself, why did I lose before you just get into the trade again, trying to make some money back? And keep a record too, okay? Know how much you're making, know how much you're losing, know how consistent you are, because it's really gonna help you go back and see, well, I've been slamming, well, I've been crushing it. And a lot of brokers keep track of that, but you guys can keep track of it too. So the disciplined trader, you gotta be like a robot in the game. You gotta get up, be a robot, okay, grind. And the most disciplined person, the most robotic person when it comes to keeping their emotions stable is gonna win, okay? You can't be letting fatigue, emotions, anger, fear, anxiety, and none of that get to you. Okay, you got to be a boss, stand on business, and get to it. And execution is for a disciplined trader, and it's robotic and unemotional. And the moment the trade is entered, all necessary parameters, the stop loss and the target are set. And strict adherence. Traders are only taken when the market offers a setup that perfectly matches the criteria in the written plan. Okay, the edge. And let's talk about the trade journal. Every single trade is logged with the entry, exit, reasoning, psychological state, and a chart screenshot. And this data is used to iteratively improve the edge over time. Okay, you can go back, be like, whoa, okay, I was crushing it here. Let me stick to this. Why am I changing it up? Let me invest into this. Okay, this led me to a positive equity curve at the end of the year. Okay, let me stick to this. Okay, it's gonna help you guys keep your data. And you're gonna have a positive expectancy focus, wanting to crush your goals and be a better you and just be better every single day. And you'll understand that the goal is not $10,000 profit today, but the statistical certainty that $10,000 will be achieved by repeating the process over a period of growing your seed, stacking wins, stack mode. Okay, take your time. Okay, it's not a race, it's a marathon. And be in the game for decades, years. Okay, don't just lose your account overnight trying to make a FOMO trade. Relax, be disciplined. I'm telling you, it's gonna be worth it to be disciplined. When you're chilling on the beach, when you're driving in the Lamb, when you're doing what you wanna do, when you're chilling in your house, okay, when you're put up because you stayed down and you were in stack mode, you're gonna be cheesing hard. okay, it's going to be worth it, inshallah. So let's say, for example, the trader reviews their journal and finds their system has an 80% win rate, okay, on Tuesdays. And they use their objective data to confirm their edge. Let's say news is on Tuesdays and they notice that the news correlates with their edge, and then they go ahead and keep trading that, and they find a profitable way to make some money, for example. And let's say the gambler, okay, they review their account statement, sees a negative balance, leading to frustration, more reckless trading, booting up their account more, whole check into it, okay, and just losing their whole mindset, okay, and not sticking to a consistent edge, which is going to help you grow your account over and over again, okay. Take your time. So, psychological mastery, detachment versus attachment. Trading is 80% psychology. I'd really say like 90%, okay? Because there's been times you can really give someone really good levels, and if they don't know when to close, or if they're greedy, they can still destroy it all, okay? So the final differentiation lies in how losses and profits are internalized. So the gambler, they're really attached to the outcome, okay? They have way too much greed. They're fiending to win every single trade, and they're very impatient, wanting to make a trade every single day too. You're not gonna trade every single day. It's not realistic. They close profitable trades early too, destroying the risk to reward because of the fact that they're scared, okay? It's why you gotta trust God, okay? Relax, okay? Only trade with what you're okay with losing. You're gonna be cool. Let the trade play out, and if you see something, believe in it. And they hold losing trades for too long, okay? Now, if you see your trades going in the opposite direction and it's way past your stop loss, okay, you could go ahead and close your trade, especially if it's way past your stop loss. You got to. Don't hold something that's clearly not gonna go ahead and reverse anytime soon. That's ego trading. And that's viewing losses as a personal failure or an indictment of their intelligence. And this fuels revenge trading and their need to prove the market wrong, which can lead you to throwing more funds into a loss. And mood swings. They experiences extreme emotional volatility with deep euphoria on wins, okay, extremely happy, cheesing hard, jumping up and down. But then when they lose, crashing out, sad, okay? Be stoic. Whether you win or lose, just keep going. Stack mode, put 50% away, keep 50% in your account, keep stacking it up, keep going, go on to the next trade, okay? Keep getting richer, keep getting better. And the disciplined trader, they're attached to the outcomes. They have a sense of neutrality built into them, okay? And you gotta accept that a single trade is meaningless. Even if you make way more money on one trade than the other, that doesn't mean that that trade was better than the other. Did you stick to your process? Did you stick to your rules? Were you grateful, okay? And stay humble after your wins. It's really going to keep you guys focused on the process, which is really going to get you to the next level, inshallah. So the focus is on executing the edge perfectly, regardless of the P&L, profit and loss, and learning from losses. A views of a losing trade that adhere to the plan at a successful win, okay? So even if you didn't make any money on the trade, if you stuck to your entry plan, you stuck to your stop loss, you saw what you needed to see and it just didn't work out, that's a win, okay? Keep yourself mentally balanced, keep yourself mentally good, and understand that losses in life and on the market are just tuition for you to learn from experience and go forward, okay? And objectify, okay? They use if-then statements to govern their actions. If price has stop loss, then they're gonna exit. If price turns resistance into support and they're looking for a long, they're gonna enter, okay? If price hits resistance, they're gonna exit, okay? So you guys are gonna go ahead and have some parameters set, like, you know, if price does X, Y, and Z, I'm going to do X, Y, and Z, okay? And that's going to help you trade logistically, robotically, and play the chess moves correctly. And mental discipline is going to be important. The disciplined trader sees a loss, not as I just lost $1,000, but I just incurred a 1R loss. You know what? It's okay, which is budgeted. I planned for this, and it's statistically necessary for the system to eventually produce 2R, 3R wins. Okay, so when you lose that 1,000, but then you make 4,000, you're not gonna be mad. You're gonna be like, you know what? I'm happy I only lost 1,000. I'm glad I didn't just risk my whole $10,000 account trying to make a whole play. Okay, because I just stayed within my risk, caught a nice trade, and I didn't blow my account even though I took a loss, and I made it back the right way. So don't be a gambler. Gamblers are driven by emotion. Don't be drinking alcohol. Don't be doing nonsense. Don't be trading with the mindset of, you know what, I'm going to come on and make some money. Nah, come on with the market and be like, you know what, I'm going to make some good financial decisions. I'm going to come onto the market. I'm going to enter because I have some logical parameters on why I'm about to enter. I'm going to enter because support is at this area here. You know what, price doesn't want to go below here. This is safe. Let me go ahead and take this trade here. Oh, resistance just turned into support. Let me take this trade here, okay? Take the money out of the picture. Focus on the charts. Take your focus off the P&L too, okay? Get your eyeballs off the P&L. Don't be staring at that. Look at the chart. And the discipline trader, focus on statistics. Focus on getting better, okay? Understanding that the ability to even trade in itself and make some money just looking at the screen is a blessing. Okay, straight from God. God is great. Okay, so let's go hard. Let's keep going. Let's keep pushing harder than ever. So don't focus on the money. Professionals focus on the process, the discipline behind it. And to succeed, you must first manage your risk, and only then can you manage your profits. Stay prayed up to God, keep grinding, and head over to Stackmode.net for all trading education. Catch you in the next one. Peace. All right, let's talk about how to buy stocks in crypto at the right time. So we'll talk about trend trading and we'll talk about pullback trading. So both are going to be great ways in order to make some profit, both used in different scenarios. And we'll talk about pullback trading first. So pullback trading is going to be when you're buying at an area below where current price already is. So if price is going in an uptrend, you can just wait for price to come back down, buy it again, and take it back up. Okay, this way you could catch an even bigger trade, catch larger profits, and you might even be able to sit on your trade with a lot more safety too, due to the fact that price already dipped. And we know that the stock market and crypto markets are markets where people want to go ahead and hold and gain APY per year. That stands for annual percentage yield. So people are trying to gain APY on their money. I know I definitely am, by holding in something that has value, whether it be in a cryptocurrency that has value or a stock that has value. Okay, so you invest in the future, buy at certain lows, and let's go ahead and let's talk about how we can identify certain lows and how we can buy at these certain areas. So let's go. So first thing we're going to go ahead and have to do is hop on our higher time frames. Higher time frames are going to be important. We got to see everything. We cannot be tunnel vision on the smaller time frames. Okay, if you're on the minute time frame, you might see a downtrend, but then whole time when you're on the daily time frame or weekly, you'll see the trade going up in an upwards direction month after month, week after week, year after year. So make sure you're on your higher time frames, doing your analysis before you scale down. You can use your smaller time frames, but you can really just use them in order to get in at your entry. Okay, so you can use like your 1 minute to get in at your entry, but all your analysis for the most part should come from these two key time frames. They should come from the daily, and they should come from the 4 hour. Daily and the 4 hour are going to be your two time frames that you're going to have to use in order to catch some profitable trades. You've got to see the real trend. So the daily is going to come in play, and then the 4 hour time frame is going to be used in order to show you any candlesticks that you can't see on the daily. Okay, due to the fact that stock market is only Monday through Friday. So sometimes extending trading hours is going to have to come into play. So your 4 hour is going to show you certain candlesticks that you might not be able to see using only the daily candlesticks. Okay, so that's your 4 hours going to have to come into play. And then you could scale down to your 30 minute as well. Okay, personally, I like to go down to that after my 4 hour too, just to verify my entry on an even smaller time frame. Make sure everything correlates, make sure it all lines up before I get in a trade. I'm not going to risk my bread doing anything on the block. I'm going to make sure that playing structured trades that have logistical planning behind them. Okay, one of them making sure we're making some bread in the markets, not wasting money that we've worked hard for. Okay, so buying pullbacks are going to be extremely important. Stop buying at all-time highs. Okay, don't hop on Twitter, don't hop on Instagram, YouTube, or anywhere and see hype being talked about. Okay, a lot of people are just now buying in Nvidia, for example, and a lot of times by the time things are being posted, stuff is probably already at all-time highs. Okay, by the time media gets things, it's already too late for the most part. So here's how to identify real dips. So one, use your daily time frame and see where current price is at in the first place. Okay, current price is at all-time highs, you have to wait for a pullback. Okay, don't buy at all-time highs, because one, think of it logically. People got in way over here to the left. Okay, some people have been holding these trades for years, way over here. Okay, they're going to sell eventually. So anytime price makes an area of resistance and falls in a downwards direction, all it is people taking their bread off the market. Okay, nobody's about to sit and hold for an unlimited period of time. Once people are up some profits, 1000% plus, okay, people are going to be like, you know what, these are some great gains. Let me go ahead and take some money on off. Okay, especially when they went holding for a few years, definitely down to go ahead and get paid. Okay, it's a lot of money increase within these past couple of years. Okay, if you've held Nvidia for 5 years, for example, could have got in at around $50 a share. Okay, and price today is at $252 a share. Okay, so that's almost a 4x of your money. Okay, so you can put your money in a shares calculator too to go ahead and check everything out and see the actual percentage yield you would have gone ahead and returned based off of that. Okay, so prices at all-time highs. Don't buy at all-time highs. wait for price to pull back. Okay, so you're going to be looking for two things on a pullback. You're going to be looking at an area of support to be touched again. Okay, price can either mirror supports, okay, the same support area that it bounced off of another time, or it's going to go ahead, bounce down, and try and turn an area of resistance below current price into support. Okay. And that's primarily where your pullback areas are going to come from. It's either going to be an area of support below current price or an area of resistance below current price that you see on your 4-hour or daily time frames. Okay. So my daily time frame, I can see where all-time highs. Let me go ahead and put a line here at the top of all-time highs resistance. Let me get on my 4-hour time frame, zoom out. Okay, and let's go ahead and identify how we can find the best levels here. So stocks is going to be a bit different. I'm going to go to my indicators here. Turn on that market open marker indicator here, the one by Charmeager. Okay, then from here, I can get on my 30-minute time frame. Okay. So I'm going to go ahead and look at areas in between these green shaded boxes. This is going to be for stock market. Okay, cryptocurrency is going to be a little bit of a different analysis. But for stocks, this is how it's going to go. Look at these green shaded areas. I'm going to go ahead and put lines at the 9:30 a.m. areas. Okay, so it's showing when market opens. Market opens at 9:30 a.m. Eastern time. Okay, hence it's why it's called the New York Stock Exchange. Okay, everything is based off of Eastern time. New York is in Eastern time. So I'm going to look below current price. Okay, current price right now is going to be 253. So I'm going to look at 9:30 levels below current price, expecting price to go down to these levels and give me a bounce back up. Okay, so let's go and let's mark some levels. So let's jump into it. So I'm going to stay on my 30-minute time frame, and I'm going to look below current price at certain levels that I'm going to be paying attention to. Okay. So I have a 9:30 level right here too. Boom. Go. And just check the direction and the flow of where the chart is going. Okay. If you can't tell which way the direction is going from the candlestick, then you feel free to hop down to something like your 15-minute time frame, where you can see things a little bit more cordially. Okay. So let's say I delete everything here. Okay. Price is at 253. I look below current price. Okay. Have this area of support right here. And that matches this area of support over here. Okay. So we know that this could be a potential area right here. Now I'm going to keep looking at areas below current price. Have this area of support down here. Area of support down here. And even down here. Okay, as you can see, some of these areas are going to line up with each other. Okay, the more areas that you see line up with each other, the more probable that area is going to be tapped again, inshallah. Okay, so use your past information as data. So we have this area down here too. So, and you can even go down to your 5-minute too to see things just a little bit closer, just to verify that these 9:30 levels are exactly what you're looking at. Okay. Nice, so right here, up here, okay, very, very clean. We're going to put a line down here. Looking below current price here. Have an area of resistance right here. And area of support down here. Yeah. Then I can go to my 4-hour time frame, and I can wait for price to pull back to any of these levels. Okay. So if I see price pull back to any of these levels, I can be like, okay, you know what? I'm going to go ahead and trust that price wants to potentially give me a retest off of any of these areas here. Okay, these are all 930 areas here that are going to be extremely just key levels here. 930 levels are going to be important because it's when market opens. Okay, when market opens, everyone's excited. There's going to be a large rush, and that's going to be the time where the most orders are going to be in place. So Eastern traders are trading, okay, or American traders in general, and European traders are both trading in the same session. Okay, so a lot of the time, the volume is going to be extremely high. Okay, so if you've heard of London session, that's going to include New York session during this time. So for stocks, that's going to be an easy trick in order to find the cleanest areas of support and resistance in order to identify where you want price to pull back. So if price pulls back to any of these levels, okay, and personally, I like to wait for a 4-hour close. Okay, so 4-hour close is going to mean I'm never going to really take the first wick like this, how price tapped the black line and then went up. I don't normally take the first wick. I'll take something like this, the second wick, or the second candlestick with a wick above where my zone is. This way I know that price truly wants to reverse in an upward direction, potentially, inshallah. Okay, but if you take the first wick, you can easily just get destroyed. You can get pulled back on, and then you can be upset and be like, you know what, dang, I shouldn't have taken that trade. You know, I didn't know if it was ready. And you don't want to be getting pulled back on for no reason. Okay, so take your time, let the trade verify itself, and catch the whole sweep in upwards direction. Okay, so let's go over another example here. And this works for all stocks, all popular stocks. And we'll talk about a trend trading example here. Okay, so when you're trading with the trend too, it's going to be a lot of volume. What volume is going to be? It's going to be the amount of people trading. Okay, so when there's a lot of people trading, your trading should happen in a quick direction. Okay, because everyone's expecting price to go in the direction in which your trade is planned in. Okay, so let's do it. So if I got on my 5-minute time frame here, I got on my market open marker. I'm gonna look above current price. I'm gonna go ahead and mark this area of support here. Okay. Okay, just so we have this area here as data. I got this area up here. It's gonna represent some resistance. Okay. Market to the support area right here. Breakout area in between it, very clean. Okay. We have this area up here that matches with this area. Okay, so as you can see, one area of resistance right here matches with another area of 930 resistance here. Okay, the more taps, the better. Okay, more taps, the better. And as you can see, we have a tap here from previous levels. So we know that these levels are going to be probable. A lot of levels here working out. Extremely nice. I'm going to go ahead and put a line here at this area of resistance. So you can see price went in a downwards direction. Okay, so that's why I put it at the top, signaling where the resistance is. Another candlestick wicking off of previous data. Okay, so the more data that we see, the more probable we know the trade is going to be, inshallah. So up here, resistance as well too. We got right here an area of support. Okay, because we know price is going in upwards flow here, and then price bounced off there of support again. Okay, so take your time when you're reading the chart. You can do this on your 5-minute time frame too. Okay, it's easy to read. This area of resistance kind of close right here. Yep. And then if you run out of candlesticks or if you don't have premium data, then you could go back and do like the 15-minute stuff like that. But I know not everyone has that, so yeah, just read your higher time frames as best you can. And then, yeah, waiting for price to pull back to these zones here. I'm going to put this area here. Yeah, so these are going to be just very clean areas that I'm going to be relying on. As you can see, the more taps that we have, especially on past lines, the better. Okay, another tap right here. Another tap right here. Okay, so you can see all these taps are reacting off of each other. Once you do these levels once, you're going to be good. You don't have to continue to do them all over again. Okay, they're going to be here for you. Okay, and you can just update them as price decides to go ahead and continue
in an upwards or downwards direction. Okay, so right here, and as you can see, another area of resistance being reacted off of right here. Okay, so after you do all your levels like that, you can go back to current price, go back to your higher time frames, and you can check everything out. Okay, so say I'm on Amazon here. Okay, I can either wait for price to get above, let's say, this black line here. Okay, I can wait for price to break and retest and take it up to this area here. Okay, take this as first take profit, and then I could take up here as the second one. Okay, if I wanted to. Okay, so you can be very flexible once you have your levels down. Okay, even if price decides to come down, give me a pullback off of here, that'd be fine. Okay, or even if price goes up and gives me a pullback at this level, that'd be valid. Okay, so even if price gets above these black lines and gives you a pullback, that's going to be valid. So whether you pay the head break and retest or wait for price to pull even back further, okay, it's going to be just up to you depending on the market. And once you have your levels down, you're going to be good. You're going to have your information. You're going to know what to do, and you're not going to be panicking. Okay, so I also have this strong area right here too. This is the 30. Yep. But then you could check your 4-hour time frame too. Just scan it all. Make sure everything makes sense. Okay, so I can see. Yep. So I can see, okay, price wants to potentially come back to these levels here. If I see price give me a 4-hour close above or below these levels, then I'm going to be like, okay, these are going to be some clean levels. Okay, so let's go over another example here. So we'll do Google. Or actually, you know what? We'll do Tesla. Okay, big stock. I know a lot of people like to invest in that. Let's do it. So starting off on my daily time frame here, it's going to give you my bird's eye view for absolutely everything. Okay, it's going to help me see what I need to see. Okay, it's going to help me put everything into a global perspective. So when it comes to the global stock market and cryptocurrency, I know that price is trying to go in an upwards direction. Okay, due to the fact that companies aren't putting in hard work for their stock to not go up in value. Okay, there's dividends and company owners get paid more depending on their share status. Okay, so billionaires and stuff like that. It's not $1 billion in a bank account. There's not bank accounts that can really hold like hundreds of millions of dollars and stuff like that. So a lot of the time it comes from a person's company share value is what makes them a billionaire. Okay, so not the pure fiat cash value. So knowing that, we know that the value of certain currencies are trying to go up, whether it be it a cryptocurrency or a stock, okay, like Tesla. It's always trying to innovate, always trying to get better, and always trying to improve with these things down here called financial earnings. Financial earnings are letting you know if a company is profitable or not. And if a company is beating these, like slamming these year after year, month after month, making bread, you know it's going to be a good company. Okay, sometimes Tesla beats earnings, and sometimes it misses it. It can be inconsistent, but then you'll take a company like Nvidia, for example, that consistently beats earnings over and over again. Okay. So I'm not saying things that don't beat earnings consistently are going to be bad investments, just they can have more fluctuations due to the fact that the earnings are going to be negative sometimes. So still, same logic stands. Price is trying to hunt the area of resistance above current price. Okay, so we know it's trying to hit this all-time highs here because it's trying to make some new all-time highs. This price is trying to keep going. It's not trying to stay in the same place. Okay, it's just like real life. So you can see from 2018, shares were $20 a share. Now they're $434 a share. Okay, many millionaires were made by just buying and holding. Okay, so all it takes is just a couple of years of buying and holding. M's will be made. Okay, but just like the plays I've been really just researching and really just planning yourself in the future, we have opportunities over and over again. Okay, during this Tesla time, you know, Apple coming out with AirPods, Face ID and stuff like that, 2016, 2013, a lot of millionaires made there. Okay, there's always going to be an opportunity. There's going to be a lot of new AI companies, inshallah, hitting the stock market soon. Okay, so any good AI companies hitting the stock market will definitely go ahead and be good play. Okay, so investing in the future, depending on whenever you're watching this, is going to go ahead and be important. Just keep investing into the future. Whatever time period you're in, invest into the future. Okay, as of 2025, cryptocurrency and AI are two things that's really innovating anything forward. So Nvidia, for example, has been going in a very bullish standpoint due to the fact that AI chips are produced from it. Okay, so anything AI related as of like 2025, it's going to be extremely popular. Okay, so cryptocurrency is also going to be something that's popular too. So brokers like Robinhood, okay, as of 2025, has able to shot up, okay, within a pretty instantaneous standpoint. So due to the fact that people know that it's a great company, okay, people need it in order to trade, okay, and it's very, very user friendly. Okay, so people invested into the future and make some money with the share. So we know that price is trying to always hunt new resistances and break out from those resistances. Okay, you can even see this resistance right here. Go to my 4 hour. You can see right here. Price created an area of resistance right here. And as you can see, resistance got broken and turned into support right here. Amazing break and retest. And then price decided to go up in this upwards direction. Okay, we filled this area of resistance up here. Okay. And we're trying to fill this area of resistance into this area of resistance all the way up here. Okay, extremely, extremely nice. And we see which way price wants to head. All the way up here to all-time highs. So here's how to trade pullback levels, even if price is all the way up here. So same thing I would do, just like before. I could go to my 5-minute time frame. And I can go back as far as I possibly can. So on the 5-minute time frame, let me go all the way back. I'm going to start placing out levels below current price. So my current price is currently 436.32. Okay, 436.32. We look below current price. Mark this area of support. Why? Because it's below current price. Same right thing right here. Mark this area of support because it's below current price. So I'm going to stay on the 5-minute time frame. Keep marking areas of resistance. Okay, area of resistance right here too. I'm going to keep marking areas of resistance or support. Okay, depending on the direction of the candlestick. Okay, so if I see price going in a downward direction after the 930 candlestick, then I can assume that the top of the candlestick is going to be where the level started. Okay, so put it where the level started. As you can see, you're going to have correlations. One tap right here where price decides to fall downward, and a whole another tap right here. Okay, so price a lot of times will mirror itself too. That's what makes trading simple. Okay, have your levels marked out, and you're the only thing that can self-sabotage anything. Okay, everything's already done for you. So look, the resistance here was created, did it again a couple of days later. Okay, it's double resistance mirror. Okay, and as you can see, price got broken, turned into support, and then price filled up to the next area up here. Okay, that's a 4-point trade. 4-point trade is very nice money on it. Okay, especially on Tesla. It's crazy money. Okay, times on Tesla, I've been in a trade for like 2 minutes, like 3 figures, and just instantly closed. Okay, and just stuff like that. Okay, so yeah, especially my early days. So yeah, Tesla, it can be wild. But when you start playing it logically, like I was just playing like a fool, okay, when you actually play it how it's supposed to be played with levels and just all your analytics down, it's going to be lethal. Okay, it's a great way to make some just profit. So these day trades, especially when you have all these levels down, it's going to be really clean. So right here, we have this area of resistance. And just go as far as you can with the 5-minute time frame here. Down here, key area of support. It's literally going to give us the best levels here. Okay, the key levels that we got to be paying attention to. Okay, and then price decided to go in an upward direction here. Price created resistance here, fell down. Price created support down here, went up. Resistance right here. Another support down here. Support. or not resistance, not support. Price went up. And then breakout in between that level 2. Really nice level there. 930 support right here. Price went upward direction, so bottom of the candlestick. And we have another high up here. And even up here. Area of resistance. So the more levels we have filling in the space is going to be just the better. Okay, bottom right here. Okay, and then I'm going to have this area right here too, where price decides to go in the downwards direction. And then down here. Yep, this area right here. Okay, and then let me go ahead and mark this area right here too. So let's just say I did all these levels, for example. I can go to my 4-hour, check everything out here, okay? So I can know that, okay, if price pulls back to any of these levels here, okay, I could potentially go ahead and take a day trade, okay? So even if price decides to give you some break and retest, okay, you can also take trades based on that too. Okay, so either that or wait for price to just pull back to these levels simply. Once again, all-time highs all the way up there. So you can just wait for price to pull back to any of these levels, give you a 4-hour close, and then go ahead and take your trade. Okay, in between here, this whole gray space, I would just go on like your higher time frames, go to the left. Since the price action is too old, even on 30-minute, it can be too old. If you're not a premium user, and just put it on the best levels you can. So at the top of the resistance here from the 30. Top of the resistance here from the 30. Okay, which lines up with this one. Okay, got the bottom right here. Price went in upwards direction. 930. 930 resistance up here. 930 support. Not resistance, actually. Price support right here. There we go. And a lot of these levels, once again, are gonna correlate for sure. Okay. There we go. So then from there, after you have all your key levels down, okay, you have all your information. So even if market decides to go in a bear market, okay, if you see a sweep from any of these levels below current price, okay, then you know, like, you know what, this is actually going to be a pretty decent buy area. Let me go ahead and take my chances. Okay, you can check out your levels too on your 30-minute time frame. Okay, just make sure everything looks how it's supposed to. But if price goes down, gives you a 4-hour close from one of these sweep areas, then go ahead and take the trade and show up. Okay, let's go over some crypto examples. So crypto is going to pretty much be the same for the most part. Only thing on crypto is that you can't do the 930 strategy. For the most part, you have to primarily just use your daily in your 4-hour time frame, which is still going to be extremely strong. But yeah, let's go and let's cover it. So we'll cover Bitcoin first, for example. So Bitcoin. Okay, if I wanted to read Bitcoin, start off on my daily time frame, just like I always would. I'm going to be putting a line at all-time highs because I know people wanted to break all-time highs in order for price in order to progress in a bullish scenario. Okay, so think of it from a human standpoint. People want to just see numbers go up. So I know that my goal is always going to be all-time highs. Okay, now on the daily time frame, I'm going to go ahead and analyze certain setups. Okay. So I can go ahead and see, okay, price has this area of support down here. Okay, price might want to feel this area of support right here. Okay, So waiting for the right time, waiting for pullbacks, it's going to be important. Okay. So we don't want to just buy willy-nilly. Okay. We're going to see, okay, was price want to break this trend line? Okay. If it does, then we know the support wants to get reached. Okay. Then you'll see if the support will be held or broken. Okay. If support gets broken, then you're also going to be able to, pull back to the next level. Okay. And you can use your 4-hour and your daily levels. Crypto is also going to have a lot more levels too, because it's 24/7. So, but still, areas of support are going to be valid, because you can see this right here. Check it. Look at this area of support all the way over here. Bounced once, came down to the area of support, bounced again. Okay. And then came back a couple months later, bounced again from the same area. Okay, so on crypto, supports can also be extremely powerful and strong in order when making your TA. Yep, and we're always going to be waiting on our 4-hour candle close. So yeah, 4-hour candle close is just going to give us a good jurisdiction, like, you know what, this is a good trade. And you can see the timer all the way to the right, and whatever broker you're on too. So yeah. So after that, you can go ahead and see, okay, you know what, price created this ultimate level. Okay, but price doesn't always have to come down to an area of support. Okay, once again, it can stop in an area of resistance. Okay, it can turn resistance to support, and then it can go ahead and bounce. Okay. So plot out your trades neatly. Okay, make sure it's a strong area of resistance that you think is going to be successful. Okay, take this example. This area right here of resistance decided to get broken, and it turned into support right here. Okay, clean. Okay, break and retest, extremely clean. So I could, once again, try to buy at the areas of support below current price, okay, and see if price wants to give me the same bounce. Or I'm looking below current price and marking areas of resistance that are going to be strong and heavy, and seeing if price wants to give me a retest level. Okay, check this out. Area of resistance 1 and resistance 2. Okay, guess what? Price broke out of the resistance over here, break and retest. Okay, and then price continue in the upwards direction. Okay, and same thing over here. After price support mirrored here, all it did was do it again. So support mirror. Okay, price will mimic itself. It's just about finding the key good reactions. Okay, and that's when the price did it, it decided to blast off. Why? Because when price did it right here, it blasted off. Okay, so just know what you're investing into and know where. Knowing where is going to send you to a different realm. Okay, you're really going to understand what's going on when you know where to get in and where to exit. Okay, those are going to be the two most important things other than risk management when it comes to these charts, is knowing what to get in and knowing what to exit. Okay, you cannot be cooking your trades, holding way too long for no reason. Okay, so that's how you find pullback levels even without the 930 strategy. Okay, or you can wait for an area above current price to be broken, turn it to support. Okay, and that's going to be trading with the flow. Okay, and it's going to be different depending on what your goal is. So if you're trying to hold a cryptocurrency for years, then trading with the flow like that might be different than trading pullbacks. Okay, because you want to be buying at the lows. Okay, you're expecting to hold for years. Okay, so when price is dumping, you should be happy. Okay, but if you're a day trader, option trader, or just a trend trader in general, okay, then you might want to wait for resistance to be broken. So this is support. Okay, make sure you can trust the trade, okay, and let it rock out, let it do its thing. All right. Yep, resistances below current price. We're going to go ahead and do, because we know resistance can be broken and turn into support. And then we're also going to do sometimes the supports. Let's check this out. Amazing example on XRP. So right here, as you can see, this low right here got met up with this low right here. Okay, so supports a lot of the times we'll try to meet, especially if it's a bear scenario. Now, will it not break is another question, but a lot of the times Chicago support and certain things like that within the stock exchange is really going to be imperative. Okay, so look at the support, look at the key levels, and make sure everything just makes sense. Okay, so look at the bull. Okay, so bull. Okay, so think of the Chicago Bulls, think of a U. A lot of the time your trade is going to go ahead and look like a U. Okay, it's going to look like a horn. So your sweeps, whether in a downward scenario, okay, price might try to sweep down, meet the supports, okay, bullhorn down. Or in an upside formation, price might try to meet these areas of support here, and then sweep to an upwards direction up here, okay? So an upwards U, okay? So price can go up in that direction or go down in a certain direction, okay? So if it just hit an area of resistance and it's falling in a downwards direction, price might be trying to hit an area of support below current price to try and meet at, and then try and bounce again like it's doing here. Or it's going to try and find an area of resistance below current price and try and bounce there due to the fact that resistance can be broken and turn into support. Okay, so it's about catching the flow and just making sure that we're trading the right things properly. Okay, so it'll be trying to bull rush down, okay, to an area of support or resistance, just so people can buy it again. Okay, because on the daily time frame, just like we talked about in the beginning, if I zoom out, price is nowhere near where it was like a couple years ago. Okay, 2022, price was at 0.30. Okay, and price now is at 2.8. Okay, really big jump in XRP. Okay, over the course of a couple of years. Okay, so it's just about where you're buying, catching the sweeps, and holding your positions, even though certain things are going to take time. Okay. So let's go and check out this example here. So you know price once again is going to try and hunt certain areas of supports, just like the other cryptocurrency we just looked at. Price decided to hunt the area of support that was right here and bounce at the area again. Okay, and we are getting some 4-hour closes, so we'll see if it wants to hold. Okay, but in this instance here, you could also wait for an area of support above current price to be invalidated. Okay, so this area of support, and if support below current price gets ran through, or if support below current price gets turned into resistance and then ran through, okay, then that area could be a decent area. Okay, so I get on my 30-minute here, see the strong area of support. Okay, price has the potential, and you could see some support candles here too. Okay. Price has the potential to break above this area and give it a support mirror. Okay, so I call this inverse break and retest, and price can definitely do this too. Let's say it wants to go ahead and fill like the resistance area up here, okay, or even just up here. And then check everything on your higher time frames, so you can see, okay, higher time frame support is obvious here. So if price decides to go up, okay, turn this area of support into support again by inverse break and retesting, that can go ahead and be a valid area to play too. So let's go over that. Okay, so we'll go over some meta. All right, so we can go ahead and see price all the way up here. Okay, price is trying to hunt all-time highs, and we're currently in dumping period. Okay, when you see heavy, aggressive red daily candles like the one right here, then you know price is trying to hunt for a low in order for price to retest, okay, or just find a certain support low and bounce its way back up to certain all-time highs. Okay, check it out. If I zoom all the way out, I look at the daily here. See, over the course of the years, price has just been going in an upwards direction. Okay, flowing. So, knowing that, area of resistance above current price, we can go ahead and keep that here. Okay. Why? Because we know price has to break areas of resistance in order to progress. Okay, so I'm going to put that here as my take profit and my goal. Okay. Then from there, put a 4-hour time frame. Okay, and let me look down below current price. Okay, so I can just see the structure here. Okay, I can see price meeting up with this area of support here. And since it is the stock market too, unlike cryptocurrency, I can actually swap over to my 15-minute or 30-minute time frame and use the market open marker indicator. Okay, so I can check out the lows and see if anything does make sense. Okay. So I'm looking at levels below current price, and we're going to see if price wants to bounce at any of these areas potentially. Okay, we have this level right here. The price decides to go in upwards direction from here. And then price right here. Upwards direction. Heavy area of support down here too. And we're going to go on the 5-minute too, make sure everything is clean how it should be. Okay. This area of support makes sense on the 5-minute. This area of support makes sense on the 5-minute. Same thing with here. Okay, so the 15-minute and 5-minute gonna give you really clean, accurate entries. Okay. Right here, we got this area of resistance right here. Actually, not support. We're going upward direction. Support right here, lining up with it. Resistance lining up with it over here. We got support right here. Price lining up with that. Resistance right here. The price is falling in a downward direction here. Price here, falling down. Price down here, bouncing upwards direction. Then right here. We got this level here. Okay. And a lot of times I like to wait for a good 4-hour close. So price is kind of starting to bounce at this black line right here, okay, indicating a level. Okay, so if price decides to keep going in an upwards direction, this could be a potential pullback level that's valid. Now, if price decides to break below it and it tries to retest from this level here, that's fine. Okay, it could break this one and try this one, or here, or here, or here. You get the gist. Okay, any of these levels that give you a good 4-hour close and a sweep, or you could even wait for a daily close too for even more safety. Okay, you can go ahead and just plan, buy years out, okay, depending on your options contracts. Okay, you can buy years out or as many months out as you can, or you could just buy shares. Okay, sit on it, hold, and just hold positions until certain take profits, like let's say all-time highs up here, something like that, for example. Okay, let price do its thing. Let price gain equity, okay, and let your money gain APY by just putting down good profitable trades. Okay. So price could potentially want to hold this area here, okay, especially after this heavy area of dumping in a downwards direction. Okay. So might want to hold here, and something that makes this area more exciting too, I can see on the 4 hour this area of support right here too. Okay, so price decided to make the same area of support here and then blast it in upwards direction. So this area of pullback here could mostly be pretty good. Okay. So when you're doing examples, make sure you're paying attention to key parameters. Okay, let's go and let's do Palantir. So Palantir here, price is trying to go ahead and chase this all-time highs. Okay. I can go to my 15-minute here. I can look below current price if I wanted to. Or I could look above current price and play the trend continuation, okay, if I wanted to. Or once again, I could look below current price. Okay. Or for pullback, so we got this area here. I'm getting my 5-minute. Make sure I got accurate entries. 930 support here. 930 support here. And we got this area right here. And then price decided to go in upwards direction right here. Okay, so the more lines in the zone, ideally the better. And that zone is going to be pretty strong for the most part. Price bouncing in upwards direction from here. Down here, price bouncing in upwards direction. Price shorted right here. Shorted right here. Bounce in the upwards direction here. Okay. Let me show it here. Okay. Getting all these reactions down. Resistance here. Yep, support. Okay. Support down there. And like you see right here, sometimes the levels are going to go ahead and correlate. 1, 2 taps of the same level. Okay, the more taps of the level that you see, the better a lot of the times. And the 930 strategy only works for stocks. Cryptocurrency, you got to use your daily 4-hour in your smaller time frames to verify everything normally. Support. And then resistance. Okay. And down here. And then we can go to current price. Go to our 4-hour time frame. Check out everything. Okay. So I know if price pulls back, honestly, I could just make this one big zone here. So I know if price pulls back to any of these areas, price could potentially give me a good bounce. Okay, price could give me a good bounce to a higher direction. Okay, so that's what I'm going to be looking for ideally. Okay, so price could come down to this black line, give me a 4-hour close, try and bounce in upwards direction. If not, we could try this zone here, or try this line, or here, or here, or here, or here. Ideally, these are going to be some strong levels we're going to be able to play, okay, if price decides to go in a downwards direction, okay. Then from there, we can buy the pullbacks and buy months and weeks out. Yep. So yeah, 4-hour daily and then 30-minute for crypto, and then time frames for stocks for the market open maker. Be like your 4-hour, your daily, and then like the 5-minute. So both of those together, or all of those together,
going to be like an extreme combination, but especially your 4-hour and your daily together. It's going to be, your 4-hour and your daily together. It's going to give you good combination. Okay. So yeah, we'll stop there.
Inflation is back, and it's eating your savings alive. $1 today buys less than it did yesterday. Government prints trillions, central banks scramble, and everyday people, they're looking for an escape hatch. Enter Bitcoin, the digital gold, the inflation killer, or so the story goes. But is it really a hedge? When inflation spikes, does Bitcoin protect your wealth, or just add more chaos to the fire? Tonight, we rip open the data, the history, and the hard truths. No hype, no slogans, just the numbers and what they mean for your money. This is the showdown you can't afford to miss. Let's find out who wins, and let's see if Bitcoin is a real hedge against inflation. Inshallah, if God wills.
Okay, so let's go and let's talk about inflation versus crypto. And let's answer the question, is Bitcoin a real hedge against inflation? And this is going to be an online, in-depth analysis. Let's get into it. So what is inflation in the first place? Inflation is going to be the sustained increase in the general price level of goods and services in an economy over a period of time. And the key effect, it erodes purchasing power. Simply put, your money buys you less than it did before, meaning that it's going to cost you more money for certain things than it did within the past. That's because sometimes the dollar loses value. So this is why people invest in things such as diamond, gold, and now we have things like Bitcoin, which is going to be a representative of kind of like a online version of gold. We don't completely know how much gold is available. We don't know how many diamonds are available either, but we do know how much Bitcoin is going to be available. And Bitcoin has a cap of around 21 million of it. So you know how much of it is going to be left available to buy, and the scarcity is already going to be implemented and set in stone, unlike certain other things like gold or diamonds. So for example, let's talk about some inflation, right? The power of your money. So in 1990, right, a cup of coffee cost $1. So that means a $20 bill will buy you 20 coffees, And in 2024, the same coffee will cost you $3.50, meaning that a $20 bill would now only buy you 5 coffees. Significant difference, It might seem like a slight increase, going from $1 to $1.50, but it's actually a big increase over time, especially when it comes to real estate, apartments, houses, etc. Rent, mortgage, and stuff. Back in the day, houses were a lot cheaper. Now things are a lot more expensive, a lot more lucrative, and just changing in certain ways. So the main causes of inflation, right? So inflation comes from multiple factors. One, it comes from the fiat currency, and the fiat currency is going to be whatever government that you're involved with. Say you live in Thailand, then you're going to be working with the baht. If you're in China, then you're working with China's currency. If you're in the US, you're going to be working with the US dollar, etc. That's what fiat currency is, your country's currency. So inflation comes from demand pull inflation. So too much money chasing too few goods. This happens when strong consumer demand outpaces the economy's ability to produce goods and services. And cost push inflation. Production costs rise. This occurs when the cost of raw materials, oil, or wages increase, forcing companies to raise their prices to protect margins. And built-in monetary, expectations and money supply. So workers expect higher prices and demand higher wages. It also includes rapid expansion of the money supply by central banks. So we're keeping certain things in context. We know things can get expensive. We know things progress over time, but we have to understand why and how we can protect ourselves from this. Investing is going to be a strong way. When you're investing within the future, your dollar is going to be a lot more worth your while. Money is a tool to generate more income, whether you're investing in ads, buying stocks, crypto, etc. It's a tool to generate more income, and use it as such, not just to consume. So the problem, why we need a hedge, it erodes savings. The value of cash saved in a bank decreases in real terms. A $10,000 savings account loses purchasing power every single year that inflation is high. Once again, this is why investing is going to be your good bread and butter in order to counter this stuff. And discourages investment. High uncertainty over future inflation can make businesses and individuals hesitant to commit to long-term projects and investments.
Okay, because they're going to be worried about, well, are things going to just get more expensive? Are things just going to keep increasing over time in a way that I'm not going to be able to handle? Okay, so that's what inflation throws in the mix in. So it's really a question of, okay, what can we do to counter this? And once again, it's going to be invest, inshallah. So redistributes wealth. It disproportionately hurts those on fixed incomes, like retirees, for example. Okay, say someone's living off dividend income, okay, like an ETF, crypto ETF, or even just profits, right? As things get more expensive, your dollar is worth less, okay, that big giant trade that you hit, or your dividend income that's coming every month is then going to be just worth less since the economy is just going in a different direction. Okay, so we have to come up with ways of how we can keep our income afloat and what we can invest in to keep the money cycle always flowing. Okay. So it creates uncertainty, makes long-term financial planning extremely difficult for families trying to save for college or retire, buy houses, and for corporations planning new factories, for example, as well too. A lot of factors that go into this. Okay. So what is an inflation hedge? Okay. So let's talk about the definition, right? So an inflation hedge is an investment asset that is intended to protect against the decreased purchasing power of a currency that results from inflation. And how it works. So its value should in theory increase or at least remain stable during periods of high inflation, preserving one's real wealth. Okay. And some traditional examples, right? Gold. Okay. It's a physical asset with a long history of a store value where you can create jewelry with it. Okay. Create companies with it. Okay, whether it's going to be a gold lending thing for something like that. Okay, whatever you want to do. Okay, horseshoes, whatever. Real estate. Okay, it's physical property, and the rent it generates tend to rise with inflation. That's why you're going to see your rent get higher and higher and higher sometimes in certain cases. Okay, and tips. Okay, Treasury inflation protected securities are bonds specifically designed to offset inflation in a lot of cases and scenarios. So let's talk about the argument for Bitcoin as a hedge, right? The digital gold thesis. So it's a finite supply amount of Bitcoin. Keep that in mind. So mathematical scarcity is going to be implemented. The Bitcoin protocol strictly limits the total supply to 21 million coins. Unlike fiat currency, which can be unlimited, central banks cannot simply print more Bitcoin to fund spending. As we know, Bitcoin is created by power, POWs. So it requires a very extensive and powerful computer with a good graphics card in order to mine the Bitcoin, which uses a lot of power, okay? And decentralization is going to be into place. No central control. And it operates on a global distributed network outside the control of any single government or financial institution, making it resistant to national monetary policy failures, okay? And global accessibility. It's a borderless asset, so it can be traded anywhere through all countries at any time instantly. Very, very useful. And it can be accessed and transferred 24/7 across borders, acting as a potential escape from a rapidly devaluing national currency. And the argument against Bitcoin as a hedge, right? The risky asset thesis. Extreme volatility. A hedge is supposed to provide stability, and Bitcoin's price regularly fluctuates by 10% or more in a single day. This is the behavior of a speculative asset, not a stable store of value. And high correlation with stocks too. If you check out the Bitcoin chart, you look at the stock chart, very, very similar in a lot of ways. Okay. In recent years, Bitcoin has often behaved like a high-risk tech stock, a risk-on asset. When inflation fears spooked markets, Bitcoin often fell with the stock market. Okay, failing its one job as a hedge. So sometimes it can mirror the stock market or the S&P 500 or NASDAQ a lot of times too. So in the lack of long-term data. So Bitcoin is only about 15 years old. And gold has been a store of value for millennia, and there's no data on how Bitcoin behaves during a prolonged inflationary period, okay? And we've seen certain times like COVID in the past where it took significant dumps, but what changes a lot of things is the government getting involved. Now that the SEC and the government is able to have control and own Bitcoin in a manner where they can benefit as well too, I can see things going in a lot more positive direction, if God wills. So some head-to-head comparison, right? Let's talk about Bitcoin versus gold in the first place. So scarcity, right? Bitcoin, it's finite, okay? It's not infinite, it's finite, okay? It's finite. So that means that it's capped. There's going to be 21 million Bitcoin available. And gold, right? Gold is going to be physically scarce, okay? So some new discoveries come in
as we explore more land within the earth and stuff like that too. But for the most part, gold is going to be scarce. And Bitcoin, right? Bitcoin's 15 years old. Gold, we've known of gold for like 5,000 plus years. Okay. And the volatility of Bitcoin can be extremely high, which can be a very positive thing if you buy certain dips as well too. So not all negative. And the volatility of gold can be relatively low, but gold year after year seems to be going up in a very consistent uptrend. And storage, as far as holding gold, right? You can hold gold as well too. You can buy certain ETFs, buy certain shares, or buy the gold futures as well too. But you can, for the most part, buy physical bars, buy jewelry, buy Rolexes, any type of watches, chains, etc. as well too, can be melted for more gold. Okay. And Bitcoin's going to be held digitally, can be held on a USB stick or cold wallet as well too, in case you don't want to hold any of your crypto on the internet. And portability is very, very high. You can put your crypto anywhere. You can spend your crypto on a card too. You don't even have to send it over to your bank account. You could just get a card, depending on your crypto broker, send your crypto and spend your crypto like that. And portability for gold, it's going to be pretty low. Okay, it's pretty heavy for a lot of the times, carrying all those gold bars, and you got to know where to sell it too. So Bitcoin's going to be online. You can use your online money anytime, anywhere, and really help you out. Inshallah, I know there's been times where my bank, for example, has been doing maintenance at the middle of the night, and I really needed it, and I had to come in clutch and use some crypto. So thank God that was an option for me. Okay, so the primary use case for Bitcoin is going to be for speculation. Speculation within the trading environment means that you're betting on a certain direction. Okay, and for transferring, okay, for spending your money too. And for gold, right? You buying gold bars for store value, for jewelry, or if you're just in the industry in general. Okay. So here's a real world case study here. The 2021 to 2023 inflation surge, right? What happened? So from 2021 to 2022, inflation in the US and Europe surged to 40-year highs, driven by supply chain issues and stimulus. Okay. And what did Bitcoin do? After peaking in the late 2021, Bitcoin's price crashed by over 70% during 2022, precisely when inflation was at its worst. Now, granted, it's not the best example to look at this due to the fact that at this time, there was a lot of laws and regulations and stuff that hasn't been completely passed yet. So we got to keep that into manner in case too. Okay, so not everything was as proper as it should have been right at the time of all of this stuff was occurring. Okay, so keep that in mind. Okay, don't forget about that. So now the government has a lot more control over things. So things have changed. Okay, so conclusion. What is Bitcoin, right? A nuanced view of it. So it's not a reliable short-term hedge, for example, right now. So the data clearly shows that it's too volatile and too correlated with risk assets like tech stocks, for example, and mirrors the NASDAQ to reliably protect purchasing power month to month. So it can't really fight against the stock market, but it is going to be a good source of value to have due to the fact that it's a finite resource. Stocks, for the most part, are going to be and an available resource in an abundance. Is pretty much who has like the most of it. But Bitcoin, there is a limited amount. And Bitcoin, and maybe a long-term store of value, right? The digital scarcity argument remains compelling. And once again, it gives you the ability to send money instantly across the world. That's a huge plus. You cannot do that with normal fiat currency. If you try to send a wire transfer to somebody in another country, it's going to be pretty difficult. But if you send a very crypto, it's instant, just like that. Very, very simple, very clean, very, very useful within the future. So over a 5 to 10 year horizon, it has outperformed fiat currency. And this is a growth and scarcity bet, not a classic inflation hedge. Okay, so keep that in mind. So some key takeaways from this class, right? Inflation. It's a persistent rise in price that erodes purchasing power, driven by demand, cost, and a monetary supply. And a hedge. It's meant to provide stability and protect value during inflationary times. Traditional examples include gold and real estate. And Bitcoin's pro argument is based on its finite supply of 21 million and decentralization, meaning that it's not controlled by a government body or entity. Okay, it's free for everyone to use, person to person, peer-to-peer transactions, making it a digital gold. And Bitcoin's con argument, right, is that it's extremely volatile in certain times and has high correlation with tech stocks, making it a speculative asset. And the verdict. Bitcoin has not yet proven to be a reliable inflation hedge, since once again it does mirror the economy, but
we got to give it time as more laws and stuff like that get regulated and passed, especially in the short term. So it's better understood as a high risk, high growth asset class based on the concept of digital scarcity. Okay. So leave questions in the comments below. Stay prayed up to God. Keep grinding. And head over to Stackmode.net for all trading mentorship. Peace. So I want to talk to you guys about trading with the trend. Understand that trading with the trend is going to be trading with where the money is flowing. You have to trade with where the money is flowing. Think of the market like a river. If you're trading against the current or you're swimming against the current, what's there going to be? Counter resistance. It's going to be hard. So if the market's going in a heavy uptrend, lots of buying is happening. Lots of liquidity, lots of money is flowing into the upwards direction. And you put in a short and you notice market still keeps going in an upwards direction, you're swimming against the current. Stop swimming against the current. If you're doing that right now, stop doing it. If you see market going in an upwards direction, you need to be buying in an upwards direction. If you see market shorting, okay, then you need to trade with the trend and take shorts. Stop trading against the market. Stop trying to see market go in an upwards direction and be like, market's going to short exactly right here. And then try and plant something that's not even going to happen. Next thing you know, buyers are still in place. The breakout happens. And then price continues in an upwards direction. Why? Because the trend is so heavy. The buyers have stepped in. If it's an upwards trend on the higher time frame and it's real, it's going to be a heavy trend. Okay. Trading. It's the art of reading human psychology through price. Most traders fail because they look at the reflection and not the source. And price is the only really thing that matters. Where's price going? Is price going up or down? Price can literally only go up or down. Trading is quite simple when you think about it. Okay, everything else is pretty much a derivative. So any type of indicators, things like that, all delayed, not things you need. So let's talk about the cycle of money. So accumulation, right? Professional buying. Accumulation is going to be people loading up on things, people loading up on shares, people loading up on crypto. When people are accumulating large amounts of an asset, such as the government, many governments buying hundreds of millions of dollars worth of Bitcoin, for example. Okay. Accumulation is going to be when an investor or an investing class, such as a government, a hedge fund, and the hedge fund is pretty much just a bunch of people with a lot of money coming together investing, and they buy. Okay. And markup is going to be letting you know that there's a visible trend. Okay. And professional selling as well too. Distribution coming into play. Okay. Is market going in a downtrend? That's all it is distributing going on. Okay. And accumulation is just a bunch of buying. People loading up on shares, cryptocurrency, whatever. Okay. And the markup. So as far as certain things, you can wait for pullbacks, wait for support to confirm, and you could see breakouts, such as breakouts into new all-time highs to confirm the markup phase. Okay. A lot of the time that's going to be where the easy money lives, and risk is going to be the lowest. Okay. So if market is continuously breaking areas of resistances, okay, you can wait for market to pull back and buy each pullback until market comes back to the area of resistance. And you can continue to hold your contracts for a breakout if possible too, because you have to understand that market, in order to continue an uptrend, for example, has to break areas of resistances above current price or areas of support above current price. Okay, let's head over to the next slide. So the anatomy of an uptrend. So higher highs plus higher lows equals a trend. So higher highs equals exactly what I talked about on the last slide. Areas of resistances, which is just going to be areas where market decided to sell off at. That's all an area of resistance is. And then you're going to have areas of support, which is going to be areas where market decides to buy at. And that's going to be where buyers are stepping in it. Yeah. So sellers resistance, buying at areas of support. And you see higher highs, which means areas of resistances are getting broken into higher areas of resistances. Okay. See these areas of resistances, see how each one of these are higher, and then you're going to have the higher low.
So look at this low, this area of support where buyers are stepped in. Then this low, buyers are stepped in. And this low. This low is higher than this low. This low is higher than this low. This low is higher than this low. Okay. So whenever you see higher lows getting put in and higher highs getting put in, then you know price is trending in an upwards direction, inshallah. So certain things matter. Resistances getting broken out into new highs and higher lows being maintained so price doesn't keep dumping down to the same areas of support over and over again. So it can actually trend in a staircase. So identify the last higher low. Higher lows are going to be good areas to enter, and that's going to be a really good pullback entry. And some people do find success in breakouts as well too. Find your bread and butter, find what you like to play, and play that. And as long as that low holds, then the trend is going to go ahead and be intact. And risk versus reward. So you might see certain things like on the risk reward tool, like 1 to 4, or you might hear terms like 1 to 2. So what this means is, let's say the 1, let's say you're risking $100. So if you're risking $100, then the 4 is going to be a multiple of that. So that means you made $400. So if your risk is $100, you made $400, your overall profit would be $300. Okay. So you always want to try and make double at least whatever you're risking. Okay. So if you're risking $50, try and at least make 100. If you're risking 70, try and make it at least 140. Okay. If you're risking 1,000, try and at least make 2,000. And that's going to be a 1 to 2 whenever you're just catching the double multiple like that. And the strategy is only as good as the exit. So remember, as higher lows and higher highs are getting put into place, let's say you are trading in an uptrend. Let's say you caught a higher low entry, such as right here. You want to make sure you're closing at the area of resistance, most of your contracts at least. Okay. And then if you want to play breakout, let's say you have 3 contracts, then maybe hold 1 contract for a breakout and see if price will continue. Okay, but don't be greedy and take profit. Target the next major horizontal resistance or area of support above current price, and that's going to be a trouble area where a lot of orders are going to be sitting. Okay, people are going to have what's called limit orders and bracket orders, which are automatic orders when price comes in contact with a certain area. Either price is going to sell or buy, because people know price is waiting to react to that certain heavy area. So if market falls down heavily from a certain place, people might have limit orders placed at that area of resistance if they're in buys, so price will automatically close. Or some people, which you, depending on the market, could affect you, could be good and sometimes not. Some people might have sell orders at the area of resistance too, expecting price to fall downwards. Okay, and structural protection. So your stop loss, it's an invalidation point. Okay, and if price hits it, your thesis was wrong. Accept it and move on to the next trade. Don't break your account structure and everything you've been working hard for because you want to have an emotional moment. It's not worth it, I'm telling you. Okay, stay focused, stay disciplined, and stay prayed up to God, and just keep working on your craft. Don't give up. It's really important to not give up. Okay, let's do it. Indicators, just trash. Okay, all of them. All of them, in my opinion, are trash. Okay. Everything you need to see is baked into the candlestick chart, which I'm going to cover right after we get over these slides. Okay. But all these RSI, MACD, stochastics, EMAs, barf. Okay. Trash can. And we take the indicators and we put them in the trash can. That's what we do. Okay. We grab the indicators. You get on your trading view. You get on your broker. You click the trash can on them. And you delete them. Everything you need is baked into the chart. Why are you looking at lagging indicators? It's not worth it. They tell you what already happened. Just look at the chart. Look at the chart and look at your higher time frames. Stay prayed up to God and focus on your wisdom. Focus on how you're analyzing the charts. Focus on how you're feeling the charts. Okay. So the lag. Late data is going to kill your edge because you're relying on something that's already in your face. So stop it. A lot of people do that in life. A lot of people look instead of just doing and reacting. And it can cause analysis paralysis. Clutter clouds judgment. Instead of just being confident in the candlestick chart analysis mixed in with the economics with whatever you're playing, you're waiting for an indicator. Stop it. I used to be there. It's not worth it, I'm telling you. So naked charts, okay, just straight up candlestick charts, all you need. Indicators suggest reversal, and price action proves it. Stick to the source data, stick to the actual candlesticks that are moving in your face, not lines that react off of the candlesticks later. Please don't do that. Don't destroy your account like that. Don't destroy your future's family profit like that. You got this. You're the breadwinner. You can't fail. Okay? And if you do, get up, scrape your knees off, and pray to God and keep winning. Don't let these indicators hold you back. Let's go. Simplicity wins. I'm going to show you guys how to read the chart with just candlesticks. No indicators, no squiggly lines on the candlestick chart. It's not making sense. Turn it off. Turn everything off. Okay, trade price, not the derivative. Follow institutional footprints. You can see it all. A lot of it's going to be baked into the higher time frames. Okay, stick to your weekly, daily, your 4 hour, okay, and lowest maybe your 1 hour. Okay, stick to your higher time frames. It's really going to help you get that good edge and break everything down strategically. Remove the clutter, use your higher time frames, and use horizontal lines. Let's go ahead, continue on to the charts. So we're on the charts with it. Let's go ahead and analyze Bitcoin. So I'm going to show you guys 2 examples. I'm going to show you guys how to read an uptrend. And then after this, I'm going to show you guys how to read the downtrend. So a lot of the times the United States markets and cryptocurrency are meant to go in upwards directions. So US stock markets are meant to go in upwards directions due to the fact that the more successful that these worldwide companies are, the more taxes they're going to be able to pay to the US government, whether via business taxes or the more employees they're going to be able to hire since their company's on the stock market. And the whole reason companies list themselves on the stock market is so they can generate more income, which causes them to build more buildings, which needs more people to maintain. The more people, which means more taxes can be taken out of their wages, the richer that the US government gets. So it's really imperative that US stocks go up year after year after year, especially the big important ones that help the whole world. And cryptocurrency is meant to go in an upwards direction because the creators of them, especially Bitcoin, is going to be finite, which means that there's a limited amount. Okay, so people are trying to buy it up, and there's a lot of imperative value to owning cryptocurrency and buying and holding. So let's talk about how to read the uptrend. So a lot of the times you want to be starting on your higher time frames first. Make sure you're not trading when price is already at all-time highs, okay? Because then you're just going to go ahead and get pulled back on. It's not worth it. You don't want to get pulled back on. It can really just destroy your account buying at all-time highs. Buying after all the hype is done, you want to buy at pullback areas and then catch the sweep upwards, okay, back to the area of resistance above current price. Okay, so I'm going to go ahead and show you guys how to analyze the trend. So I'd like to go ahead and zoom all the way from the beginning. I don't like trading trash personally. I like to make sure I'm trading a trending asset, and I like to ask myself, does this asset go up year over year? Okay, if it doesn't go up year over year, I'm not even worried about the uptrend. I'm worried about if I'm trading something decent or not. Okay, Bitcoin, for example, I can see has gone up year after year after year after year after year. Okay, so in my opinion, this is going to be a good asset for me to trade and catch an uptrend on. If it doesn't go up year after year after year, if it's sideways, like if price action was like this, and then this, and then this, and then this, and then price was over here today, it's not something I'll be looking forward to uptrending on personally. Okay, but I could see price starts from here and decides to progress over time, and I like that a lot. Okay, I can see a lot of upwards projection value in this since year after year data is showing me that it likes to uptrend. So I can see price decides to burst up. So we started here from the beginning of time, price came up and it bursted up here. So buying started happening. So when you start seeing price heading up in an upwards direction, multiple green candlesticks, a lot of times is what I like to look for. Multiple green candlesticks on my higher time frames in a row. Okay, it's going to signal a lot of the buying. Okay, a lot of buying happening here. The price decided to top out right here. And then it fell down. price decided to fall down and create an area of support. So let me go ahead and show you guys here. When price decides to fall down from an area, that's going to be called an area of resistance. And when price decides to bounce upward from an area, that's going to be called an area of support. Okay, resistance is going to be an area where price falls down from. Support is an area where price decides to bounce upward from. Okay. Then we could see this area of support. Price decides to bounce in an upwards direction here. Price decides to bounce up and stop again. So whenever I'm looking at an uptrend, I like to think of price moving in a V. V meaning that the top left of the V is going to signal the resistance. Okay. And the bottom of the V
Power off.
is going to go ahead and signal the area of support. So I'm going to have the left side of the V, which is going to signal area of resistance. And the bottom of the V is going to signal the area of support. Our goal, if we're catching an uptrend, is to catch the right side of the V. So on my higher time frames, I like to wait for price to make an area of support first. And if I get multiple green candlesticks heading in an upwards direction after price has already fell down, because that's going to let me know that sellers are selling. And then if I see price making a bottom and then buyers start buying, that's going to let me know that price is done selling and buyers have stepped in. Okay, price is not going to sell forever. And there's also going to be a lot of laws, especially on the stock market, such as the short sale restriction, which prevents a lot of things from just flash crashing to zero. So you can see here, price decided to create resistance all the way from here. And price decided to fill in and even break the area of resistance right here. Okay. And price decided to make a new high from here. Price decided to come up here and make an area of resistance up here. From there, price decided to make the left side of the V again, come down, bottom out, and make the bottom of the V. Right here. And then we see multiple green candlesticks going up in a row on the higher time frames and the right side of the V being filled. Okay. We got the left side of the V, bottom, and then our job is to catch the right side of the V. Okay. So the later you enter on the V, let's say you enter like right here where that black line is, the later you enter in the V, the more confirmed. The earlier you enter, the more profit you're going to be able to make, but more of a chance that you could potentially get burned. So it's going to be depending on the certain setups you take. So if you would enter like right here on the black line, if you're trying to close at this area of resistance, it's like not a lot of money left. But if you enter like right here, like that would be fine. Or even right here, that would be fine too. Try and enter like halfway of the V and then go ahead and close at the resistance. Yeah. And then you can see price decided to make a low right here. Price decided to come back up to the resistance. Didn't quite break it. It said, nope, gonna go ahead and reject again. We came down. And then we bounced at this low here. So this low is higher than this low. And then this low is higher than this low. Now we can see the V right here being filled in. Again, just like the V here filled in, V here filled in. Okay, and price will continuously do that. And you can also use your daily time frame to go ahead and plot out trades too. So even if I delete something here, and I just see this trend, I have the bottom area of support right here. We got another area of support right here. Then we got another one right here too, the C being generated. price making higher lows. Price is making higher lows. See price uptrending. Yeah. It's going to be a really, really important thing to look at. And you can see these V structures being filled in. So top left of the V, price started here, area of resistance was formed, price came down, bottomed out. Then the right side of the V got formed, resistance area got broke, price came down, did the same thing again. Price bursted up towards this area of resistance here. Came all the way down, made this area of support, and did the same thing once again. Okay, could see price deciding to progress over and over again. Okay, and we're coming down here. Looks like it's trying to hold a new low, and we could potentially see over time if this low will remain higher than this low here. Okay, and if so, that's going to be another verified area of support. I like the multiple green candlesticks here on the daily. On the weekly here, we do have some sideways weekly candlesticks that are green. So we'll see about another week here too. Okay. So higher lows and higher highs are going to be something to look at whenever you're reading your uptrend. Let's over to the downtrend. All right, let's go ahead and talk about analyzing the downtrend. So when you're analyzing a downtrend, you want to be looking for lower lows and lower highs. Okay, so let's go ahead and let's talk about it. So let's say price decided to super top out right here. You know, it had a good run. It's been uptrending for a while, but since then, it's been trying to head down to the graveyard. So let's analyze and break down how you can catch trades when price is heading in a downward cycle. So you could see price here created an ultimate area of resistance. And resistance is just going to be an ultimate area where sellers are coming in. Okay. Sellers are coming in to this area since price is falling down. Then you're going to have price making bottoms. Okay. Once again, that's going to go ahead and be areas of support. Support is going to be an area where buyers are going to be stepping in. Okay. You're going to have support and then you're going to have resistance. They both correlate. And the cool thing about them is resistance sometimes can be broken and turn into support. And a lot of the time support can be broken and turn into resistance. Just as resistance can mirror another area of resistance, even if price decided to previously break it. Say, for example, price decided to create an area of resistance here. Price broke it, came down. Price could still come up and short at that resistance again. Same thing with an area of support. Price decided to come up, break below the support. Price could come above the support and pull back at the same support again. Okay, price is very reflective over what happened in the past. Okay. So let's go and let's keep analyzing. So you're going to have the area of resistance where price decides to fall downwards from. And then you're going to have the area of support where price decides to bounce in an upwards direction from. Okay. Both important areas to look at. So resistance, just like I said, can sometimes be broken and turn into support. Support can sometimes be broken and turn into resistance. Okay. Keep all that in mind. And put it all together on the charts. So a lot of times when I'm downtrend shorting, I'm looking for two things. I'm either waiting for an area of resistance. I don't even care if it's in the past, to meet up with an area of resistance and I'm taking it again. Okay. Or I'm going to wait for an area of support to be broken and turn into resistance. Okay. So let's find an example here. So let's say price decided to make this area of support right here. Could see price decided to make this mini bounce after a heavy downtrend from a while. Okay. After that, price decided to hunt back up to this area. So look at this support zone right here. Price decided to bounce up for a little bit here. Okay. To this area of resistance here. Okay. And even this area of resistance right here. All right. Sometimes you'll be able to look to the left and be like, okay, I see why resistance was created here. Okay. So for instance, if I drag it all the way over here, we can look to the left and we could try and piece things together and see, okay, was there any price action that reflected? So I could see this area of resistance here. And if I zoom in close, I could see another area of resistance right here. Okay, so stuff doesn't just happen for no reason. You could see the two areas of resistance both cause price to fall downwards for a while. Okay, very, very reactive market. So stuff even from years, months ago, okay, could be reactive. And even right here, price decided to create support. Price broke it and turned it into resistance. Support right here got broken, turned it into resistance, and then price headed in a downtrend. That's going to be one of my favorite ways to downtrend. Is going to be waiting for support to get broken and then waiting for price to run back up to it and turn it into resistance. A lot of the times, if you see that, it's going to be a really, really good short or a good time to short. And even if you see two areas of resistances meeting up with each other, it's going to be a good area to short at as well, too, a lot of the times. Okay, but be careful with that, especially during uptrends. You don't want to get caught trying to short something that's not meant to be shorted. That's in a clear uptrend because you're just hunting for something. Okay, so that's why I like to wait for support to get broken and turn into resistance cleanly, whether it be it on my daily. A lot of the times I'm gonna wait for it on my daily because that's gonna give me the cleanest structure and what I'm actually looking for, making sure it's confirmed. Because I don't want to be taking any type of nonsense trades. Okay, you don't want to be wasting your funds. You don't want to be wasting your time. You want to try and take the trades you know are going to be making you good money. Okay, and waiting for confirmation is also going to be really, really important too. So just as you're waiting for, let's say, an uptrend, I like to wait for 2 to 6 daily candlesticks going in an upwards direction to the right. If I'm waiting for a downtrend, I'll wait for 2 to 6 red candlesticks going down just to make sure. Okay, I don't buy the first immediate reaction a lot of times because I don't know if it's going to be completely true. So let me go ahead and pull up an example here on natural gas. Okay. So even here on natural gas, we can see price farming this downtrend here extremely, extremely heavily. Okay. And certain trades can be found by just being patient, okay, analyzing the market, and really just taking your time. So even right here, take this area of support. That was very important. I like to look at very important areas of support, especially on my higher time frames. You can see price decided to break below it. We could see a daily wick right here. After that, I got 1 red candlestick, 2, 3, and then we got price heading in a downwards direction. Okay, from there. Okay, and you could have did take profit at like this support here, or even this support right here. Okay, and caught that good trade down. Could enter down here, take profit here, and that would give you about a 1 to 2. Yeah. So taking your time with the setups and analyzing everything, it's really going to be important. And when you're downtrending, a lot of the times your take profit is going to be either an area of support above current price or below current price, not above, an area of support below current price, or an area of resistance below current price too. Because just like I talked about, resistance can turn into support. So when you're shorting, your take profit can either be resistance or support. Same thing if you're uptrending too. So yeah. So say here, price decided to create a little buy zone right here. Price bounced in the same area 3 different times. Price broke it, and then price hunted all the way up to it, shorted, and they gave us one red candlestick, 2, 3. I like that a lot. You could have did take profit at like this support right here, and you could have went ahead and caught your trade. Okay. Boom. Could even take profit down here. And then the amount of days this would have took, you can use a ruler to on trading view. Again, start on the resistance, drag it to the support. It took about 90 days, but that would have been a real account flipper. Okay. A lot of the times it's not about getting a trade over and over and over and over again. It's about just taking a couple of good trades. Okay, a month, a week, or even a year sometimes. Even if you did it right here, this resistance to the support took about 14 days. So if you did a smaller take profit, it would take less time. So yeah, so cool. That's gonna go ahead and be that. Stay praying to God, keep grinding. Catch you guys in the next one. And I pray this helped. Head over to stackmode.net for all trading education. Peace.
Imagine waking up and realizing the Federal Reserve just moved this single number, and suddenly Bitcoin, Ethereum, your entire portfolio either pumps like crazy or falls off a cliff quickly. Sounds dramatic, right? But that's exactly how strong interest rates are. And today, I'm breaking down how the Fed quietly controls the entire crypto market. So here's the truth. When interest rates go up, money gets expensive. Investors pull cash out of risky assets, and crypto is usually first on the chopping block. But when rates start to drop, liquidity floods back in. Risk appetite returns, and when crypto wakes up fast, then the whole economy is ready to pump the market back up. Let's go on and jump into the reasons why interest rates are so important for the crypto market. Fed rates, they're extremely important. Let's go and let's understand the macro forces and how central bank decisions move the digital asset market. So the engine, the Federal Reserve policy. The U.S. Federal Reserve, which is the Fed, it operates with a dual mandate, maximizing employment and maintaining price stability, which helps manage inflation. Their decisions ripple across all global financial markets, and the primary tool is used using the funds rates. This is the target rate for commercial banks lending reserves to each other overnight. By raising or lowering this rate, the Fed influences the entire economy's borrowing cost from mortgage rates to business loans. Let's talk about a rate hike, right? Tightening. It makes borrowing more expensive, and it slows down the economy and cools inflations, and this generally hurts risk assets. And rate cuts, it makes borrowing cheap, stimulates spending and investment, and this generally favors risk assets. And the secondary tool involved into it, quantitative easing and tightening. These involve open market operations where the Fed buys or sells government bonds to expand or contract its balance sheet. Okay, so we're going to go ahead and keep understanding certain implementations and why Fed cuts are going to be important. And to understand that importance, let's talk about the DXY. The US dollar index, also known as the DXY, measures the value of the US dollar against a basket of 6 major world currencies: the euro, the yen, pound, etc. And because the USD is the world's primary reserve currency, its strength dictates global capital flows. And the inverse correlation mechanism, Bitcoin, BTC, and the DXY often exhibit a strong negative correlation. When the US dollar strengthens, DXY rises, and risk assets like crypto and sometimes stocks tend to fall, and vice versa. And why does the inverse move occur in the first place? A stronger dollar often results from higher US interest rates, and higher rates make safe haven assets like US Treasury bonds, for example, much more attractive, leading investors to sell off riskier non-yielding assets such as Bitcoin or other cryptocurrencies to move capital into dollar-denominated stability. This is known as a risk-off move, so people can plant their money in a less volatile environment. And USD and global liquidity. Since much of the world's trade, debt, and finance is denominated in US dollars, a strong dollar effectively tightens global financial conditions, reducing the total amount of available capital for speculative investments globally. So, how well the US dollar is doing and how high inflation is really going to correlate to everything, such as crypto. And taking a look at the DXY is going to be a nice way to navigate and understand where the economy is at as far as the US dollar. And with all this, it can have a significant impact on crypto. As a high growth, non-yielding, and historically volatile asset class, Crypto is highly sensitive to the cost of money and general market risk appetite and rising rates, right, during the tightening cycle. Higher interest rates hurt crypto in several ways. A higher discount rate is going to be one of them. Future cash flows for growth stocks and projects are valued less in the present. And a yield competitor. Safer assets like bonds start offering attractive yields, pulling capital away from speculative assets so people can have more of that definitive, stable income. And credit contraction. Borrowing costs for institutions and exchanges increase, discouraging leverage trading. So people are not going to be able to make money as rapidly, but they're going to have their money implanted more of like a seed within a stable position. So not looking to quickly leverage trade based off a high and a low or a short and long scenario, but it's more of a scenario of, okay, I'm going to be making this investment with the idea of holding this for decades and years and years and years. And falling rates, this helps ease the cycle. Lower rates are typically a tailwind for crypto, and it increases liquidity. It includes cheaper borrowing and it injects capital into the financial system, with some flowing into risk asset. It also involves lower opportunity costs. Bond yields become less attractive, which force investors to seek higher returns in growth sectors. And a weakened dollar happens when rates fall. And it often accompanies rate cuts, making Bitcoin, which is a digital gold, which people like to call it, relatively more attractive as a hedge. In the balance sheet, understanding this is going to be extremely important, and quantitative tightening is a policy that's frequently deployed alongside rate hikes. It directly reduces liquidity by shrinking the central bank's balance sheet, creating a powerful headwind for risk assets. And how quantitative tightening works in the first place. The Fed first reduces its holding of treasury bonds and mortgage-backed securities by allowing them to mature without reinvesting the proceeds. And this effectively removes cash from the banking system, which achieves several outcomes. 1. Reduces the money supply. It directly pulls liquidity out of the broader financial ecosystem, and it increases the bond supply, which floods the market with more bonds, which requires higher yields to attract buyers, driven up long-term interest rates. And quantitative tightening's direct impact on cryptocurrency. Since cryptocurrency thrives on liquidity and risk appetite, quantitative tightening is a major negative factor. And historically, periods of aggressive QT have coincided with significant drawdowns in the Bitcoin and altcoin markets. Less money circulating means less capital available to flow into speculative digital assets. And the word speculative, it's pretty much meaning where you're trying to make money based off directional bias. If you think something's going to go in an upwards direction or in a downwards direction. And crypto's evolving macro relationship. So while Bitcoin was once seen as totally uncorrelated, its relationship with macro forces has evolved due to the increased institutionalization. So the institutional factor, right, with major hedge funds, asset managers, and spot ETFs holding Bitcoin, institutional investors, and now even the US government, for example, treat it similar to high beta tech stocks. When they face the risk-off macro environment, they sell both their tech stocks and their crypto holdings, increasing the short-term correlation and holding cash. And partial hedge thesis, right? Despite the short-term volatility, some analysts suggest that over a longer time horizon, maybe over a course of 180 days, Bitcoin's correlation with the DXY often vanishes, indicating that it can still act as a partial hedge against dollar market-driven fluctuations. Okay, so while the US dollar is weak in certain scenarios, there's a strong chance where Bitcoin can remain strong due to the fact that it's a decentralized currency and takes itself out of the whole fiat currency pool. And some key macros to watch, right? Take a look at CPI. You guys can go to forexfactory.com or any other news website to see some news. Take a look at the CPI, all right? CPI and the PCE are going to be really, really important inflation data numbers to pay attention to. It signals the Fed's next move, and typically after CPI and PPI happens, the market makes a drastic move a lot of the time since people are going to know how to move. So if rates get cut in certain ways, people are going to know how to invest, and then you might see market get extremely bullish after CPI. So if you're going to make a super big investment, whether it be in a cryptocurrency, stock, whatever, wait for CPI to happen, wait for certain earnings to happen, and then see how the market reacts, and then you can make your decision a lot more logically based off of that. So DXY is also going to be a great macro to check out too. It's an indicator of the dollar strength in capital global flows.
And check out the Fed balance sheet. It tracks the velocity of quantitative tightening and QE. So everything together is really, really going to help you put together a good thesis and know when is a good time to buy. And as of recently, we've been trading in a much more mature market when it comes to the cryptocurrency space. The cryptocurrency market is no longer isolated. It's intrinsically linked to the global economy. If you check out SPX or the S&P 500 and you pull up the Bitcoin chart, you'll see certain correlations, which is definitely going to let us know that it's classified as a high value asset. So it's intrinsically linked to the global economy, making the Federal Reserve policy the single most powerful external driver of market direction, especially as governments get more control over it and things like that. And understanding the Fed's tools, the rates, quantitative tightening, QE, it's all essential for interpreting market shifts and when market is going to be bullish, which is when market is going in upwards direction, or bearish, which is when you think market's going to go in a downwards direction. And particularly the inverse relationship between the strength of the US dollar, the DXY, and the appetite for high risk, high reward digital assets can have some things you can look at to let you know when it is ready to buy on either sides. So stay prayed up to God, keep grinding. Head over to Stackmode.net if you want to learn how to trade cryptocurrency. I'll catch you guys in the next one. Let me know what you thought in the comments below.
So a single rate hike doesn't just cool the economy. It changes the math for every crypto asset in your portfolio. And here's the reality. When borrowing money gets expensive, the big whales pull out of risk and run to safety, leaving retail investors holding the bag. And we're talking about a liquidity drain that can wipe out months of gains in minutes. If you want to survive the next FOMC meeting without ever getting wrecked, you need to understand exactly how this mechanism works right now. Let's go and let's talk about rate hikes. Inshallah.
So let's understand when the Federal Reserve moves, global markets shake. And we have to understand the mechanisms of how traditional monetary policy dictates the fate of digital assets. And in this case, we're going to be talking about crypto. Let's continue on. So what is a rate hike in the first place? So it's the Fed's primary tool to fight inflation. Okay. And it's pretty much a tightening. And it's when they raise the federal funds rate, which is the baseline interest rate for the economy. And borrowing costs end up rising due to this fact. It becomes more expensive for banks, businesses, and consumers to borrow money. So it's going to be more expensive in order to get loans, certain private equity, and just borrow money in general. And spending slows. Higher loan costs mean fewer mortgages, fewer car loans, and less business investments, which means the economy would slow down. So less people being able to get large sums of money. Okay, it's not a lot of people rocking around with over 5-6 figures. So less loans logically would mean less cars being bought, less mortgages equals less houses being bought, which would then cause the people who own the houses to lower the cost of the houses to try to get rid of it and make some profit. So whenever rate hikes come into place, it really just throws off the whole balance. And the goal of the rate hike is to reduce demand to lower inflation prices. Once again, this often causes pain in asset markets because since people have less money, less free cash, people are going to then have less money to flow into assets. So imagine if the economy is a speeding car, okay? Imagine that as inflation. And a rate hike is going to be the Fed slamming on the brakes. And the goal is to slow down without crashing the car, which causes a recession. Now, there is going to be repercussions for this, upsides and downsides. So keeping everything in mind is going to be extremely important. But when a rate hike comes into place, it means that banks, businesses, and consumers are going to have a harder time borrowing money. And the seesaw, so the dollar index, the DXY, you might have heard of it. So there's a strong inverse relationship between the strength of the US dollar and the price of Bitcoin. This is also because Bitcoin is used as an inflationary hedge since the US dollar is going to be a infinite currency. Okay, it can continuously just be printed, and owned by everybody. Bitcoin is going to be a finite currency. Okay, so only a certain amount of people will be able to own Bitcoin. Once it's gone, then it's going to be completely gone. So rates up equals the DXY would be up, which is letting us know that this is a strong US dollar and that the economy is trying to progress. And crypto down, okay, would be in relative relation to this, okay, equaling weak asset prices. So when the Fed rates hike, global investors buy dollars to access those higher yields. And a stronger dollar makes it more expensive to then buy certain Bitcoin assets, other cryptocurrency assets, and stocks, which suppresses
the price. Okay. So while crypto is going down though, gives you a really, really good opportunity in order to save your cash and buy assets at a low. Okay. Try and capitalize and always buy assets at a low. If you analyze that the setup or whatever you're looking at is meant to go up year after year after year after year after year after year, if it's hitting a low point, invest at the low points. Stop buying at all-time highs. Okay, and don't just look at when something is going down as a negative thing. Price has to pull back in order to go up. So if price pulls back, see that as an opportunity. Ask yourself, is that going to be a good buy? And if you're struggling to identify a setup, head over to stackmode.net or just watch my videos. Okay. Take advantage of the economy. Okay. When economy or when assets are down, take advantage of that. I don't care if it's real estate, Bitcoin, stocks, whatever. When assets are down, you have to take advantage of that low, because just like everything else, price inshallah will sweep back up, and you don't want to be in a position to where like, oh man, I wish I invested at X, Y, and Z time when you could have. So take your action, do what you need to do, and make your decisions today. Okay, catch your assets when assets are at a low. When the economy is in shambles and everyone's panicking, that's the time you need to be buying. It's really important to try and have some cash on hand. This way you're going to be able to make some good decisions and invest into these investments when you need. So while rate hikes hurt crypto in the short term, the reason for the hikes might fuel the long-term bull case. Okay, and the long-term counter narrative. If inflation wins, then the Fed raises rates, but inflation could still stay in a high stagflation point, and fiat currency loses purchasing power rapidly. And the hard money hedge, and that's why a lot of people look to and run towards Bitcoin, for example. Okay, Bitcoin, yes, is good for profit, but you can make a lot of money quicker playing options or futures, for example. But just the fact that Bitcoin has a fixed supply, it gives you a sense of asset superiority. So once it's gone and somebody has it, all right, and if you weren't to have it, then they would have an advantage. Okay, so Bitcoin's fixed supply, it's 21 million, and it's designed as an escape valve from failing fiat monetary policy, since we know that over time, the US dollar is meant to cost, or it's meant to give us less and less and less purchasing power year after year after year after year, since more dollars will just be printed. And the pivot hope. So the market's always trying to predict when the Fed will stop hiking and start cutting. And that's going to be the pivot. So the moment they pivot, crypto usually rallies super duper hard, because once they start pivoting, people are going to be like, all right, you know what, economy's safe. And then people are going to go ahead and start taking advantage of the buys. So mix in the economy news with the charts, and you guys are going to be able to make some really, really great decisions and some great choices. Use your higher time frames as well too. So you can check out the FOMC meetings on forexfactory.com, and the days the Fed announces rate decisions are historically the most volatile days of the year for crypto. So FOMC a lot of times is when they release a bunch of really important rate decisions and reports. And cash, understand that cash is going to be a position. You don't always got to be in a setup all the time. Cash is a position. So in a high rate environment, holding stable coins, right, the earning yield is often better than forcing bad trades in a bear market. You just don't need to do that. Don't do that actually. Okay, don't force trades in a bear market. Just wait for price to pull back, wait for buyers to step in, and then go ahead and catch the low. Catch the low. Once again, if you're struggling with finding the right setup, head over to stackmode.net and look for decoupling. It's the ultimate bullish signal, and it'll let us know when it's time to buy. So when tech stops drop on Fed news, but Bitcoin holds steady or rises, a lot of things are going to let us know when it's time to buy. Okay, so if you see tech stops dropping really, really hard, and then the Fed announces some certain news, you start seeing rallying, put that together with your higher time frame analysis and put it together with the charts, and you can start seeing like, okay, price is ready to buy. Or after big events like CPI and stuff like that, etc., a lot of people hold their cash until these big news events come out, and then you'll start seeing market make its move that it needs to be making. And sometimes you'll even see market, let's say for example, trending in a downwards direction weeks or days before this news event comes out. Then when the news event comes out, price will go ahead and blast in an upwards direction. Okay, so make your decisions patient ones. Okay, make sure they're extremely patient decisions, because the more patient you are, the better setups that you plan, the more money you're going to be able to make, inshallah.
All right, I'm gonna catch you guys in the next one. Stay prayed to God. Keep grinding. Head over to stackmode.net for all trading education. Peace.
What's going on, class? We're going to be talking about options mistakes that we just have to avoid, inshallah, if God wills. Okay, we don't want to be destroying our portfolio, destroying our future, destroying our dreams of buying the house, buying the car we want, living how we want, paying all of our bills and clearing our debt, etc. Okay, avoid these mistakes to avoid destroying your future. Okay, we got people to protect and provide for. Okay, and even yourself, you got to provide for yourself. Okay, so let's go and let's jump into the mistakes that we just absolutely have to avoid. Let's jump into it. So, mistake number one, having a gambler's approach. So, one, you gotta know how options work. Okay, you gotta know what you're doing. You gotta know what expiration date you want to buy, etc. Okay. So, the problem that people have when they come onto options is that they see people posting. Okay, they see people making big flips, big giant profit flips, etc. And then they're like, "Whoa, options is gonna be crazy." And they come on with a lack of information expecting certain results. So don't have a gambler's approach. Have a logical approach. Know where you're going to close at. Okay, if you're going to take a long trade, okay, you should know that you should be purchasing a calls contract. Okay, if you're going to wait for an area of resistance to be broken and turn it to support and then take it up to the upside and close at an area of resistance. Know where your take profit's going to be. Know where your entry is going to be. And most importantly, know where your exit's going to be. Okay, don't just hold your trade forever and cook your trade past certain areas, because there's going to be a lot of things that come into play with options, such as theta. And theta is going to be part of what's called the Greeks. Okay, and theta controls time. Okay, so theta controls time. So keep that in mind. Okay, so there's going to be things we can do to get past this. So have a good time horizon. Okay, even if your take profit isn't that many points away, try and buy contracts at least, I'll say 3 months to 2 years out. Okay, and that's going to be called a leap contract. Okay, you want to be buying leap contracts. Okay, you don't want to be buying 0 DTEs, you don't want to be buying a week out, etc. Okay, due to the fact that you're going to be fighting time. Even if you're right, you're still going to be fighting time. Let me tell you guys a story. There's been times where I made $930 in a day. Okay, I hedged on a J Powell speech. Okay, hedged on the J Powell speech, and I was up. I told myself I had a 0 DTE SPX contract. Okay, if you've ever played SPX, it tracks the S&P 500, but it's just a really boosted up version of it on options, pretty much. Okay, compared to the SPY. So I had an SPX contract. They were boosting up. I'm up around $930. I'm thinking I'm going to hold all day, not understanding how theta works, not understanding how the time works on the options. So due to me thinking that, came back to the trade, and the trade was then in the negatives. Okay, so I went from up being almost $1,000 in a single day to coming back negative a couple hours later. Okay, due to the fact that I got eaten up by theta. Yes, the trade continued in a certain direction, but as the day decided to decline and go on a further downtrend, okay, the market decided to flatten out, killing the 0 DTE contract. Okay, so if a transaction that you buy for a contract is looking to expire on the same day, okay, you can't expect to hold for a long time. You can't see your trade out the way that you want it to. So make sure you guys are buying at least 3 months to 2 years out. Okay, it's gonna really, really be important. And having a gambler's mindset is gonna be the most fundamental error. And options trading offers high leverage, okay, due to the fact that an options contract, it lets you play with 100 shares. Okay, keep that in mind. So options trader offers high leverage, which attracts speculators. Okay, speculators is when you're playing off directional bias, and on options, that's how you get paid. Okay, you're getting paid based off of choosing the right direction. So if the current price is going to be at 50, you think price is going to go to 52, okay, and you buy a 51 or 52 strike price contract and price hits there, you're going to go ahead and make some money, inshallah, if God wills. Okay, so that's how it works. So anyone who treats options though like betting and has a lack of repeatable tested strategy means that your results will be entirely random and often negative by the end of the year. And why it fails. Okay, you could have inconsistent and entry exit rules. You got to know where you're playing at. You got to know why you're playing. Okay, ask yourself why and where when it comes to the market. Okay, where am I going to close? Where am I going to enter? And why am I going to enter? Ask yourself these questions before you press buy or sell. And traders enter on a hunch, right, and exit based on panic or greed sometimes, leading to inconsistent P&L, profit and loss. When you're just closing wherever, you're destroying what's called your risk to reward ratio. Okay, so if you risk $100, you want to try and at least be making $400 or at least $100. Okay, so then you would double your money. Okay, so 100 plus 100 is 200. Okay. So, put that into mind and do your risk to reward. Okay, you could play 1 to 2 risk to reward, 1 to 3, okay, 1 to 4. Do your math. So, but just try and at least make your return back. Whatever that you risk, if you risk $750, try and make at least $750 back. Okay, so that's going to be a really a 1-to-1, I'll say. Okay, just try and make at least your risk back. So, and journal as well too. Okay, put your trades in a Discord and your notes, your physical notepad, whatever, wherever you want to do. Okay, I'm creating the Stackmode app, generating it right now, where you guys can go ahead and track all of your trades as well too, coming up very soon, inshallah. So, you can have some emotional decision making can happen sometimes in the market. Don't do anything that you don't need to be doing. If you're invested heavily into a shares play, okay, don't just pull out your money. Okay, keep it. Okay, if you believe in your view, if you believe in your trade, you can't be disrupting your process because you want to take out some money and be hasty and do something real quick. Go grind and go get some more money. And when it comes to pure candlestick formation, if you see market just go in a big upwards direction, a big burst, and you don't have any logical plan around it, no area of resistance where you want to close at or support above current price or any type of plan behind the trade, just don't take it. Okay, and the solution, right? Define your edge. Okay, figure out what you like. Okay, do you like calls? Okay, you know that market's going to be an upwards trend. There's a reason why market goes in upwards direction. They put jobs in the economy, and the company pays taxes, okay, which feeds the government, okay, and then the government can help the people, and it's a big cycle. So there's a reason why these stocks want to go up in upwards direction. So choose for focus. So ask yourself, are you an income trader? Okay, do you like cover calls on puts, or are you a volatility trader? Where you like straddles and strangles? Okay, stick to one initially, and never enter a trade where the potential loss exceeds the potential gain. Okay, just don't do it. It's not really worth it at all. Okay, take your time. Okay, make sure you guys are getting at least try to get at least a 1 to 2 risk to reward ratio, 1 to 3 risk to reward ratio, and at least a 1 to 1. Okay, never try and go negative with certain things if you want to earn on a good trade. Now, if you lose, but try and make some money on your trade. Try and go for at least a 1 to 3 minimum if you want to start growing your account. And specify the maximum duration that you want to hold for. Okay, because the longer that you have, the more of a risk reward that you can get, because you can have bigger take profits. You can use your higher time frames to look at your take profits. Okay, you can use your weekly time frame, your daily time frame, your 4-hour time frame, and set take profits weeks and weeks and weeks away. Grind in real life. Wake up, pray to God, go work out, keep building yourself, keep working on yourself, and then boom, trade hits, take profit, take the next play, take the next play, take the next play. Since you've been working on yourself so much, then inshallah, God wills, you have some more capital. Put that into the next play and just keep going hard. So we'll talk about the Iron Condor. So a structured strategy is like the Iron Condor. Okay, it's a non-directional, and it relies on the stock not moving too much, meaning expecting it to go in a flat direction. Okay, and your strategy must detail how far out of the money you place the wings, the expiration date, and the precise profit target, for example, 50% max profit, and where you will close the trade, regardless of the market movements. Okay, so keep everything in mind like that. So mistake number 2, right? The silent killers. Let's understand theta. Theta pretty much just equates to time. So options are decaying assets. So as soon as you buy it, it has an expiration date. You can hold shares forever, but options are leveraged. So if you're right in a certain amount of time, you will get paid. And options are decaying assets. And unlike stocks, time is going to be an enemy to the buyer and a friend to the seller. The rate of decay is known as theta. and it accelerates rapidly in the last 30 days before expiration. And the theta trap for buyers. Okay, sometimes there's going to be a steep decay curve, and an option may lose 20% to 30% of its value in a final week due to theta, even if the underlying stock price remains favorable. And buying too close to expiration. Trying to maximize leverage by buying 0 DTE. All right, and 0 DTE means 0 days to expiration. It'll expire at 4 p.m. Eastern Time, New York Stock Exchange time, and then can't be held overnight, and you have to reopen it again. Okay, or 7 DTE. Options increase the risk of total capital loss exponentially. And the implied volatility rate, crush. The implied volatility measures market expectations of future stock movement. And options prices surge when the implied volatility is high, usually before earnings reports or major news. And if you buy an option high IV, an expected event passes without a massive move, the IV would crush, causing the options value to plummet, regardless of the stock's minor price change. And some practical fixes. Options bought with the 45 to 60 days to expiration offers a better balance between theta decay and market responsiveness. And if your IV rank is high, right, say above 50%, consider selling the options. And strategies like spreads, okay, are going to be in the play too. And if IV rank is low, it's generally better to buy a premium in general. Okay. So, mistake 3, the blow up risk. So, using too much of your capital on a single trade. So, make sure you guys are trading between 1 to 10% of your account per trade, okay? And choose whatever percentage that you want and just stick to that, okay? Don't over leverage. Even if you hit a big giant chunky play, you make the most money in the world, okay? Stay between your risk parameters. Okay, if you have $1 million, then the max that you ever want to trade with is 100,000. Okay, you need to be doing it like that. Okay, break it down. Okay, break it down. Or I'll say 10,000. Yeah, 10,000, and break it down like that. Okay, decide how you want to trade and how you want to grow your portfolio. So options provide phenomenal leverage, which is their double-edged sword. And a beginner often uses 50 or 100% of their available capital on 1 or 2 trades. Now, if you know what you're doing, you're depositing your money in certain ways, like, okay, I'm going to use all this money for options, then that's different. Okay, but booting up your account where you have shares and everything, and then just showing your account on a couple of trades or bad decisions, it's just not. Okay, so believing the high probability of return justifies the risk. And this single mistake accounts for the fastest depletion of trading accounts. Okay, please do not overexpend your risk. Take your time. Do not use too much capital of your trade at once. Okay, spread out your trades and grow the wealth over time. Get rich slow. Okay, it's important to take your time. It's important to just stay down, wake up, pray to God, and just grind. Okay, keep putting the money away, keep investing, and I promise in a couple months, the play that you're investing to, whatever. Okay, just give it time. Inshallah, it'll pop. Okay, you have to give it time though. You can't rush by trying to use your whole account unless you structure your account like that. Okay, but if you know that you're trying to keep your account alive, don't just put it all into one giant trade. Try and spread it out. Diversify a little bit. So all of your capital can't just be tied to one underlying asset. And if that asset faces unexpected news, the entire account can be at risk. And sometimes there could be margin calls on spreads. Selling options or spreads without sufficient collateral means a sudden unfavorable move can trigger a margin call, forcing liquidation at a loss. And trading the farm. So risking more than 5% of your total account value on any single trade is mathematically unsustainable. Okay, so you could do 5 to 10% if you want, but 1 to 5% is going to be strong too, as a short losing streak could really wipe you out, honestly. Okay, but if you lose 10 trades in a row and you blow your account, then yeah, I understand how you could lose 10 trades in a row, but 5 trades gives you a lot more trades. Okay. So the 1% rule of risk management. So the gold standard, right? Never risk more than, I'll say 1 to 5% of your total trading capital per trade. And these mean that if your account is $10,000, your maximum potential loss in your position, it should be around $1,000. Okay, $1,000 if you're doing 10%, or it should be $500 for 5%. And this ensures that you can sustain a long sequence of losses while preserving your capital for future high probability trades. And this is for you to have protective stocks, Choose trade structures with limited risk, like defined spreads, and trade smaller and with more manageable positions. So calculate your max loss as well. So before every trade, determine the absolute worst case scenario and ensure that your trade is meeting the 1 to 5% rule. Okay. So keep majority of your capital in cash if you're not sure that you want to trade, and then you can deploy your positions when you take your time. So mistake number 4, right? The hope and pray method. Okay, we wake up, we pray to God every single day, but we can't just make horrific, horrible decisions. And bad traders set a trade and then just ignore it. Okay, we got to know where we want to close at. Okay, you can't just hope the trade is going to work out. Okay, you got to have a logical plan before the trade is even placed out. So make sure that you have a highly active process that involves a strict entry, exit, and stop loss criteria. And don't hold your winners too long. Close at take profits. So letting a trade run all the way to 100% max profit is rare and inefficient. You expose yourself to accelerated theta and assignment risk for a minimal additional gain. Okay. All right. So we pray to God every single day. Okay. We ask for hope. We ask for strength. And we're going to ask for wisdom to not make bad trades. Okay. We don't want to be buying at all-time highs and then expecting it to go up. Okay. There's certain things. Okay. Take Jesus, for example. Jesus did not jump off the cliff. Okay. Due to the fact that just didn't test God. Okay. So there's certain things that we just don't want to do as human beings. That's just a bad decision. Okay. We want to pray for wisdom. So cut your losses too. If you know your trade isn't going to work out, if you know you need to chop it up, chop it up. Don't hold past stop loss, especially on Forex and futures. Get margin called. Okay. So take your profit too. Take profit at certain places and make sure that you guys know what you're doing. And the unforeseen cost, okay, ignoring regulatory and tax complexity. So the IRS and other tax authorities, right, treats options differently than stocks. Furthermore, the risk of assignment or exercising an option can create unexpected financial obligations, especially when dealing with short sold options. So the tax headaches. So certain options like those broad-based indices such as the SPX or NDX are at a tax beneficial of 60% long-term and 40% short-term rate, regardless of the holding period. Okay, and this is the macro factor ignored by many traders, so keep that in mind. And trading options can easily trigger complex wash sale rules, preventing you from deducting a loss if you reestablish a similar position too quickly, leading to unexpected taxable gains. And avoid risk at expiration. So when you're selling options, there's always a risk that the options holder will exercise it, forcing you to buy for a put or sell for a call. And the underlying stock, this could be especially dangerous when a stock closes exactly at the strike price. Okay. And for the solution for that, always close short options, even those worth just a few pennies, before market closes on expiration Friday to eliminate assignment risk if that's how you're selling options. And the tiny commission is going to be worth avoiding the overnight risk of being assigned thousands of shares of stock. So some key takeaways, right? Develop a mechanical, repeatable trade plan with defined entry and exit and management rules so you know what you're doing whenever you're putting down some size. And respect theta. Theta means time in options world. Okay, and be mindful of the time decay. And trade strategies that benefit from high implied volatility when selling and low implied volatility when buying. And adhere to strictly to 1 to 5% maximum of your account, okay, per trade to protect your capital from inevitable losing streaks. And you can close soon winners, okay, you could trim, okay, make sure you guys know where you want to close your trades at, okay, set take profits, okay. If you have 10 contracts, make it to where you can close 6 contracts at this area, 2 contracts at this area, 2 contracts at this area, if that's how you want to play it. Okay, and know the rules. Understand the tax benefits of Section 1256 and actively manage assignment risk by closing short positions before the expiration. Trading is a marathon. It's not a sprint. Okay, stay prayed to God. Keep grinding. You can't give up. Okay, whenever you feel like trading's hard, when you feel like you want to give up, you got to keep pushing. Okay, you got to wake up, pray to God, ask for wisdom, ask for strength, and keep persevering. Okay, I don't care if you blow in your account. Wake up,
get 2 jobs, grow your business, keep grinding, keep making plays, and keep studying. Don't ever give up. I pray to God, guys. Catch you in the next one. Allah is amazing. Head over to stackmode.net for all trading education. Peace. What's going on, guys? Let me go ahead and show you the full guide on how to detect when prices are going to go ahead and reverse, whether it be for an uptrend or a downtrend. So let's talk about it. So first, price is going to reverse when it meets at its congruent areas or opposite areas. So what does that even mean? So if price, for instance, is trying to hunt an area of resistance, price has a chance to reverse at an area of resistance again. Okay, so that's going to be one potential reversal pullback area. So if you're looking for a short, this is going to be setup number A. Okay, if you're looking for a short setup. Okay, then we're going to have setup B for the short. Okay, or if there's an area of support above current price, okay, price can come up and turn that area of support into resistance. Okay, this is also going to be a probable area to short too. Okay, so both of these models right here are going to be usable in order to catch a reversal trade to the downside. Okay, so if you think price is going to go in a downwards direction, okay, if you think sellers are stepping in and price is going to short, then you're going to go ahead and be able to play model B. Okay, and you're also going to be able to play model A. Okay, so model A and model B are going to go ahead and work if you're trying to short trades, for example. Okay, so let me go ahead and show you if you're trying to long a trade. Okay, so let's talk about model C. Okay, model C is if an area of support decides to be created. Okay, an area of support is going to be an area where price decides to bounce upward at. Okay, so an area of support can go ahead and be mirrored and bounce that again. Okay, so if you see an area of support getting bounced at similar times, then that can go ahead and be a trade. This will also count as model C too. Okay, say price didn't exactly do a clean level of support. Okay, let's say price decided to break past this level of support that's going to be right here. Okay, so let's say price decided to do that. Okay, price could still run through it downward, come back up, and give it support. Okay, and that still be a support mirror. Okay, and then you can go ahead and take it up to the areas of resistance, which would go ahead and be another reversal point. Okay, so we're going to be closing at congruent or reversal areas. Okay, so if you're in a long trade, then you're ideally going to be closing an area of resistance. Okay, because you're expecting price to go in an upwards direction. Price can't go up if it doesn't break resistances or break past areas of supports above current price. Okay, it has to do one of the two. Okay, so you know price is going to try and either A, reverse at the resistances before the breakout, or reverse at the area of support above current price. Okay, causing a support into resistance. Okay, candlestick formation. Okay, also known as break and retest. Okay, so as far as a long example 2, okay, example D, price can also break an area of resistance, turn it into support. So resistance can be broken, turn it to support, and the price can go up to the upside and decide to go up. Okay, so this is going to be like the staircase model, and this is going to be my favorite model personally when it comes to longing trades. Okay, even when it comes to pullbacks. Okay, so even prices or areas of resistances below current price can still hunt back down to it eventually, turn it into support, and then you can catch an even bigger sweep up. Okay, so let's go and let's talk about on the chart how we can identify certain pullback levels. Let's make it easy. So if I'm on the stock market and cryptocurrency market, I like to always start off on my daily time frame. Daily time frame is going to give me my bird's eye view, and I'm going to be able to see absolutely everything. I can see 5 years worth of price action on one chart, for example. Okay, so I can also use my 4-hour time frame too. 4 hours are going to be amazing, and it's also going to be my bread and butter time frame too. So if I'm on the daily time frame here, I know that price is always going to be trying to chase new areas of resistances or supports above current price. Okay, why? Because if I'm in the stock market, I know that people are working hard within the company, generating revenue, generating items, okay, and giving those items to the public, okay, in order for people to buy, which will generate more revenue, okay. And when the company generates more revenue, earnings reports beats, you're going to see these financials down here where you can see surprise, estimated. So it'll be a report that estimates how much money a company will make. And if they beat it, then that means that they beat their earnings. That means that they beat the reports that they thought were going to happen, the estimates. Okay. If they beat the estimates, a lot of the times price can move in either a positive or negative direction sometimes too. But once a company has shown that it's profitable, especially when it's paying out dividends, which is something to where the more shares that you have, the more money that you get paid out in dividends, then it's going to go ahead and show you that, okay, this company is potentially profitable. And as you can see here on the daily time frame, from just 5 years ago, price was at pretty much $2 a share. Okay, $10 a share. Price is now at $178 a share. Okay, if you know the old NVIDIA prices, then if you know, you know. But NVIDIA had a squish, so the numbers got smaller. It used to be a lot bigger than this. But yeah, so you always know that price is trying to hunt an area of resistance above current price. Okay, always know that. So price is trying to hunt areas of resistances above current price, especially all-time highs. Okay, all-time highs is definitely a level that's trying to get hit and destroyed, so then price can continue upward. Okay, and then price can continue trying to make some more money. Okay, or the company can make some more money due to the fact that their share value is going to be increased. Okay, so instead of a certain person being a billionaire, you know, they could be a trillionaire depending on the stock value. So that's why I want it to go up. So here's how you know price is going to reverse. Okay, one, it's like we talked about with Model A. When price decides to come across areas of resistances, even if it's way in the past, you're going to see here on this blue line, price reversed at this area one time here. Okay, once. Okay, twice, 3 times, 4 times. Okay, 4 times. 1, 2, 3, 4. 4 times price decided to short at this blue line area here. Okay. And if I'm going to trade a breakout, this is why I don't trade the first candlestick personally. I like to wait for a 4-hour candlestick. So I'm going to wait for a whole new 4-hour candlestick to be above the zone for me to trade that personally. Or I would wait for break and retest. I would just wait for the resistance to be broken completely. And if it turns to support, then I'll take it up. Okay. That's also how you trade break and retest too. Okay. So, you know, price is going to be trying to break this area that one day. So even if price is below current price, I can see that, okay, price has this area of support created right here. Areas of support are going to be important because it's going to show you where price pretty much already wants to retest and bounce from. So areas of support below current price are going to be really important. But so are areas of resistances. Okay, heavy areas of resistances can also show you, especially with support, can show you and be like, okay, this price area can go ahead and be a decent area to buy. Okay, so check out this area right here. Okay, so if I put this area of resistance here underneath the circle, I can check that this area of resistance decided to get broken here. Okay, price got broken here. But once I got up, price decided to turn this area of resistance here, got broken, and turn into support here. Okay. So resistance broken, turned into support. Tried to hold it here once, got broken down, and then came up and did it again. And then price decided to bounce up. Okay. So you could wait for price to either come down to areas of support like here and see if price wants to bounce up. Okay. So either that, or you're going to wait for price to come in contact to an area of resistance. So price can either bounce down there. Okay. Or price can go ahead and bounce on the candles on top of it. Okay, maybe at these areas of resistances here. Okay, and just wait for price to go ahead and react because we know that resistance can be broken, turn into support. Okay, or price can go ahead and bounce at an area of support that was already there. Okay, so you can use that in order to make trades. Okay, make it extremely simple. Don't make it too hard whenever you're catching your reversals and your sweeps. All right. So either play a support mirror, resistance mirror, however you want to trade. That's all the formations of reversals. Stay prayed to God. Keep grinding. I'm going to catch you in the next one. Peace.
Trading without discipline, you might as well go take yourself to the slot machine. And God says not to do that for a reason. you can be extremely disciplined and you can grow your account to 5, 6, 7 figures just by staying consistent. I want to teach you guys about being disciplined and about taking accountability because I want you to get to the next level. Let's go and let's jump into it, inshallah. So the accountability hierarchy. So not all accountability is created equal. You must construct layers of defense against your impulses. So level 1. So system accountability. So the hard stop. Automated rules that are physically set on your chart, okay, and set in your brain that prevents you from trading, such as a broker daily loss limit. You can go into your broker settings as well too and have a certain amount that you can lose per day and per trade. Especially on that futures, you're gonna want to set your loss limit, especially if you're struggling with over trading, struggling with yourself, okay? And peer accountability as well too, or mentorship. Head over to Stackmode.net if you're looking for mentorship. A trading buddy on the same journey really helps you, okay? It helps you share plans, not just P&L, because I really care about getting you guys better. And a coach, okay, such as myself, someone with more experience who can spot behavioral leaks that you might miss normally. And systemized accountability prevents the action even in the first place. If you got your stop loss order down placed, right? Let's say you're in a setup, okay? If you got your stop loss order placed down and you got your take profit already placed down, it's going to be a lot harder to crash out when you already have your orders placed down in the proper areas. But if you come into a scenario where your stop loss, your take profit, your orders aren't placed down, and say price goes below your stop loss, okay, there's going to be times, because you're a human being, where you could potentially just ultimately freeze, okay? You might freeze. It might be hard to close because you don't want to lose a certain amount of money that's past your stop loss, okay? So this is why it's going to be really important for you guys to play with a stop loss and take advantage of your limit orders on your brokers. And data entry as accountability. If you don't track it, you can't improve it. Your journal is the evidence log of your business, and screenshots are going to be mandatory. Okay, try to keep it in a Discord. You can go ahead and put it inside of a Notion, and I'm working on the Stackmode app right now where you guys can also put your trades in there as well too. And emotional tagging. Record your state of mind. How are you feeling? You know, were you feeling pretty happy? Were you sad before the charts? Were you feeling quite mellow? Okay, all of these different factors and emotions are going to determine how we are for the day. Okay, are you greedy? Okay, revengeful from yesterday? Ask yourself these questions. And then the feedback loop. Okay, accountability isn't just writing it down. It's the review process at the end of the week or the day, asking yourselves, why did I take this trade? Where did I take this trade? Okay, why, where, and what did I make from this trade? Okay, so ask yourself why you took the trade, where you took the trade, and what did you get out the trade? Okay, and before every trade, write down your setup criteria, especially in the beginning. Ask yourself, does this line up? Okay, if you're going to play a pullback, for example, okay, if you're expecting price to curl back in an upwards direction after downtrending, we're going to ask myself, okay, did price create support? Did price create an area of resistance causing it to fall down in the first place? Okay, do I have 2 to 6 4-hour or daily candles going in an upwards direction after a heavy selling period? Okay, if so, I'm going to go ahead and take my long and take my best opportunity. So I have these things baked down into my brain of my criteria of what I'm looking for a setup. If I'm going to take a short, for example, I'm going to ask, okay, if I'm on my daily or 4-hour, is there an area of resistance to the left? Looking for a resistance mirror. Is there a reason why price wants to dump here again? So having your plan written down is really going to help you bake it inside of your brain. Okay, and the goal is to bake everything inside of your brain. Okay, as human beings, we can make mistakes, but through repetition, discipline, and grind, inshallah, and prayer, most importantly, we can definitely build this habit, the successful habit. So let's continue going. So a mentor, also known as the partner protocol. Okay, structuring the relationship. So choosing a random person from Discord often fails. Okay, you need a structured agreement. Okay, you could sign up at stackmode.net and get some trading mentorship. You guys can speak with me for free for the first call. Then from there, we'll go ahead and I'll give you a price and we'll talk about how I can make you guys better investors and traders. Try to have scheduled check-ins. Okay, this way you guys are going to be able to meet your status quos, improve, and have a more of a reason to be more educated and bring better results to your mentor or your coach. Okay, And a good partner and a good coach is going to criticize your mistakes. I try and just make sure you guys are always catching the right setups, and I don't high five your wins all the time. Okay, I want to ask you guys, did you follow your plan? Not just worried about, did you guys make money? Okay, even if you guys did make money, I want to ask you, was the setup correct here? Was it greedy? Was it an accident? Etc. Because I want you guys to make sure you're understanding what you're looking at wholeheartedly. And screen sharing. So I screen share my setups, and you screen sharing for me, for example. If you sign up for my mentorship, it really helps you, because then from there, you're not just looking at somebody else mark the setups, you're going to be able to mark the setups on your own. And avoid coaches or partners who are also struggling with massive discipline issues. And the blind leading the blind creates a toxicity loop where you validate each other's bad habits. So that's why ideally it is a lot better to get a coach or a mentor, somebody who's just on the better side, and it's going to be a lot easier to improve. So social pressure is extremely lame. Do not worry about what anyone thinks on this planet about your trades, about your money, about your P&L. Okay, who cares what they think? Who cares what people have to think? Okay, who cares if you've been trading for a while and people think you're not going to be successful at it? It doesn't matter. Does not matter. Leveraging the fear of embarrassment for positive gain is going to be building in public. So posting plans, not just P&L. So try and post your plan before the market opens, especially early on in my career. That really helped me build a lot of confidence, like posting my certain setups and then seeing things play out. And now if you deviate, then you would look foolish publicly. Okay, and the Hawthorne effect. Humans perform better when they know they're being observed. Okay, and risk. So be careful not to trade for the audience. And the goal is to adhere to the rules, not just showing off profits. There was a little season in time where I was on prop firm, making really good winning days, but then I would crash out my account on like right before a withdrawal day due to the fact that I wanted to just have a big giant withdrawal that I could flex to everybody. Okay, so I had to start trading for myself, had to redo my mindset and get detached to the money and work on my own spirit. And you can create a small private Twitter circle or just a Twitter where you can tweet your setups as well too, and your breakdowns as well, and it really does help. And you could really have a lot of people come in as well too and see the same things that you see, and building that public confidence. Be like, you know what, this trade I believe will go here, and being able to say that and stand on that, and then it happens, builds a lot of confidence. Okay, so if you want, try and post your trades on Twitter, Discord, share them with a friend or somebody, and it really does help. And gamification is really going to be important to understand. Okay, so rewire your reward system to prioritize process over outcome. So the carrot, it's going to go ahead and be the reward. If you follow your plan 100% for the week, regardless of the profit, okay, treat yourself to a non-trading reward, whether it be a nice dinner or massage or something like that. Okay, whether you guys like to go outside on runs or hikes or whatever, follow your trading plan and then live your life. The more you follow your trading plan, inshallah, the more money you'll be able to have, and the more you're going to be able to live your life. So fix some balance with that. Live your life and then enjoy your trading. Live your life and then enjoy your trading. And that's going to motivate you to stay a lot more disciplined. And the stick, it's punishment. If you break a rule, then that means that you're going to be banned from trading for 24 hours. No exception. Okay, if you break a rule, then you need to unplug your keyboard, lock it in the closet, and you're not going to be allowed to log on for the day because you broke your rule. And that's going to bring a really big neurological shift. So eventually your brain is going to associate following rules with pleasure rather than just winning money. Okay, and give your accountability partner, whether $500 or something like that, or your mom or something. And for every rule you break, then they keep $50. And the immediate financial pain of breaking a rule stops the behavior faster than a futures trading loss. Okay, I do not want you guys destroying your account in 1 second. So if you take a loss, take it extremely seriously and discipline yourself. If you care, you need to discipline yourself. If you ever overtrade, if you ever crash out, if you ever buy too early at an area that you know wasn't confirmed, discipline yourself. Okay, this way it's going to be a lot easier for it to not happen again. You have to be your own business person. You have to be your own boss and your own parent. Okay, let's head over to the next slide. In the forensic analysis, so post-mortem. So accountability, it's useless if you don't learn from the data. You must be a detective of your own failures. And reviewing the why. So did you just lose because the market was choppy? Or did you lose because you were impatient? You didn't wait. Waiting is going to be the number one thing that separates a profitable person from a not profitable person, is literally just waiting. You have to wait for the setup to come. You have to wait for market to form the way that it needs to. Okay. And categorize certain errors. Identify as an execution error. Did you fat finger or did you buy the wrong side? Did you take a short and then maybe you bought a buy on accident? Okay. Did you take a buy and you accidentally bought a short on accident? Okay. Analysis error. Did you read the chart wrong? Did you think price was in a downtrend the whole time it was in an uptrend because you weren't on your higher time frames? Ask yourself these questions. Analyze what went wrong. A lot of times there's a reason why you lost. And psychological error. Did you enter out of FOMO? Okay, fear of missing out. Or did you enter on revenge? Ready to crash out, ready to tweak, trying to farm for some money back again. And then guess what? It just doesn't happen. It just leads to more gambling, more random impulsive decisions. It makes things really, really hard. And the fix. Create a specific rule to address the most common error found in your review. And traders find 80% of losses. Okay, let's just say a trader finds 80% of losses happen between 12 p.m. and 1 p.m. Okay, that's going to be the lunch chop. And during that time, European market is no longer active as well too. And the new rule, okay, they're going to tell themselves, you know, I'm accountable to not be on my desk during lunch hour. So they don't place down a trade, destroy their account for absolutely no reason, trading at the times that they don't even like. And the compound effect of discipline. Consistency is the only grail in trading. And accountability bridges the gap between knowing and doing. So small wins. Being accountable for one small rule today builds the muscle for bigger rules absolutely tomorrow. And the equity curve. An encounter trader's equity curve is smooth, and an undisciplined trader curve is jagged, stressful, super duper high, super duper lows, and sporadic. You want your account to be looking consistent and slowly curving up like this. Okay, in the infinite game, you're not trading to win today, you're trading to stay in the game forever. Accountability ensures survival in every way. And discipline is doing what you don't like to do, but doing it like you love it. Okay, and accountability makes sure you do it even when you don't love it. Okay, so real trading is going to be pretty boring. It's never going to be like, oh my gosh, we'll do it. Like a lot of times when you're on your higher time frames, waiting for confirmation, you already know what you're looking for days ahead of time. So when it finally comes, it's more of like, oh, finally, it's here. Because it's a patience game. All right, so that's going to go ahead and be it. Head over to stackmode.net. I want to be you guys' accountability partner. Make sure you guys are setting hard stop loss and take profit limits so your trade automatically closes and you don't have to worry about that. And commit to the post-mortem reviews. Okay, read your journal. Jot down anything you need to in here, and it really helps you be a lot more successful. So let's go and let's jump into these charts.
Hey, what's going on? We're going to be talking about the psychology of a crypto trader, how things go, and how we can manage our emotions and avoid FOMO. FOMO is going to be fear of missing out. And it's pretty much going to be like say for instance, a candle burst straight up and you're going to be emotional. You're going to be excited to get in because you're going to be thinking money, 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 instead of thinking discipline, 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 discipline. So I'm going to be talking to you guys about how you can manage your emotions and turn those cringe emotions into discipline. So this is going to be a deep dive into the cognitive biases, emotional pitfalls, and some practical strategies we can do to maintaining mental resilience in volatile markets, such as the cryptocurrency one. Let's go. So the emotional roller coaster. The cryptocurrency market is a unique ecosystem, distinct from traditional finance, due to its 24/7 nature. So the stock market operates Monday through Friday, and same thing with Forex, okay? Forex and crypto, Forex, stocks, and futures, I meant to say, all operate Monday through Friday. Cryptocurrency operates 24/7, Okay, so whenever your levels get hit, as far as your take profit, say you're in a long trade, okay, and you're trying to close at an area of resistance above current price, okay, if take profit gets hit at 2 a.m. in the morning, you need to have your alerts set on your phone, okay? Your alerts are going to be a big use, okay? So what you can do is get on your phone, okay, or do it from your computer, whichever one, and just get the app of whatever brokerage you have, or get the TradingView app, okay, whichever one. Then from there, whatever stock that you're on, find the level that you want to close at, okay? You should know where you want to close at. You should know where you want to enter at, okay? And you should know where you want your stop loss to be, which is going to be a place where your trades is going to automatically close, okay? And you should know where you want to automatically close for a win as far as an exit. So if your take profit gets hit, you need to get up and close your trade, okay? You cannot be lazy when it comes to cryptocurrency. If you're deciding to play a 24/7 market, you need to be ready to 24/7 close your trades and manage your trade. Okay, so if you don't have limit orders set as far as stop loss orders and take profit orders set, then you need to make sure you're on top of it. Set your alerts and do what you need to do in order to succeed. So it's a lot different from the traditional finance system due to the fact that it's 24/7 once again. Has rapid price swings, and the influence of social media can make certain cryptocurrency coins or tokens or meme coins just skyrocket due to its popularity. And the more popularity something has, inshallah, a lot of the times the market cap is going to increase. Higher the market cap, people are going to trust it. Okay, the more trust something has, a lot of the times more value it's going to have, because people are going to feel more comfortable with parking tons of money within there. Okay, don't go into a state of euphoria whenever you're trading too. So even if you're making large amounts of money, okay, you're seeing your bank account go from $100 to $1,000. Let's say you held the trade for a good while. Okay, you're like, whoa, cryptocurrency, you did yourself a nice withdrawal. Okay, put 30% away for taxes. Okay, every time you withdraw, put 30% away for taxes. Whatever your withdrawals amount is, put 30% away for taxes in some different bank account. Okay, really 50% of that in a whole other bank account. Keep breaking down your money like that. So this environment amplifies human emotions, turning every price chart into psychological battleground. And understanding the emotional psyche of the market is going to be the first step towards achieving a disciplined mindset.